Please like, share, and subscribe. Wishing you happiness and good luck every day.
So what if you could actually invest like the most successful investor in modern history? Well, today we're cracking open the playbook of Warren Buffett himself. We're going to look at the core principles that helped him turn a pretty small investment into an absolute empire worth billions.
And just so you know where all this is coming from, everything we're about to dive into is based on this fantastic book. It's really a practical guide for the rest of us, the regular investors, showing how you can take Buffett's time-tested strategies and actually use them for yourself.
Get this, 27%. For 36 years straight, that was the average annual return for Berkshire Hathaway, the company Warren Buffett runs. I mean, that's just an incredible testament to his discipline and his laser-focused long-term vision.
Look, you don't have to be some kind of Wall Street wizard to invest like Buffett. It's really about adopting his mindset, a calm, rational approach that can help you hit your own financial goals. So, okay, let's dive in and see how you can start thinking and investing like a true legend.
Here's our game plan for today. We're going to start with the man himself and the common mistakes he just doesn't make. Then, we'll get inside the heads of his two most important mentors, we'll break down his core principles, and we'll even uncover his kind of unique research methods. And then, at the end, we'll bring it all home and show you how to apply this stuff yourself.
All right, first up. To really get why Buffett is such a genius, you have to understand the mistakes most of us make when we invest. Let's explore why his way of doing things is just so different and, frankly, so successful.
Buffett's real secret weapon isn't some fancy algorithm. It's his complete mastery over his own emotions. He totally avoids that siren song of the market, that mix of fear and greed that causes so many people to buy high, sell low, chase hot tips, and panic during every downturn.
So, where did this incredible discipline come from? I mean, it didn't just appear out of nowhere, right? Well, the answer really lies with two other investing legends. Two mentors who completely shaped his philosophy and put him on this path to greatness. So here are the two pillars of Buffett's entire worldview. On one side, you've got his teacher, Benjamin Graham. He was all about bargain hunting, finding those cigar butt stocks, as he called them, companies that were beaten down but had one last good puff left in them. On the other side, you have Philip Fisher, who is all about quality, finding these amazing businesses you could just own forever.
This quote really nails it. It's such a great reminder that investing isn't just about getting a good deal. It's about finding a fantastic business that you can stick with for the long run. One is just, a quick, cheap thrill. The other is a source of real, lasting quality.
And this is where Buffett's genius really shines through. He realized that value and quality aren't opposites. He blended these two ideas together and came up with his master stroke, realizing that it's far, far better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price.
Okay, so we've got the foundation of his philosophy down. Now let's get into the nitty-gritty, the 12 timeless principles that guide every single one of his investment decisions. These are literally the rules that made him who he is.
You can really boil all of Buffett's principles down into this simple three-step process. First, it all starts with the right mindset. You're not a gambler, you're a business owner. Second, it's about doing the hard work, that rigorous analysis to find great companies at a good price. And finally, it's about disciplined action, having the guts to go against the crowd and the patience to hold on for years.
This circle of competence idea is so powerful because it saves you from making so many dumb mistakes. It's just about being honest about what you don't know and staying in your lane, right? So if you're a doctor, you probably understand healthcare companies way better than, say, a brand new tech startup. So invest there.
But here's the thing. Buffett's process doesn't just stop at the spreadsheet. Oh no, he goes a huge step further, using this really powerful investigative technique that he picked up from his other mentor, Philip Fisher, to get the real story behind a company. Fisher called this process scuttlebutt, and it's basically like being a detective for your investments. It's all about getting out there, talking to people, asking smart questions, and piecing together a true picture of a company's real-world position from the people who know it best.
And look, this isn't some secret art form. This is just about rolling up your sleeves and doing the homework. You can get this incredible three-dimensional view of a business by talking to its customers, its suppliers, even its competitors. It gives you an understanding that numbers on a page could never, ever provide.
The salad oil scandal is just a perfect example of how scuttlebutt can give you a massive edge. While the rest of Wall Street was freaking out and dumping American Express stock, Buffett was out on the street, doing his homework. He found out the brand itself was still rock solid, and that conviction made him an absolute fortune.
Whew, okay. We have covered a ton of ground, from his mentors to his core principles, so now let's bring it all together and figure out how you can actually start putting this stuff into practice today. I know what you might be thinking. This all sounds amazing, but where do I even begin? The great news is you don't have to be a financial guru to get started with this. There are actually several really practical ways to go about it.
You basically have a few options here. The simplest way? Just buy shares of Berkshire Hathaway and let the master do all the work for you. Another route is to build your own little baby Berkshire by investing in the same public companies that he does. Or you can find a mutual fund manager who thinks and invests in a similar way.
Now, for those of you who want to roll up your sleeves and find your own gems, this scorecard is a fantastic place to start. Think of it like a checklist. It helps you zero in on businesses with that long-term potential by focusing on the stuff that really matters: profitability, financial health, and good old-fashioned cash generation.
I love this quote. It's really a gut check for any investor, isn't it? Are you just a short-term renter of stocks, jumping in and out, or are you a long-term business owner? Because how you answer that question, well, that's probably going to determine your entire success in the market.
Because at the end of the day, all of this, the principles, the scorecard, the scuttlebutt, it isn't really about a secret formula. It's about a mindset. It's about developing the patience, the rationality, and the discipline to stick with your plan, especially when the market is going completely haywire.
So I'll just leave you with this final question to think about. Are you investing for a lifetime, or are you just investing for the moment? Your answer to that doesn't just shape your financial future. It really reveals the kind of investor you truly are.
So, you want to invest like the one and only Warren Buffett. I mean, who doesn't? It feels like this huge, impossible task, right? Trying to copy the genius of the Oracle of Omaha. But what if I told you there's actually a pretty clear map to follow his strategy? And it's a whole lot easier than you probably think. That's the dream, isn't it? To get a little bit of that Buffett magic working for you in your own portfolio? Well, if you've ever felt like a Warren wannabe, then you are in the right place. We are going to break down a clear, actionable game plan to follow his whole value investing strategy. So, here's how we're going to do it. First, we'll try to unpack the puzzle of Buffett's style. Then, we're going to explore 3 totally different paths you can take. You can own a piece of his company, you can build a portfolio yourself, or you can use a managed fund. And then, at the very end, we're going to pull it all together into one seriously powerful solution. Okay, let's be real. At first glance, Buffett's whole strategy can feel, well, super intimidating. You're talking about decades of wisdom, crazy complex financial analysis. It just seems completely out of reach for the average person. But the truth is, the core ideas can be applied in some really practical ways. Let's kick things off with the most straightforward path of all. I mean, if you want to invest like Warren Buffett, the absolute easiest way is to just become his partner. How? By owning a little piece of his company, Berkshire Hathaway. Now, you're probably thinking, wait a minute, aren't those shares insanely expensive? And you're not wrong. The Class A shares cost a small fortune. But that's why the Class B shares exist. They're about 1/30th the price and were created specifically to be more accessible for folks like us. Yeah, you get less voting power and you can't tell the company where to send its charity donations, but you are still a direct owner of Berkshire. And get this, Buffett himself has given us a super clear rule of thumb. He literally says that if you can buy the B shares for more than a 2% discount compared to the A shares, you're getting a better deal. He's telling us exactly how to get the best value when buying his own stock. How cool is that? So how should you actually go about buying it? Well, one great strategy is something called dollar cost averaging. It just means you invest a fixed amount of money regularly, say every month. It helps you build up a position over time without all the stress of trying to perfectly time the market. It's also smart to check out what the analysts are saying, and of course, in true Buffett fashion, think about buying when the stock is hanging out closer to its yearly low. All right, let's move on to our second path. This one's for those of you who want to be a little more hands-on. This is the build your own approach, where you basically construct a portfolio by buying the very same individual stocks that Berkshire owns. Berkshire's portfolio is filled with a ton of publicly traded household names, companies you definitely know. You can just go out and buy shares of Coca-Cola or General Dynamics yourself. The thinking here is that since Buffett is famous for buying reasonably priced stocks, these companies should, in theory, still be a pretty good value. But, and this is a big but, there are some real dangers here. First, there's a time lag in the reporting. By the time you find out what Berkshire owns, he could already be quietly selling it off. Second, and this is a huge one, you risk creating a really lopsided portfolio. You might end up way more exposed to one single industry than Berkshire is, which actually makes your investment a lot riskier. And this brings us to the most important part of this whole DIY approach: balance. You see, just copying a few of Buffett's top stocks isn't a strategy, it's more like a gamble. To avoid creating this riskier, unbalanced version of Berkshire, you gotta be a little more thoughtful. So how do you actually get that balance? Here are 3 great ways to do it. You can peek at the holdings of other value-focused mutual funds to get some ideas. You could also intentionally buy stocks in sectors that Buffett tends to stay away from, like healthcare, just to diversify. And you can add some international flavor by looking at foreign stocks held by a fund like Tweedy Brown. Okay, that brings us to our third and final path, using mutual funds. You can think of this as the managed approach. You're basically hiring a professional fund manager to go out and buy Buffett-style stocks for you. It's a fantastic option if you love the philosophy, but don't want to do all the individual stock picking yourself. This really is the million-dollar question, isn't it? If we're going to go down this road, we want the fund that's the closest thing to the real deal. So which one is it? The consensus answer is a fund called Sequoia. It was actually started by one of Buffett's friends from business school, and it's known for its incredible long-term track record. But there's a giant catch. It's been closed to new investors for years, which makes it notoriously hard to get into. And this table right here shows you exactly why Sequoia is considered the top dog. Just look at its largest holding, Berkshire Hathaway Class A stock. It makes up nearly a third of its entire portfolio. I mean, it doesn't get much more Buffett-like than that. Okay, so if we can't get into Sequoia, how in the world do we find the next best thing? A common metric people use to compare funds is called R-squared. In simple terms, it just measures how much a fund's performance is explained by the ups and downs of a market index, like the S&P 500. A score of 100 means they move in perfect sync. So you'd probably think, okay, simple. I'll just look for a fund with an R-squared close to Sequoia's, which is 37. But when you look at the data, the numbers are all over the place. Vontabell is even lower at 27, while Clipper and Terray are way higher. There's just no clear pattern here at all. And that leads us to a pretty surprising truth. It turns out R-squared is just not a useful guide in this particular search. So why is that? It's because Buffett-style funds are often highly concentrated. They hold fewer stocks than a typical fund. And because they're so concentrated, they don't really track the broad market, which makes R-squared a really misleading number for what we're trying to do. So let's pivot to the metrics that actually matter. First, look for funds that are concentrated, meaning they make big bets on a smaller number of stocks. Second, you want low turnover. That shows how often they're buying and selling. A low number means they have a buy and hold strategy, just like Buffett. And finally, look for low price to earnings and price to book ratios. Those are classic signs that a fund is buying undervalued companies. And as you can see, funds like Clipper and Longleaf Partners really start to fit that profile. Whew. Okay, we've explored 3 completely different paths, and each one has its pros and cons. So now let's do the fun part. Let's bring it all together into one single, cohesive strategy that any Warren wannabe out there can use. Here it is, a sensible 3-part solution. It's actually pretty simple. First, own some Berkshire Hathaway shares directly. That's the purest way to play it. Second, carefully pick a few individual Buffett-like stocks to round things out. Just make sure to stay balanced. And third, add 1 or maybe 2 Buffett-oriented mutual funds to get that professional management and extra diversification. And one final, really crucial tip. Value investing can sometimes go through long stretches where it underperforms the market. So to give your portfolio more stability over the years, it's a really good idea to balance your Buffett-style value stocks with some good growth stocks or even growth-focused mutual funds. Diversification is always, always key. So there you have it. A clear map with 3 different paths and a final strategy to tie them all together. See? Investing like a legend doesn't mean you have to be one. It just means you need a sensible plan. Now, the only question left for you is, which path are you going to explore first? Warren Buffett. You hear the name, and you immediately think of investing success, right? But he's so much more than just one of the richest people on the planet. His absolutely staggering, decades-long record of beating the market is a phenomenon. It's something that forces us to ask some really fundamental questions about how investing actually works. I mean, is this guy a once-in-a-generation genius? Was he just incredibly lucky? Or is there something else going on entirely? Okay, let's really dive into this. So, let's start with just one number that kind of sets the stage for this whole story. 27%. That was the average annual growth rate of a single share of Berkshire Hathaway's stock from 1965 all the way through the year 2000. To put that into perspective, that's the kind of compounding power that turns a small nest egg into an absolute fortune. It's a number that, in the world of finance, is almost mythical. And it's not just the raw numbers that are so impressive. This quote right here, this is from John Bogle, the founder of Vanguard, the guy who basically invented index funds for regular people like you and me. So when he says that Buffett belongs in this tiny, super exclusive club of people who can actually beat the market, well, that carries an unbelievable amount of weight. It's like getting a 5-star review from the toughest critic in the world. All right, so let's get into our first section here, the legend of Buffett. Because before we can even start to debate the man or the myth, we have to establish the foundation of his legend. And that foundation is built on the raw, undeniable numbers that prove his incredible consistency over a very, very long time. Just think about that for a second. Beating the market, even for 1 year, is really, really hard. Most professional fund managers can't do it. But to do it 32 times in 36 years? Wow, that's not just a lucky streak. That's a pattern. It's relentless, and it's the kind of consistency that separates a pretty good run from, true legendary status. And this right here, this is what that consistency actually looks like in your bank account. Imagine you bought one single share of Berkshire Hathaway back in 1965 for about $12. If you did nothing, just held on to it, by the end of the year 2000, that one share would have been worth $71,000. It's just a jaw-dropping way to see the sheer power of his ability to compound money. Okay, so moving on to our second section, the man versus the myth. We've seen the legendary numbers, but who is the person behind them? This gets us to a really fascinating contradiction at the very heart of the Buffett story. Is he the folksy, aw shucks grandpa from the news? Or is he something else entirely, a highly sophisticated, razor-sharp Wall Street pro? Now, this slide really gets to the core of it. On one side, you've got the myth, right? The guy from Omaha with the aw shucks persona who loves his hamburgers and cherry cokes and makes investing sound so simple. But then you look at the reality. He's a graduate of Columbia Business School. He was the only student to ever get an A+ from the legendary Ben Graham, the father of value investing. And he uses complex strategies like arbitrage, which is all about profiting from tiny, temporary price differences. This is not simple stuff. This is the work of a deeply analytical and sophisticated strategist, even if he doesn't work on Wall Street. And beyond the numbers and the big brain, there's this other crucial piece of the puzzle. His reputation for just being a decent guy. I mean, in a world that's often defined by corporate greed, Buffett is famous for his unshakable loyalty and his deep, deep dedication to his shareholders. That 5-hour Q&A session he holds every year, that's not a gimmick. That's about building trust. And in the world of investing, that kind of trust is an absolutely priceless asset. Okay, part 3, the data showdown. We've talked about his legendary consistency. Now let's really zoom in and look at the head-to-head numbers. We're going to see just how dramatically he could outperform the market, especially when things got really tough for everyone else. Just look at this. 1977 was a pretty terrible year for the stock market. The S&P 500 lost over 7%. But Berkshire Hathaway? It soared by almost 32%. That is a nearly 40-point difference. This shows he wasn't just riding a bull market wave in the good times. He was a master navigator when everyone else's ship was taking on water. In this table here, it basically expands that 1 year into a 36-year saga. Now, don't worry about memorizing every single number here. Just let your eyes scan down that last column, the one labeled relative results. What do you see? It's just a sea of positive numbers. Sometimes he won by a little, and sometimes, like in 74 and 77, when the market was getting absolutely crushed, he won by a massive, massive margin. The takeaway here is that the long-term data is just, well, it's simply overwhelming. So, an incredible record, no doubt. But is it purely genius? Now we've got to pivot to part 4, the skeptic's case. And here, we're going to explore the other side of the coin, the legitimate financial theories and alternative explanations that really challenge the idea that any single person can be that much better than the market for that long. Now, these skeptics, they aren't calling Buffett a fraud or anything. Instead, smart thinkers like Larry Swedroe, they start with this really powerful idea from finance called the efficient market hypothesis. And it basically says that all the known information about a company is already baked into its stock price. So it's almost impossible to consistently find bargains. Now, if that theory is true, then Buffett's record can't be pure skill. It has to be an anomaly that needs some other explanation. So how do they explain it? Well, this slide breaks down the 4 main possibilities. The first 2 are pretty simple. Either he's a genius or he's the luckiest guy on earth. But the 3rd and 4th are way more interesting. Number 3 suggests he's not just a passive investor picking stocks. By getting on company boards, he can actively influence his own success. And number 4, this points to his secret weapon, using the float from his insurance companies. Think of it like this. You pay our car insurance premium today, but you might not file a claim for months, or ever. That massive pile of cash that Berkshire holds on to in the meantime, the float, is basically a giant interest-free loan that he gets to invest for Berkshire's own profit. It's a brilliant, low-cost form of leverage. And the skeptic's case gets a whole lot stronger when you look at periods like this one. From mid-1998 to early 2000, while the S&P 500 was rocketing up 24%, Berkshire's stock got crushed. It fell by 46%. That is a shocking difference. It made a lot of people wonder if the old master had finally lost his touch, and it proves that even the greatest can look totally out of step with the market. But like with everything in investing, context is absolutely key. So why was he doing so badly? Well, this was the absolute peak of the dot-com bubble. Tech stocks with zero profits were driving the S&P 500 to just insane heights. And Buffett, sticking to his lifelong discipline of only investing in businesses he could truly understand and value, simply refused to play that game. He just sat it out. So, after looking at the legend, the man, the incredible data, and the case from the skeptics, what does this all mean for the rest of us? Let's move on to our final section, Buffett's enduring lesson. Because it turns out, his amazing career might teach us more about the game of investing itself, and not just about the greatest player. And this is really where Buffett's story becomes a lesson for all of us. You see, his incredible, exceptional record doesn't prove that beating the market is possible for most people. No, it actually proves how ferociously difficult it is. And why is that? It's because your opponent, a simple index fund like the S&P 500, has all these massive built-in advantages. It's super diversified, it has rock-bottom costs, and it automatically holds more of the winning stocks as they get bigger. Trying to outsmart that year after year after year is what makes this the toughest game in town. And that leaves us with this final, really provocative thought. If Warren Buffett, with all of his genius, his discipline, and his unique structural advantages, is the massive exception that proves the rule, then is his real legacy a warning? Is the story of the greatest investor of all time actually the single most compelling argument for the average person to not even try to be like him? It's something to think about.
Warren Buffett. You hear that name and you immediately think of mind-boggling wealth, of investing genius. But what if I told you the real secret to his success isn't some complex financial formula, but actually has more to do with the character of a plain-spoken U.S. president? Today, we are going to unpack the life and the principles of a true financial legend to figure out how the man from Omaha really truly became the most successful investor in history.
So, to really get Warren Buffett, we've got to start with a pretty surprising comparison. President Harry S. Truman. It is absolutely fascinating how two guys from such different worlds can be described using the exact same words, plain spoken, genuinely from a small town, and with this really appealing mix of being both modest and incredibly confident. Now, this isn't just some weird personality quirk. This is the bedrock, the very foundation of Buffett's entire philosophy and his success.
All right, so we're going to follow Buffett's incredible journey through 6 key chapters. We'll kick things off with his roots as the man from Omaha. Then we'll see those first sparks of genius as a capitalist in the making. We'll watch him transform into the intelligent investor's apprentice, ride that incredible wave of the partnership's winning streak, and then we'll dive deep into the engine of his empire, the Berkshire Hathaway machine. And finally, we'll take a step back and look at the uncommon legacy he's built. Okay, so let's start at the beginning. Our story begins in Omaha, Nebraska, and this is where that foundational Midwestern character was really forged.
This shared worldview really snaps into focus when you see how they both reacted to just extreme, over-the-top wealth. Truman, he looked at the incredible opulence of the Palace of Versailles, and all he saw was money that was squeezed from the common person. Decades later, Buffett is looking at Hearst Castle, and he's not in awe. He has this very practical critique, seeing it as resources that were taken away from other societal purposes. For both of them, this wasn't about envy. It was a really deep-seated belief that wealth should have a purpose beyond just, showing off.
So Warren was born in Omaha back in 1930. He was the only son of a stockbroker who later became a congressman. And his dad really taught him his core moral values. But his relationship with his mother, well, that was a lot more complicated. She was often described as being difficult and disapproving. And some people suggest that this very dynamic is what fueled this incredibly deep drive in him, this powerful need to prove his worth not just to her, but to the entire world.
And let me tell you, this intense drive wasn't just some teenage phase. Oh no, it was there from the very beginning. It's what turned a young boy from Omaha into a full-blown capitalist in the making.
Just try to picture this for a second. At only 7 years old, lying in a hospital bed, he makes this stunningly clear prediction to his nurse. He says, "I don't have much money now, but someday I will, and I'll have my picture in the paper." I mean, come on, that wasn't just some childhood fantasy. That was a declaration of intent. The blueprint for his life was already being drawn up.
And he did not waste a single second putting that plan into action. The hustle was just relentless. It started small, age 6, selling chewing gum door to door. By 11, he'd already graduated to working at his father's brokerage firm. Then, at just 14 years old, he used his savings from his paper route, money most kids would have spent on comic books or candy, to buy a 40-acre farm and become a landlord. And from there, it was on to fixing up and renting out pinball machines. Every single step was a masterclass in finding an angle and turning it into profit.
His first real taste of the stock market came when he was 11, and it was a huge learning moment. He bought 3 shares of a company called City Service Preferred. He totally panicked when the price dipped, and then he sold for a tiny little profit the second it recovered. He probably felt like a genius for a day, but then he had to watch in agony as that same stock soared all the way to $200 a share. It was a painful lesson for sure, but absolutely priceless. It would define his entire career. In investing, patience is everything.
That painful lesson in patience really set the stage for the most pivotal chapter of his entire intellectual life, his time as the intelligent investor's apprentice. This is the exact moment his raw entrepreneurial talent found a powerful, guiding philosophy.
But look, his path to greatness was not a straight line, not at all. And what has to be one of the greatest ironies in business history, a 19-year-old Warren Buffett applied to Harvard Business School and was flat out rejected. Can you even imagine being the admissions officer who made that call?
I mean, you have to imagine how devastating that must have felt. His high school yearbook literally labeled him a future stockbroker. So in that moment of rejection, did he think his dream was over before it even really began?
Well, far from it. That rejection from Harvard actually led him to a discovery that would change his life forever. Benjamin Graham's book, The Intelligent Investor. For Buffett, reading this book was like a religious experience. He said the veils fell from his eyes. In a world obsessed with speculative gambling, Graham offered this revolutionary, simple idea. Treat investing like you're buying the whole business. Find good companies that are trading for less than they're actually worth, and then just have the patience to hold on. This book didn't just give him a strategy, it gave him a creed to live by.
Buffett was so fired up by this book that he enrolled at Columbia University specifically so he could study under Graham himself. He became a total star student, the only one to ever get an A+ from the master. And yet, when Buffett graduated and offered to work for Graham for free, Graham's answer was a simple, flat no. As Buffett later joked, Graham just made his customary calculation of value to price and decided the value was zero. It's a pretty amazing testament to Graham's discipline, right? Even his most brilliant protege had to be a good deal. So, with Graham's principles now as his compass, Buffett was ready to stop being the apprentice and start his own thing. And this is where he puts everything he's learned to the ultimate test, which leads to the legendary partnership's winning streak.
So in 1956, he moves back to Omaha with about $140,000 in savings. He gets a small group of family and friends together and creates an investment partnership. But here's the detail that tells you everything. Of all the initial money, Buffett himself only put in $100. It was the ultimate bet on himself. And his pitch was so simple and incredibly bold. I will beat the market by 10% a year, every single year.
And the results? Well, they were just staggering, absolutely mind-blowing. Over the next 13 years, while the Dow Jones delivered a pretty respectable 7.4% annual return, the Buffett partnership compounded at an almost unbelievable 29.5% per year. He didn't just beat his crazy audacious goal, he left it in the dust.
Now, the partnership made him a millionaire, but his next move is what would make him a legend. He was about to build his masterpiece, the Berkshire Hathaway machine, and it all started with a nearly bankrupt textile mill.
So back in 1962, he starts buying up shares in this struggling textile mill called Berkshire Hathaway for less than $8 a share. By 1964, he had full control. But here's the thing. Buffett wasn't interested in making shirts. He saw that the American textile business was basically doomed, so he made this brilliant pivot, using the shell of this failing company to get into a completely different industry, insurance.
So why insurance? Well, the answer comes down to one magic word: float. This is the secret engine at the very heart of the Berkshire Hathaway machine. Here's how it works. Customers pay their insurance premiums up front, right? And the company gets to hold on to that cash, that's the float, before it has to pay out any claims. For most companies, that's just working capital. But for an investor like Buffett, this float became this gigantic, constantly refilling interest-free loan from the rest of the world. It was the fuel he used to buy up slice after slice of American business.
And that machine made him one of the richest people on earth. But that brings us to what I think is the most fascinating part of his story, his truly uncommon legacy. Because for Buffett, the principles he lived by were always more important than the billions he was piling up. This simple statement, it just reveals so much about his character. When a prestigious club in Omaha, a real pillar of the city's establishment, refused to admit Jewish members, Buffett didn't just quietly disagree. No, he went before their board and he told them that is hardly fair. And then, to really drive the point home, he immediately applied for membership at the city's all-Jewish country club. It was this quiet but incredibly powerful act of defiance. For Buffett, fairness was never just some abstract concept, it was a call to action.
And this really brings us to the great paradox of Warren Buffett. On the one hand, you've got the billionaire titan who owns huge pieces of global giants like Coca-Cola and American Express. And on the other hand, you have the neighbor, the man who, to this day, lives in the very same modest house he bought for $31,500, who drives himself to work and who takes a salary of just $100,000 a year.
So all of this leaves us with a final, really essential question. When the history books are written about our time, what will be Warren Buffett's true legacy? Will it be the almost unimaginable fortune he built? Or will it be the simple, powerful idea that you can absolutely win the game of capitalism without losing your soul? Now that is something worth thinking about.
Welcome to The Explainer. Today, we're digging into the mind of the man who literally taught Warren Buffett almost everything he knows. But this isn't just another success story. Nope. This is about a philosophy that was born from and forged in the fire of a financial catastrophe so huge it completely reshaped the world.
All right, here's how we're going to break it down. We'll start with the historic crash that really set the stage for everything he did. Then we'll look at how that absolute chaos created his core belief, the margin of safety. After that, we'll unpack his brilliant idea of Mr. Market, look at the real-world tools he used to hunt for bargains, and finally, really try to understand his incredible legacy as a teacher.
You see, to really get Benjamin Graham, you have to first understand the unbelievable devastation of the market collapse that defined his whole life. This wasn't just a dip, it was a total reset button on the entire financial world. I mean, the absolute giants of the era, they weren't just weakened, they were totally decimated. Take U.S. Steel, a titan of American industry. Its stock plummeted from over $260 all the way down to just $22 a share. The entire bedrock of the country's economy was just crumbling. This wasn't a correction. This was pretty much a total wipeout of value. I mean, to put that into perspective for you, the really bad bear market of 1973-74, stocks lost about 45% of their value then. The Great Crash was almost double that. Just unbelievable.
And you know what made it even worse? All this false optimism coming from the very top. As the market was sliding into the abyss, you had leaders telling people, hey, it's a great buying opportunity. And this lured so many investors, even the so-called experts, right back into a market that was in a complete and total freefall.
And that's the crucial point, right? Nobody was safe.
All the old rules of investing, they were proven to be completely useless. And this personal financial ruin, this became Graham's crucible. He knew he had to find a new way, a better way, to deal with the world that was just full of risk. So Graham's response to all this chaos wasn't despair, not at all. It was the creation of a disciplined, logical framework that was specifically designed to protect against another catastrophe. It was the margin of safety.
You have to understand, Graham's life was shaped by two huge financial traumas. First, as a kid in 1907 when his family lost everything. And then again as a professional during the Great Crash. These experiences just baked a deep, fundamental aversion to risk right into his DNA.
So after being wiped out not once, but twice, he came up with this core concept, born right out of that pain. The margin of safety. It isn't just a guideline. It's a non-negotiable cushion between the price you pay for something and what it's actually worth. It's this simple, powerful idea that because the world can go completely crazy, you have to protect yourself from being wrong.
And you can't overstate how important this idea is. His most famous student, Warren Buffett, called margin of safety the three most important words in all of investing. For him, it wasn't just some rule. It was the absolute bedrock of his entire philosophy. Everything else is built right on top of that foundation.
But see, Graham didn't just create rules. He created these powerful mental models to help investors get through that emotional roller coaster of the market, which, as he knew all too well, was the real source of danger.
The first thing he did was draw a hard line in the sand. He basically forced you to ask yourself, are you an investor making a calculated decision based on analysis, safety, and a decent return, or are you just a speculator, basically gambling on which way the prices will move? For Graham, that distinction meant everything.
And this is where he gets so brilliant. He personified the market as this manic, depressive business partner. And he called him Mr. Market. And your job is really simple. Just ignore his crazy mood swings. You don't have to trade with him. You only do business when his emotional state gives you a clear, obvious advantage.
This right here is one of his most famous ideas. In the short term, the market is just a popularity contest. It's a voting machine. But in the long term, all that popularity stuff means nothing. It's a scale, and what it measures is the fundamental weight of a company's actual value. And eventually, reality always wins.
Okay, so how did Graham turn this really deep philosophy into a strategy you could actually use? Well, he created a concrete, unemotional toolkit for hunting down value.
He laid out this whole series of specific, quantifiable tests to just systematically find undervalued companies. Now, hey, don't worry about memorizing all 10 of these right now. The key insight here is the method. He was looking for companies that were cheap compared to their earnings, had low debt, and a solid history. This wasn't about gut feelings or forecasts. It was about having a rigid, unemotional process to find bargains and take human error out of the picture.
He also had this really vivid metaphor for finding value where absolutely no one else was looking. He called it the cigar butt approach. He searched for companies that were ugly and discarded, like a cigar butt someone tossed on the street, but that still had some quantifiable, overlooked worth left in them. One last free puff.
But Graham's influence goes so much further than just checklists and metaphors. His true, lasting legacy is that of a thinker, a man of real character, and maybe most importantly, a teacher.
So, late in his life, after he'd achieved all this incredible success and literally shaped the world of finance, what did this titan hope to accomplish each day?
He told a friend he hoped to do these three things every single day. And that simple goal, it reveals a man of great humor, a boundless intellect, and just an incredible character. It shows a perspective on life that went so much deeper than just money.
And his kindness, it was legendary. When his student Warren Buffett had a son, Graham gifted the new family a movie camera and a projector. And that son was named Howard Graham Buffett, in honor of his father and his teacher.
This quote from Buffett just perfectly captures the depth of their relationship. I mean, for him, Graham wasn't just some employer or a professor. He was a life-changing mentor who shaped his character just as much as he shaped his career. So what's the ultimate takeaway from his life? When we look back, how do we even begin to measure the incredible impact of a man like Benjamin Graham?
Maybe the best summary comes from Buffett himself. Graham's ideas were a gift to all future generations. He planted the trees, the principles, the discipline, the wisdom, that continue to give investors shade and protection from the market's absolute fiercest storms. His legacy isn't just about making money, it's about building a framework for how to think rationally in a world of chaos. Thanks for watching The Explainer.
Welcome to The Explainer. Today, we're unlocking the playbook of a true titan of investing, Philip Fisher. His ideas, well, they totally changed the game. He's the one who taught us to stop chasing cheap bargains and start hunting for those truly exceptional companies. The ones built to last. All right, so here's what's on the docket. We're going to start with Fisher's core philosophy. Then we'll dig into his pretty unique investigation methods. After that, we'll tackle the super rigorous checklist he created for companies, and we'll wrap up with his incredibly disciplined rules for when to buy and when to sell. Okay, so to really get what makes Philip Fisher tick, you first have to understand the world he was pushing back against. See, at the time, the investing world was pretty much split down the middle, dominated by two totally opposite ways of thinking. And this slide, this really nails it. On one side, you've got Benjamin Graham. Think of him as the scientist. He was all about the numbers, just poring over financial statements, trying to find companies that were trading for less than they were worth on paper. A total numbers game. But then, on the other side, you have Fisher, the artist. He looked beyond the balance sheet. He wanted to understand the story, the vision of the management team, and that long-term potential that, numbers just can't tell you. And this just shows you how huge Fisher's influence really was, even if it's kind of flown under the radar sometimes. I mean, Warren Buffett himself, who was a student of Graham, was so blown away by Fisher that after they met, he said he was just as impressed by the man as he was by his ideas. Now, Buffett famously says he's 85% Graham and 15% Fisher, but honestly, a lot of people think it's closer to a 50-50 split. Fisher is really that qualitative soulmate to Buffett's quantitative mind. So how did this artist's philosophy actually work in the real world? Well, for starters, it meant throwing out maybe the most famous investing cliche of all time: buy low, sell high. Fisher's goal was way bigger than that. It was all about finding these truly exceptional businesses and then just holding on. Yeah, he actually had a name for them: bonanza companies. So what's a bonanza company? Well, it's a company with awesome management, a clear path to growing sales way faster than its competitors, and a real lasting edge. And his goal was super simple: find them, buy them, and then just ride out all the market's ups and downs with them. And look, this is such a critical shift in how you think about investing. Fisher's whole point was that the real lasting wealth isn't made by traders who are constantly jumping in and out of stocks. No, it's made by people who find these incredible companies and just have the patience to hold on and let the business do all the heavy lifting for them. Okay, but that's the big question, right? How do you actually find these hidden gems, these bonanza companies? Well, Fisher had this amazing, almost journalistic method that he famously called scuttlebutt. So what exactly is scuttlebutt? Think of it like being a business detective. It means you've got to go way beyond the official annual reports and the financial statements to figure out a company's real strengths and weaknesses. It's all about tapping into that business grapevine, listening to what the people who really know the company best are saying. And he had a whole system for it. It was really methodical. He had this brilliant idea: go to 5 different companies in the same industry and ask each one of them about the other 4. And what he found was that a surprisingly clear and honest picture of the whole industry just appears. You start on the outside, right? You talk to competitors, customers, even ex-employees. And only when you're loaded with all that outside intel do you finally go talk to management to get that last piece of the puzzle. All right, so you've done your scuttlebutt, but the work isn't over yet, not even close. Next, Fisher would put a potential investment through this incredibly tough test, a checklist of 15 critical questions he called his gauntlet. This was his ultimate filter. It was designed to weed out the good companies from the truly outstanding bonanza ones. So he broke this gauntlet down into a few key areas. First up, the business itself. Does it have what it takes for real long-term growth? We're talking about products that will be around for a while, a serious commitment to research and development, and a top-notch sales team that can actually sell the stuff. And, most importantly, he needed to know, can this company make good money and protect those profits? But here's what's so interesting. A great business plan wasn't enough for him. Fisher knew that a business is only as good as its people, so he put a huge focus on the human side of things. He wanted to see great relationships between management and employees, an executive team that wasn't just a bunch of yes men, and this was huge for him, management with absolute integrity, the kind of leaders who weren't afraid to admit when they messed up. And for Fisher, this was a deal breaker. He truly believed that a management team that was ruthless with its own employees could never, ever be trusted to treat its shareholders fairly over the long haul. I mean, if a company treats its workers like they're disposable, that was a giant red flag for him. Okay, so finally, if the business and the people checked out, he'd look under the hood at the actual operations. He'd dig into the real nuts and bolts to see if management truly understood their costs, if they were focused on the long term instead of just chasing a quick buck, and if they were smart about how they funded their growth so they weren't hurting the shareholders they already had. Okay, so let's imagine you've done it. You found a company that passed the scuttlebutt test and made it through that 15-point gauntlet. Now comes the really hard part. Actually sticking to the plan with discipline year after year. Now, Fisher's advice on when to buy was pretty simple, but that doesn't mean it was easy. He was totally against trying to time the market perfectly. He basically said trying to predict the economy was like magic. It wasn't real. Instead, he said the best time to buy is when everyone else is scared, or when a really great company gets hit with some temporary bad news. That's your chance to get in at a fair price. But the most radical part of his whole philosophy was probably his advice on selling. I mean, this goes against pretty much everything you hear from Wall Street. So here's the question. When should you sell a fantastic company that you bought at the right time? And Fisher's answer was, well, it was revolutionary. He said that if you did your homework right in the first place, the best time to sell is almost never. His point was that truly great companies just tend to keep growing over the long run, and you want to be along for that whole ride. In fact, he gave only 3 legitimate reasons to ever sell. Number 1, you were wrong. You admit you made a mistake with your original analysis. 2, the company itself has changed for the worse. Maybe the management has gone downhill, or its best growth days are behind it. And number 3, you find a much, much better opportunity, which he argued almost never happens if you picked a real bonanza company to begin with. And he was just as clear about what not to do. This list is just gold. It's basically a list of all the common traps investors fall into. He said don't chase IPOs, don't get suckered in by a glossy annual report, and definitely don't just follow the crowd. He said that usually leads to mass delusion. He was also a huge critic of having too many stocks, arguing it's way safer to own a few companies you know inside and out than a whole bunch you barely understand. So, as we wrap things up here, Philip Fisher's legacy is this powerful, lasting reminder that investing, it's about so much more than just numbers on a screen or squiggly lines on a chart. It's really about deeply understanding the quality of a business, the integrity of the people running it, and then having the sheer patience and discipline to let a great story unfold over years and years. And that leaves us with a really important question for today's world. In an age of AI traders and algorithms moving at the speed of light, is this kind of old-fashioned, human-centered detective work more valuable now than it has ever been?
When you think about Wall Street, you probably picture this classic showdown, value versus growth. It's always framed like they're 2 totally different philosophies, 2 opposing teams battling it out for the best returns. But is that line between them really so black and white? Well, in this explainer, we're going to tear that whole idea apart.
Okay, so let's start with this great analogy that really sets the stage. On one side, you have value investing. People often describe this as picking up old discarded cigar butts off the street. Yeah, they're cheap, kind of gross, but they might have one last good puff of value left in them. Then on the other side, you've got growth investing. This is like buying a box of fresh, super expensive Cuban cigars. They're premium, they're amazing, and everybody wants one. This simple picture is really the starting point for this whole conversation.
But today, we're going to go way beyond that simple image. First, we'll get the basic definitions down. Then, we're going to challenge that whole divide and see how these 2 styles are, believe it or not, connected. After that, we'll dive right into the hard data. We'll look at the psychological traps that catch so many investors. And finally, we'll see how the master himself, Warren Buffett, changed his own thinking on all of this.
All right, first things first, let's just establish the ground rules. What exactly are we talking about when we say value and growth? So value stocks, think of them as the market's ultimate underdogs. These are often perfectly good companies that have just fallen on some really hard times. You'll usually find them on those lists of stocks hitting new 52-week lows. They look cheap on paper, right? They've got low price-to-earnings or price-to-book ratios, which means you're paying less for what they own or what they earn. The entire bet here is that you're getting in right before a massive comeback.
And then, on the complete other side of the spectrum, you've got growth stocks. These are the popular kids at the party. Everybody's talking about them. Their earnings are exploding, sales are climbing, and their stock prices are just hitting new high after new high. Yeah, they're considered expensive by all the old school metrics, meaning you are paying a huge premium for their earnings today, because what you're really betting on is massive, world-changing success tomorrow.
So, you've got the cheap cigar butts and the expensive Cuban cigars. Two totally different things, right? Case closed? Well, hold on, maybe not. Let's complicate this picture a little bit.
And here it is, the one quote that just changes the whole game, and it's from Warren Buffett himself. He says that these two ideas, value and growth, they aren't opposites at all. They are connected at the hip. Whoa, that completely reframes the whole debate. It makes us ask, wait a minute, how can buying something cheap and buying something that's growing like a weed be part of the exact same calculation?
While the bridge between them is this concept called GARP. It stands for growth at a reasonable price. Let me put it this way. You can find a cheap house on some random street, or you could wait for that once-in-a-lifetime opportunity to buy a mansion on Park Avenue when it happens to go on sale. Both are about finding value. GARP is just focusing on that Park Avenue property, a truly high-quality growing company, but only pulling the trigger when the price actually makes sense.
Okay, enough with the theory and analogies. Let's move into the real world and see how this all plays out in the actual numbers. How do funds that claim to follow these strategies really behave?
This chart really shows you the different personalities of these funds in black and white. First, look at turnover. That's just how often the manager is buying and selling stocks. A typical value fund is pretty patient, only turning over about 71% of its portfolio in a year. The growth fund, it's way more frantic, at 120%. Now look at beta. That's a measure of volatility. Anything under 1 is less volatile than the market. Anything over is more. Value funds are much calmer, with a beta of 0.81. Growth funds, well, they're on a bit of a roller coaster, with a beta of 1.14. One is slow and steady, the other is fast and furious.
And listen, those are just the averages. When you put a die-hard value fund up against a die-hard growth fund, that philosophical gap we've been talking about, it becomes a massive chasm. Just look at this. On the left, you've got Clipper, a pure value fund. Its price-to-earnings ratio is around 18. Fidelity's growth fund is more than double that at over 41. And the beta? The beta tells an even crazier story. Clipper's incredibly stable at 0.37, while Fidelity is just a wild ride at 1.53. And check out where they're placing their bets. Clipper loves boring but reliable stuff like financials and consumer staples. Fidelity is all in on the future, technology and services. I mean, the data's telling a story of two completely different worldviews and two completely different appetites for risk.
So the really crucial point here is that these styles aren't just about spreadsheets and data. They are about human psychology. And each path is lined with its own set of very human, very common traps. The source material gives us this fantastic baseball metaphor to really get our heads around this. A value stock is like a former superstar player who just had a terrible injury-plagued season. You can sign him for cheap, and you're betting he's going to heal up and get back to his old self. A growth stock, on the other hand, is the current superstar who's hitting 300 right now. You're going to have to pay him a massive contract, and you're just betting, hoping he can keep up that elite performance. See, both are risky bets, just for totally different reasons.
Okay, so for the value investor, the biggest trap is definitely buying too early. You see a stock that's gotten beaten down, you think it's a bargain, only to watch it just keep falling. It finds what the pros call a basement below the basement. The other classic mistake, selling too soon. Your cheap stock finally has a great run, it's not a value stock anymore, so you cash out and then you watch in absolute agony as it climbs another 200% without you. And guess what? Growth investors face the exact mirror image of these traps. Their number one fear is buying too late. They see a stock just soaring, they get that FOMO, that fear of missing out, and they jump on the bandwagon right as the music stops. The flip side is selling too late. A hot growth stock is priced for absolute perfection, so if it misses its earnings target by even a few pennies, the market's punishment is swift, it's brutal, and it leaves all the late investors holding the bag.
So how in the world do you navigate all of this? Well, let's wrap this up by looking at how the most successful investor of our time evolved his own approach.
What this timeline shows is that even the greatest investors don't stay the same forever, they evolve. Early in his career, Buffett was a pure cigar butt guy, just like his mentor Ben Graham. But, and this is the key point, as he got massively successful and had billions and billions of dollars to manage, that strategy just stopped working. He was too big to go around hunting for tiny, discarded cigar butts. He was forced to evolve, and he shifted his focus to buying truly great, growing companies, but only at a reasonable price, the exact GARP strategy we talked about earlier.
And that right there brings us to the core takeaway of this whole thing. This isn't about picking team value or team growth. It's about a single fundamental question. What is a company's future worth, and what price are you willing to pay for that future today? That's the one question that connects these two seemingly opposite worlds.
So I'll leave you with this one question to think about your own philosophy. When you look at an investment, what are you fundamentally betting on? Are you betting on a comeback story, or are you betting on a champion to continue their winning streak? Your answer will tell you a whole lot about where you stand on that spectrum between value and growth.
All right, let's dive into the mind of a true legend, Warren Buffett. I mean, how did he become one of the most successful investors in, well, all of history? The secret isn't some single magic trick. It's actually a really powerful philosophy, and it's built on 12 core principles. So today, we're going to break it all down. So here's how we'll do it. First, we'll tackle the whole Buffett mystique and what people think his secret is. Then we'll get to the real core philosophy that connects everything. After that, we'll dig into his 12 principles, broken down into 3 pillars: the mindset, the research, and finally, the actual execution. And of course, we'll wrap it all up with the key takeaways you can use. Okay, first up, the mystique. When you hear the name Warren Buffett, a lot of things probably come to mind, right? There's this whole cloud of ideas about his investment style, his crazy success, and what the big secret really is. Which brings us to the big question right out of the gate. What is really, truly at the heart of his strategy? Is it just one simple rule, some kind of super complex algorithm? Or is it something else entirely? You know, if you ask a bunch of different people about Buffett's strategy, you're going to get a ton of different answers. Some will say, oh, he just picks a few great stocks. Others swear by his buy and hold forever approach. You'll hear all about his famous margin of safety, or his focus on growth, or how he only invests in companies with amazing managers. And here's the thing, they're all kind of right, but they're also all incomplete. Every single one of those is just a piece of a much, much bigger puzzle. So how do all these pieces fit together? Well, that brings us to the core philosophy, the one single idea that makes sense of everything else. This right here is the key that unlocks his entire strategy. And here it is. This is the North Star for his entire philosophy. At his very core, Warren Buffett is not a gambler. He's not betting on long shots and hoping for the best. Instead, his entire process is about systematically finding and investing in what he considers to be almost sure things. Every single principle we're about to talk about points right back to this fundamental idea. And this is absolutely crucial to understand. The primary goal isn't just about making money, it's about not losing it in the first place. Every single principle we're going to cover is basically a tool designed to do one thing and one thing only, to hammer investment risk down to the absolute minimum. All right, let's get into our first pillar and see how this all builds up. Now, this isn't about picking stocks just yet. This is all about preparing your own mind. These are the foundational mindsets, the psychology of the investor that you have to have locked down before you even think about risking a single dollar. So these first 4 principles are all about internal discipline. Don't gamble, well, that's the foundation we just talked about. Be businesslike means you treat investing like you're buying a whole business, not just a lottery ticket. You're analyzing the actual fundamentals, not just what the market mood is that day. And learn from your mistakes and avoid common mistakes. That means you have to be brutally honest with yourself and just commit to always learning. Ultimately, this first pillar is all about controlling yourself, not trying to control the market. Okay, so once your mindset is in the right place, you can finally move on to pillar number 2, the diligent detective. This is the active part. This is where you put on your investigator's hat and you really start digging for clues. And these are the rules for your investigation. Each one is a tactic for reducing risk. Buy what you know keeps you from making bets you don't understand. Do your homework is all about that thorough research to avoid nasty surprises. Buy securities cheaply, that's your main defense against paying too much and getting burned later. And invest in admirable people? Well, that just acknowledges that one of the biggest risks out there is dishonest or just plain incompetent leadership. This is the real detective work. Let's zoom in on that first rule for a second. Buy what you know. Buffett has this brilliant name for it, your circle of competence. This is all about intellectual humility. It's not about being an expert in everything. No way. It's about knowing the exact boundaries of what you do understand and then staying firmly inside them. Bottom line, if you can't explain how a business makes its money and why it's going to keep making money, you have no business owning it, period. So what about that buy cheaply rule? Well, this leads us to probably his most famous concept, the margin of safety. This is your ultimate protection against risk. Here's how it works. You do all your homework to estimate what a company is truly worth, its intrinsic value. Then, you only buy it when the market is offering it to you for significantly less than that value. That gap, that discount, that is your margin of safety. It's the buffer that protects you if your calculations were a little bit off or if, the world just throws a curveball. So, you've got your mindset right, you've done your detective work, now what? Well, that brings us to our final pillar, the patient investor. This is all about how you act and, just as importantly, how you don't act once you're in the market. This is the execution phase. It means being a contrarian, buying when everyone else is scared and prices are low. It means focusing on wonderful companies, the ones with these durable competitive advantages that Buffett calls ineditables. It takes the discipline to buy and hold, so you can let the magic of compounding do its thing over many, many years. And it demands the focus to not over-diversify, to concentrate your money in your absolute best ideas. Yeah, that last point about diversification is so important. Buffett is a huge believer in a rifle approach, not a shotgun approach. Think about it. A shotgun just scatters pellets everywhere, hoping to hit something. That's what extreme diversification is. A rifle, on the other hand, is for making a few carefully aimed, high-confidence shots. It takes deep knowledge for sure, but it focuses your money on your absolute best ideas, those almost sure things we talked about. And that ties right into the whole buy and hold idea. Buffett's philosophy is the complete opposite of that frantic, day trading mentality. He says, don't be a gunslinger. A gunslinger is always buying and selling, reacting to every little piece of news. A real investor, on the other hand, buys a piece of a wonderful business and they intend to hold it for years, maybe even decades, just letting that business grow and compound its value over time. Okay, we've gone through all 12 principles. Now, let's put it all together and boil it down into a simple, really powerful philosophy. See, it really all comes down to these 3 pillars. First, you have to master your own psychology. Get that foundation of discipline and rational thinking in place. Second, you got to do the work. Get rid of the guesswork by doing diligent research. And third, you have to act with incredible patience. You have to think in decades, not days. And this brings us right back to where we started. Every single one of these principles, from the mindset stuff to the research to the execution, it all serves that one unifying goal we talked about at the beginning. They are all just interconnected parts of a system that's designed to transform investing from a speculative gamble into the disciplined ownership of almost sure things. So as we wrap up, I'll leave you with this question to think about. When you look at all these principles, from the circle of competence to the margin of safety to that rifle approach, which single one, if you really applied it, would most fundamentally change your own approach to investing? Thanks for joining us.
When you think about what it takes to become a billionaire, what's the first thing that pops into your head? For most of us, it's probably someone who takes these massive, unbelievable risks, right? A high-stakes player just rolling the dice on the future. But what if I told you that one of the wealthiest, most successful investors on the planet, a man who literally built an empire, absolutely hates to gamble? Yeah, let's get inside the mind of the billionaire who refuses to roll the dice.
And look, that image of the high-stakes gambler is not just in our heads. It's the prevailing myth. Martin Fridson pretty much spelled it out in his book, How to Be a Billionaire. He argues that taking monumental risks is the common thread. He basically says not every billionaire is a total daredevil, but they all had to reject that safe, predictable path. And honestly, it's a powerful idea, and when you look around, you see plenty of examples that seem to prove him right.
I mean, the examples are just everywhere. You've got Kirk Kerkorian, who was a legendary high roller at the craps tables in Vegas. You have Steve Ballmer, who, get this, dropped $46 million on Microsoft stock right after some bad news hit. Then there's Dennis Washington, a guy who repeatedly put his own house up as collateral to get projects done. And of course, the poker players. Carl Icahn, H.L. Hunt, even Bill Gates. These are the exact kind of financial daredevils we're talking about.
But here's where it gets interesting. While all those guys are playing games like poker and craps, games of bluffing, of chance, what's Warren Buffett's game of choice? Bridge. Now, it's still a card game, sure, but it relies so much more on careful calculation, on strategy, on pure skill, way more than just dumb luck. And this isn't just some random hobby. It's the perfect window into his entire way of thinking.
Okay, so here's our game plan for this explainer. First, we're going to tear down that whole daredevil myth. Then, we're going to figure out what a gamble even means in Buffett's world. After that, we'll dive into his famous fat pitch analogy. It's a game changer. We'll also get into the psychology of why so many of us want excitement over certainty. And finally, we're going to boil it all down to a set of no gambling rules that you can actually think about.
All right, first up, redefining the gamble. See, to really get Buffett's strategy, you have to start with the one word his whole philosophy is designed to avoid. We need to redefine what risk actually means to him.
You know, the dictionary definition really says it all. Gambling is staking something of value on an uncertain event. And that word, uncertain, that is everything. Buffett isn't afraid of putting money on the line. He's just completely allergic to uncertainty. He's not against making huge financial moves. He's just against making them, and the outcome is basically a coin flip.
So think about it like this. Let me ask you, is it really gambling to bet someone that George Washington was the first president of the United States? No, of course not. The outcome isn't uncertain at all. It's a fact. There's zero real risk there.
Okay, or how about this one? If you bet that an ice cube you toss into a raging fire is going to melt, are you gambling? Nah, you're just betting on the laws of physics. That outcome is about as guaranteed as it gets.
And that right there, that is the whole key to understanding Buffett. He argues that what people call his big bets aren't gambles at all. To him, they're more like betting on the ice cube. They are wagers on what he calls almost sure things. He does so much research that he basically tries to eliminate the uncertainty, turning what looks like a gamble into a calculated, super high probability outcome.
You know, Buffett himself summed up his entire philosophy perfectly. He said, "I would rather be certain of a good result than hopeful of a great one." It's so simple, but so powerful. He's not chasing the thrill of some massive lottery ticket payoff. He's looking for the quiet confidence that comes from a solid, predictable return. Certainty over hope. Every single time.
So how does this actually work in the real world? Well, it all comes down to his most famous analogy. And it has nothing to do with finance and everything to do with baseball. Specifically, the legendary Hall of Famer Ted Williams.
Buffett absolutely loves telling this story. He points to Ted Williams' book, The Science of Hitting, as pretty much a masterclass in investment discipline. See, Williams didn't just see a strike zone. He saw a grid, a map of probabilities.
So here's what Williams did, and it was pure genius. He mentally chopped up the strike zone into 77 little squares, each the size of a baseball. He knew from tons of practice that if a pitch came right into his sweet spot, his absolute best sell, he could hit .400. That's incredible. But if he swung at a bad pitch, say, low and outside on the corner, his worst sell, his average would crater down to .230. So the rule became dead simple. Just wait for that perfect pitch, what he called the fat pitch, and don't you dare swing at anything else.
And here is the absolute kicker. In baseball, if you let 3 good pitches go by without swinging, you're out, strike 3. But in investing, you can stand at that plate all day, all week, all year. You can watch hundreds, even thousands of pitches or investment opportunities fly by with absolutely no penalty. There are no called strikes. You only have to swing your bat when that one perfect 400 pitch comes floating right down the middle of the plate. It's a massive, massive advantage.
So this brings up a huge question, right? If this strategy is so simple and so effective, why doesn't everybody invest this way? Well, the answer really gets down to psychology and this fundamental battle between wanting excitement and wanting certainty.
There's this fantastic story about a pediatrician who switched careers and became a money manager. And the thing that just blew his mind was that a lot of his clients, they didn't just want profits. They wanted the thrill of it all, the adrenaline, the action. They wanted to get rich or even go broke fast. For them, investing was the entertainment. It was no different than walking into a casino.
And then you just slam that idea right up against Buffett's mindset. He has said he would never, ever trade a good night's sleep for a shot at a few extra percentage points. For him, the goal isn't excitement, it's security, it's peace of mind. He's not willing to risk what he has and needs for something that he doesn't have and doesn't need. It's just a completely different ballgame.
Okay, so let's get practical. How can we actually apply this kind of thinking? Let's try to distill this whole philosophy down into a set of no gambling rules that really guide this whole approach.
All right, here are the core principles. Rule 1, stay inside your circle of competence. Basically, if you can't explain it to a 5-year-old, don't put your money in it. It's why Buffett stayed away from tech for so long. Rule 2, focus on businesses you're pretty sure are going to be around and strong in 20 years. Think Coca-Cola versus some hot new app. One is a lot more predictable. Rule 3, know what you don't know. Be brutally honest about your own blind spots. 4, and this one sounds kind of backward, but concentrating your money in a few great companies you know inside and out can actually be less risky. And finally, the classic. Find a truly wonderful company and then just wait. Wait patiently to buy it when it hits a rough patch and is on sale.
You know, if you need just one final story that perfectly wraps this entire mindset up in a neat little bow, it's got to be this one about a simple golf bet he was offered.
So the setup was super simple. Buffett's at a golf outing with friends, and someone suggests a little side bet. The deal is, everybody throws just $11 into a pot. If anyone makes a hole-in-one over the weekend, they win the whole thing. Sounds like fun, right? Everyone else immediately tossed in their cash.
And what was the prize for this tiny $11 bet? $10,000. I mean, for a guy like Warren Buffett, $11 is literally nothing. The potential payoff was gigantic. It seems like a total no-brainer. An easy, fun little wager among friends.
But Buffett actually thought about it for a second, and he said no, he passed. Why? Because he'd done the math in his head and knew the odds of an average golfer hitting a hole-in-one were way, way worse than the payout being offered. So even for a tiny, insignificant amount of money, if the odds were bad, he just refused to play the game. He wasn't paying for excitement, he was analyzing for certainty.
And really, that leaves all of us with a final, really important question to ask ourselves. The next time you make a financial decision, what are you actually buying? Are you paying for the thrill, the adrenaline rush, the fun story you get to tell about a long shot? Or are you, like Buffett, willing to be patient, ignore the noise, and wait for that one perfect fat pitch, investing only for certainty?
So, what if I told you that one of the biggest fortunes ever made in investing all comes down to a single, simple rule? Well, today, that's exactly what we're digging into. We're going to unpack Warren Buffett's legendary strategy for finding what he calls screaming bargains. And look, this is way more than just picking stocks. It's a whole mindset, a complete philosophy for seeing amazing value where, frankly, most people just don't.
Okay, this right here, this is it. This is the starting point for pretty much everything Buffett does. It's not just about finding a good company. It's about buying it at a fantastic price. You see, for Buffett, that purchase price is your safety net. It's your cushion. If you get that part right, you've basically won half the battle before you've even started.
And this really isn't some complicated Wall Street formula. It's a fundamental shift in how you think. Instead of trying to guess what the market's going to do next, you build your safety right into the investment from day one. This one idea, this simple concept, is the bedrock of everything else we're about to get into.
Right, so that's the million-dollar question, isn't it? How do you tell the difference between a real diamond in the rough and, well, a lump of coal that just looks cheap? How do you find a true screaming bargain without buying a company that's on sale for a very, very bad reason? That is the challenge we're going to tackle right now.
To figure that out, we have to start with Buffett's #1 rule of investing: never lose money. I know, it sounds simple, but it's profound. Before we even dream about the profits, before we get excited about the upside, we first have to understand how he protects against the downside. This is the foundation that makes everything else possible. Now, this slide gets at a classic trap for investors. Let's take a company like U.S. Tobacco back in its heyday. On paper, the numbers looked amazing. It was just printing cash, a textbook screaming bargain. But if you dug a little deeper, you'd see these massive legal storms brewing on the horizon. The numbers were telling you one thing, but the real world was telling you something completely different.
So how does Buffett separate the real deal from the disaster waiting to happen? He uses this incredible concept he learned from his mentor, Benjamin Graham, the margin of safety. The best way to think about it is like building a bridge. You don't design it to just barely hold the weight of traffic, right? No, you engineer it to handle way more, to withstand the absolute worst case scenario. That's your margin of safety for your investments. It's your buffer when things go wrong.
All right, so we've got our shield, our margin of safety firmly in hand. Now it's time to go on offense. This is where we stop avoiding the bad companies and start actively hunting for the great ones. And to do that, we need a compass, a set of really sharp, practical tools to help us find our way.
And the first point on our compass is return on equity, or ROE. Buffett sees this as the ultimate report card for a management team. It answers one simple but absolutely critical question. For every single dollar the owners have put into this business, how much profit is the management team squeezing out? It's a direct grade on how well they're doing their job.
But what's a good ROE, really? What's the number that separates the average players from the all-stars in Buffett's world?
The magic number he looks for is an ROE that's consistently over 20%. Now, why is that so important? Well, because a company that can consistently pull that off usually has a secret weapon, a huge competitive advantage, what Buffett famously calls an economic moat. It means they have a business that can keep competitors at bay and just keep generating incredible profits for its owners.
Okay, but a great company isn't just making money today. It's growing its profits over time, consistently. You see, for Buffett, a business that's standing still, no matter how profitable it is right now, is a business that's eventually going to be in trouble. He's looking for a powerful, clear, upward trajectory.
So, what kind of growth are we talking about here? What's the number that tells Buffett this company isn't just doing okay, it's a true wealth compounding machine?
And the number he looks for is 15% annual growth. You might think, wow, that's high. But think about it. That return has to pay the tax man, it has to beat inflation just to stand still, and it has to pay you for taking a risk in the first place. That's the kind of growth that really builds serious wealth over time.
Okay, so we've checked the quality of the business, we've checked its growth, now we have to come back to the price. And this is the absolute heart of Buffett's entire philosophy. Understanding the massive difference between the price you see on your screen and the actual true value of the business.
And this slide just lays it out perfectly. On the right, you've got the market price. This thing jumps around all day long based on fear, greed, the news, you name it. Buffett pretty much tunes that out. What he's looking at is on the left, book value. That's the real stuff, the tangible net worth of the company. He wants to see that number steadily climbing, year after year, as a sign of true wealth being created.
Next up, we have to check the company's financial health, and specifically its debt. Buffett has this great line. He says, if you're smart, you don't need to borrow much, and if you're dumb, you've got no business borrowing in the first place. He is super cautious about companies that use a lot of debt, and the debt-to-equity ratio is his go-to checkup.
So what's a safe number? Well, a good rule of thumb is a debt-to-equity ratio of 50% or less. If you start seeing numbers much higher than that, it's a bit of a red flag that the company might be taking on a level of risk that would make Buffett really uncomfortable.
Okay, we've now made it to the absolute peak of the mountain. If all the other numbers were the landmarks on our map, understanding intrinsic value, well, that's finding the X that marks the treasure. This is the whole point of the journey.
Let's just use Buffett's own words here. Now, discounted value sounds complicated, but the idea is actually super simple. The true value of any business is just all the cash it's going to produce for the rest of its life. But here's the key. A dollar you get 10 years from now isn't worth the same as a dollar in your pocket today, right? So we have to discount all that future cash to figure out what it's worth right now. That's it.
And it really just breaks down into these three logical steps. First, you have to try and estimate all the cash the business is going to kick off in the future. Second, you pick a reasonable interest rate to measure it against. And third, you do the maths to bring all that future money back to what it's worth today. That final number, that's your intrinsic value.
And this table right here, this shows you why that 15% growth rate is just so incredibly powerful. Just look at what happens to a single dollar compounding at that rate. After 50 years, it turns into over $1,000. This is the mind-blowing power of long-term compounding. And this is why Buffett is happy to pay what might seem like a high price for a truly great growing business. He knows that over time, that growth will create unbelievable value.
So, we've gone through the science of it all, the hard numbers, the ratios, the analysis. But as we start to wrap up, it's so important to remember that this is only half the picture. Because as Buffett himself will tell you over and over again, investing is just as much an art as it is a science.
So here it is. This is your treasure map, a simple checklist of all the key signposts we've talked about today.
This is the science part of the equation. It's the framework that can help you spot a company with the DNA of a truly fantastic investment.
This framework, this is your map to navigate the investing world. But, the numbers can only get you so far. The real question is, do you have the patience, the discipline, and the guts to actually follow that map and find the treasure? The journey is all yours.
Welcome to The Explainer. In the crazy, complex world of investing, it turns out one of the most powerful strategies ever is also, surprisingly simple. It comes from the man himself, Warren Buffett, and it boils down to this: buy what you know. So today, we're going to unpack that exact mental model. We'll see how it built a literal fortune and, maybe more importantly, how you can use it to think smarter about your own investments. All right, so here's our game plan for today. We're going to start with the core concept, what Buffett calls the circle of competence. Then we'll look at a real-life masterclass in contrarian investing. After that, we'll tackle the versatility trap, why this is so hard to do in practice. We'll also cover the wisdom of saying no. And finally, we'll wrap up with how you can start cultivating your garden. Sound good? Let's get into it. Okay, first up, the circle of competence. This is really the foundation for success. At the absolute core of Buffett's entire philosophy is this one single, incredibly powerful idea. So what is it? Well, it's pretty straightforward, but don't let the simplicity fool you. It's the principle of investing only in companies and industries that you're especially knowledgeable about. It's about sticking to what you genuinely understand. And here's the kicker. Buffett says the most important thing isn't how big your circle is. It's about knowing exactly where the edge of that circle is. You have to be brutally honest about its boundaries. And Buffett has this great way of making it real for all of us, using these simple analogies. Think about it. You wouldn't just go out and buy a house without knowing everything about the neighborhood, right? The taxes, the schools, the whole deal. Or would you sit down at a high-stakes poker game without mastering the rules and having a strategy? Of course not. So Buffett's question is, why on earth would you treat your life savings any differently? And see, this is where it gets really interesting. This kind of specialized knowledge, it does more than just help you pick the right stocks. It gives you something way more valuable: psychological courage. It's that inner confidence that lets you be the one to buy when everyone else is panic selling. It's what allows you to step back and be skeptical when the whole market seems to be going crazy with irrational exuberance. It's a huge, huge advantage. Okay, so let's move on to our next section, a contrarian's masterclass featuring the Wells Fargo story. This is where we see the principle in action. It's one thing to talk about a theory, but it's another to see it tested under fire in a really high-stakes situation. All right, let's set the scene. We're in the early 1990s. The U.S. is in the middle of a massive savings and loan crisis. Banking stocks are just getting absolutely hammered. The market is in turmoil, fear is everywhere, and for anyone in the banking sector, it really felt like the sky was falling. Now, for the average person trying to figure out what to do, the situation was just confusing. You had two respected analysts looking at the exact same stock, Wells Fargo, and coming to completely opposite conclusions. One is fiercely negative, basically predicting doom. The other is super optimistic, seeing this bright future ahead. So, who do you believe? What do you do? But here's where Buffett's circle of competence gave him a massive edge. As an expert in the banking industry, he was able to see what others were missing. He tuned out all the noise and looked at the fundamentals. He knew, for instance, that Wells Fargo's management had been incredibly disciplined and had resisted making the same risky foreign loans that were sinking their competitors. He also saw they were sitting on huge cash reserves. He recognized that Wells Fargo wasn't just another domino waiting to fall, it was the exception to the rule. So what was the result? Well, all that specialized knowledge gave him the conviction he needed to make a huge contrarian bet. While literally everyone else was running for the exits, selling off their shares in a panic, Buffett calmly walked in and started buying up a significant stake. That, right there, is the circle of competence in action. It's powerful stuff. Okay, moving on to our third section, the versatility trap, or why this whole thing is way harder than it looks. It sounds so simple, right? So effective. So why doesn't everyone do it? Why do so many of us, again and again, end up putting our money into things we just don't truly understand? So really, why do we stray from our areas of expertise? Well, the answer, it has almost nothing to do with investment logic. It's all about our own psychology. It's about these powerful social pressures that are constantly at play. It turns out, more often than not, we are our own worst enemy. Just think about it for a second. Our society celebrates the Renaissance man ideal, right? That person who seems to know a little bit about everything, from fine wine to baseball stats to the latest tech craze. There's this subtle, constant pressure to be versatile, to have an opinion on everything. If you specialize in just one thing, you can feel kind of, well, like a nerd. It can feel really limiting. And this quote just illustrates the power of unapologetic specialization so perfectly. The famous operatic tenor U.C. Bjorling was once criticized for being a bit wooden on stage, and his response wasn't to take acting classes. It was simply, I am a singer, not an actor. He knew exactly what his circle of competence was, his incredible voice, and he refused to let anything distract him from that core strength. It's a masterclass in focus. All right, our next section is about something just as important, the wisdom of saying no. This is all about Buffett's incredible disciplined avoidance. Because here's a really key insight. Buffett's strategy is defined just as much by what he doesn't do as by what he does. The real genius, a lot of the time, is in what you avoid. And he is very deliberate about this. He thoughtfully stays out of entire categories of investments where he just doesn't feel he has a distinct, durable advantage. So for most of his legendary career, that has meant no foreign stocks, no commodity-type companies, and of course, most famously, no tech stocks. And this quote from Buffett himself really gets to the heart of it. He says, if we have a strength, it is in recognizing when we are operating within our circle of competence and when we are approaching the perimeter. I mean, that is just profound self-awareness, right? He's saying his greatest strength isn't just knowing about insurance companies. It's knowing the exact line where his knowledge ends and pure guesswork begins. He just refuses that temptation to get restless and start hoping instead of thinking rationally. And you can see this perfectly during the dot-com bubble in the late 90s. While everyone was going nuts for tech stocks, Buffett famously sat on the sidelines. He later said he was savagely abused for it, that people thought he was just an old man who didn't get it. But his explanation was simple and honest. He said, we have no insights into which participants in the tech field possess a truly durable competitive advantage. In other words, he admitted he couldn't predict the winners, so he refused to gamble. Simple as that. It all kind of boils down to this old saying, one that Buffett loves to quote, fools rush in where angels fear to trade. It just perfectly captures his discipline, doesn't it? It's that constant reminder that when the crowd goes hysterical, when everyone's piling into the latest hot trend, sometimes the smartest thing you can do is just stay calm, stick to what you know, and let the stampede run right past you. Okay, so for our final section, let's bring this all home. Cultivating your garden, building your own circle. The big question is, how do we take this amazing philosophy from one of the world's greatest investors and actually make it practical for us? How do we turn this billion-dollar idea into something we can use for our own portfolios? Well, the strategy is actually really sensible and something you can start doing today. First, when it comes to picking your own individual stocks, you need to specialize. Figure out what you're good at or what you want to be good at. Maybe it's the industry you work in or a hobby you're obsessed with, something you're willing to really study. And then for everything else, for all those areas you're not an expert in, you just diversify using something like low-cost mutual funds. It's the best of both worlds. You see, the goal here isn't to cover the entire waterfront. You don't have to know everything. This approach completely frees you from that pressure. Instead, your focus shifts to deeply and truly understanding just a few things that matter, a few things that can actually make a difference. You're not trying to conquer the whole investing universe. You're just carefully tending to your own small, prosperous garden that you know inside and out. And so that really leaves us with the most important question of the day, and it's one that only you can answer. I want you to really think about this. Take an honest look at your job, your hobbies, your passions, your knowledge. What's inside your circle of competence? Because honestly, just figuring that out, that's the real first step to becoming a smarter, more rational, and hopefully a much more successful investor.
Welcome to The Explainer. Have you ever wondered what legendary investors actually do before they pull the trigger on a stock? Well, spoiler alert, it's not about some crazy complex algorithm. It's about doing your homework. Today, we're going to break down their whole investigative process into a toolkit you can actually use to invest with some real confidence.
So let's kick things off with this powerful idea from over 100 years ago that honestly feels like it could have been written yesterday.
Albert W. Atwood nailed this huge mistake we all tend to make, this built-in belief that the really good opportunities are always somewhere else. You know, the hot new thing in another country, instead of the solid, boring business right down the street.
And that brings us right to our first big pitfall, what we're calling the lure of the distant. It's like this magnetic pull from some exciting story stock you hear about, and it makes you totally blind to the businesses you can actually see and understand in your own neighborhood.
It's just human nature. Like Atwood said, we get all dazzled by the flashy new thing from far away, and we just walk right past the solid, understandable businesses in our own town. But in investing, choosing that glamour over what you actually know, well, that's a recipe for disaster. Your biggest advantage is your knowledge, and a lot of the time, that knowledge is found closest to home.
Okay, so let's bring in the absolute master of this on-the-ground research, Warren Buffett. And he's a fascinating character because he's this total paradox. On the one hand, he can make these massive decisions in the blink of an eye, but on the other, his whole philosophy is built on slow, methodical, patient work. So how can both of those things be true at the same time?
Well, you've got stories like See's Candy back in '71. He gets a call, glances at the numbers for just a few minutes, and boom, he's ready to make a $25 million offer. That's the quick draw. But, and this is the key, that speed is only possible because of his default mode, the meticulous detective. This is the gumshoe investor who puts on his trench coat, gets out in the field, and does the real unglamorous legwork.
And that's the million-dollar question, isn't it? What does it actually mean to be an investment detective? What kind of work are we talking about here? Let me tell you, it has a lot less to do with complicated spreadsheets and a lot more to do with good old-fashioned investigation.
All right, let's get into the good stuff. We're going to crack open some of Buffett's most famous case files to see what this sleuthing actually looks like. And you'll see there's a clear pattern here, a pattern of gathering intelligence on the ground that gave him an edge no one else had.
So our first case takes us all the way back to his student days at Columbia. Turns out his mentor, the one and only Ben Graham, was the chairman of this little insurance company called Geico. That connection was all it took to spark Buffett's curiosity.
Now, this story is just incredible. It shows his hustle, right? It was a Saturday. He hops on a train, gets to the office, and of course it's locked. And he just keeps knocking on the door until a janitor shows up. That sheer will gets him a 4-hour one-on-one meeting with the company's financial VP. For 4 straight hours, he just peppered the guy with questions, digging deep into the business model.
And here's where it gets real. That one conversation gave him so much conviction that he invested about 10 grand, which was pretty much his entire net worth at the time. He didn't just understand the business, he bet the farm on it. And that field work, that hustle, laid the foundation for one of the greatest investments of all time. I mean, Berkshire Hathaway owns all of Geico now. Okay, this next one is really interesting. It's a tale of 2 warnings. Buffett goes to the same local expert in Omaha, a guy who owned a men's clothing shop, to ask about 2 different companies, and he gets 2 very, very different results.
This is such a great comparison. In one case, the expert tells him to stay away from a hat company because, well, men just weren't wearing hats anymore. Buffett listens, and he dodges a bullet. But then, with the suit liner company, the original Berkshire Hathaway, the expert gives him the same kind of dire warning. And this time, Buffett ignores him and ends up buying into a business that was a huge struggle for years. So what's the lesson? It's not that the expert is always right. The lesson is that you have to do the research. Getting that on-the-ground intel is a critical piece of the puzzle, even if you decide to go against it.
Now, this gumshoe method, it really shines when everyone else is panicking. Back in the 60s, this thing called the salad oil scandal hit the markets, and everybody freaked out, thinking American Express was going to go bankrupt. But Buffett? He didn't read the headlines. He hit the streets of Omaha to find out what was really going on. So while all of Wall Street is losing its mind, Buffett goes to a local steakhouse to see how people are paying for dinner. He pops into banks and travel agencies. He talks to local merchants. And what does he find? People were still using their Amex cards. The travelers' checks were still good. The brand's power with its actual customers was totally fine. This boots-on-the-ground work gave him the confidence to start buying up shares like crazy while everyone else was running for the hills. Look, the most important thing to get here is that this gumshoe approach, it isn't some kind of Buffett magic. It's not a superpower. It's a repeatable strategy, a way of thinking that tons of the world's best investors have used in their own ways.
For example, Tom Bailey of Janus Funds would literally send his analysts into supermarkets just to watch what people were putting in their shopping carts.
And then you have Beth Tarana from Fidelity, an absolute legend. She famously passed on investing in a company because the CEO sat through her entire 2-hour meeting. Her thinking? A good CEO has better things to do than sit with an analyst for 2 hours. I mean, that's the kind of real-world clue you will never, ever find on a spreadsheet.
Okay, so this all sounds great for the pros, right? But what about you? How can an individual investor actually apply these same ideas? How do you build your own investigative toolkit?
Well, here's a simple 5-step framework. Yeah, you gotta start by reading the reports. The 10K is a must. But please, don't stop there. Go talk to people. Try the product for yourself. If it's a store, go visit it. See what it looks like. And finally, go check out the competition. This process changes you from just being a passive spectator into an active investigator of your own investments. Analyst Lee Spire just nails the whole spirit of this. Every single month, she'd go to computer stores and just ask the clerks these simple questions. The answers she got gave her a real-time feel for the industry that you're never going to find in some delayed quarterly report. It just proves that sometimes the best research is just asking simple questions to the right people.
Okay, let's wrap this all up with one simple but really powerful analogy that just makes this whole thing click. It's an idea that might completely change how you think about buying a stock ever again.
Just think about it for a second. For what's probably going to be the biggest purchase of your life, would you just look at a couple of pictures online and then click a buy button? No way, right? Of course not. So what would you do?
You'd do a ton of homework, you'd compare houses, you'd inspect every single corner, you'd definitely check the basement. You'd talk to the owners, you'd quiz the neighbors, you'd hire a professional inspector to find all the hidden problems, you'd negotiate on the price, and you'd buy it thinking you're going to live there for years. It's a serious investigative process.
And that's it. That is the absolute heart of the gumshoe philosophy. Treat buying a stock, which is just buying a small piece of a business, with the exact same level of common sense and hard work you would use to buy a house. Simple as that.
So we'll leave you with this one last question to chew on. When you look at the companies in your own portfolio, did you do the homework? Did you kick the tires and check the basement? Or did you just get swept up in a good story? It's a question worth asking.
You know, if you've ever looked at the stock market and just thought, there's got to be a way to do better than average, well, you are definitely not alone. The truth is, most investors, and yeah, even the pros, really struggle to outperform the big indexes. But what if the secret wasn't about following all the trends? What if it was about actively betting against them? So let's open up the Mavericks playbook and explore how to not just think differently, but actually profit from it.
All right, here's what we're going to cover. First, we'll dig into the big problem every investor runs into. Then, we'll unpack the contrarian secret weapon, see it in action with some amazing real-world examples, and then figure out the kind of personality it takes. And finally, we'll talk about that fine line between the confidence that can build a fortune and the conventional thinking that holds most people back.
So, let's just set the stage here. For most people, just matching the market by buying a simple index fund, that's a totally fine strategy. It works. But for anyone who wants to get those truly exceptional, mind-blowing results, the path is, well, it's a lot harder. So the real question is, how do you actually break away from the pack?
And that is the billion-dollar question, isn't it? If doing exactly what everyone else is doing only gets you average results, then simple logic tells you you have to do something different. But what does different really truly look like when you're talking about your money?
Well, there are a few established paths people try to take. You could try timing the market, jumping in and out of stocks, which, by the way, is notoriously difficult. Or you could be a classic value investor, digging around for bargains the market is just totally overlooked. You might chase a growth strategy, betting big on the next superstar company. Or you can focus on yourself, mastering your own psychology to avoid those classic blunders. These are all perfectly valid approaches, but there's a fifth way, a more radical way that's behind some of the greatest investment stories ever told.
And that brings us right to the heart of it all, the contrarian philosophy. Now, this isn't just another strategy, it's a complete shift in your mindset. It's about seeing where the herd is running and then deliberately, calmly walking in the exact opposite direction.
So what is it really? At its core, contrarian investing is all about capitalizing on those moments when the vast majority of people get it completely wrong. They panic, they jump to the wrong conclusion, they misread the tea leaves, and in that one moment of collective error, a huge opportunity is created for the one investor who can see things clearly. And Warren Buffett just summed up this entire philosophy in this one brilliant sentence. It sounds so simple, right? Be greedy when others are fearful. But stop and think about what that actually means in practice. It means buying when everyone you know is panic selling. It means selling when everyone else is euphoric and feels like they can't lose. It is the ultimate act of emotional discipline.
But here's the thing, and this is important. The crowd isn't wrong that often. These moments of mass delusion, they're incredibly rare. And that's why Buffett and his partner Charlie Munger call them fat pitches. It's like in baseball. You can't be a contrarian every single day swinging at every pitch. You have to have the patience to stand there and wait, sometimes for years, for that one perfect, mispriced opportunity to come floating right over the plate.
So, if these opportunities are so few and far between, where do you even find them? Or maybe the better question is, where don't you find them? Well, according to investor James Gibson, you're not going to find them at cocktail parties. Think about it. If everyone you meet is bragging about the killing they're making in some tech stock or crypto, that's your signal that the party is almost over. The real opportunity is in the stuff nobody's talking about. Or even better, the stuff they're actively making fun of.
Okay, the theory is pretty compelling, I get it. But let's see how this stuff actually plays out in the real world. We are going to open up some absolutely fascinating case files where betting against the crowd paid off in a huge way.
So first up, the Tylenol crisis back in 1982. This was a nightmare. Someone tampered with the bottles, people tragically died, and absolute panic gripped the entire country. Johnson & Johnson stock just plummeted. Investors were so sure the brand was finished, they fled for the exits. The contrarian move here wasn't even about buying more. It was simply having the guts to hold on, believing in the company's deep-rooted strength. And in the end, they were proven right.
Case number 2. The early 90s. The Clinton administration was getting ready for a massive overhaul of the U.S. healthcare system. The market got completely spooked. Investors just dumped their pharmaceutical and healthcare stocks like they were toxic. But the contrarian recognized the immense entrenched power of that industry and just held firm, resisting the powerful political story that was causing all the panic.
And this brings us to one of the most legendary examples of all time. Just look at this timeline for the insurance company Geico. In just 2 years, the stock goes from $42 a share to under $5. The company was literally on the brink of bankruptcy. To pretty much everyone on Earth, it looked like a dead company walking. And that is the exact moment that Warren Buffett started buying millions and millions of dollars worth of its stock.
And this quote just brilliantly illustrates how bizarre, how crazy that decision looked from the outside. The author of our source material, he was actually a Geico customer back then and got a letter saying the company was pulling out of his state. So imagine his surprise, seeing this famous investor pouring money into what looked like a sinking ship. In his own words, it was very, very strange. But of course, Buffett saw what nobody else did. A great business that was just temporarily crippled by problems he knew were fixable.
These stories are just incredible, right? But they really beg the question, what kind of person does this? What is the psychological makeup of someone who can stay totally calm when everyone else is running for the hills and be deeply skeptical when everyone else is celebrating? Let's break down the contrarian personality.
This, right here, lays out the fundamental divide just perfectly. Where the herd sees a crisis and a reason to panic, the contrarian sees an opportunity, like a Black Friday sale on Wall Street. Where the herd looks for the comfort of what everyone else is doing, for consensus, the contrarian relies only on their own independent analysis. They ask, what do the facts actually say?
And that gets to the absolute core of the contrarian mindset. It's a deeply ingrained skepticism. They don't just accept what they're told. They question everything, especially ideas that are super popular. And they have to be comfortable, truly comfortable, being the lone voice of dissent, ready to break away from the crowd at any moment.
But let's be crystal clear about something. This is not an easy or pleasant feeling at all. Going against our natural human instinct for social proof it's emotionally taxing. It's draining. One contrarian manager even admitted that when he makes his very best purchases, he has a queasy, sick feeling in his stomach. He says he literally has to hold his nose and force himself to click the buy button. It's a constant battle between your brain and your gut.
Okay, this brings us to a final and absolutely critical point. To do all of this, you need incredible self-confidence. But there is a razor-thin line between the confidence you need to be a great contrarian and the overconfidence that just leads to disaster.
As James Gibson warns us, an insecure investor is just going to follow the crowd, no question. But an overconfident one, especially after they've had a few wins, they're liable to think they can do no wrong, that they're invincible, and that's dangerous. The truly great investor always runs a little scared, They're constantly questioning their own beliefs and trying to find the flaw in their own logic.
And once again, Buffett gives us the perfect model for this balance. He's famously modest, right? He's constantly talking about what he doesn't understand, the mistakes he's made. But on those rare occasions when he's done all the homework and is absolutely 100% sure of his analysis, he is bursting with confidence. And he bets big. It's the ultimate combination of humility and conviction.
And this all boils down to one of the most powerful ideas from our source material. So often we think that doing what everyone else is doing is the conservative, or, the safe choice. But Buffett argues that it's not conservative, it's just conventional. The truly conservative action might be to do something that looks completely radical to everyone else, because your analysis shows it's actually the least risky path forward.
And this final quote, man, it just says it all, doesn't it? For the true contrarian, the opinions of other people are simply noise. It doesn't matter if important people agree with you. It doesn't matter if they disagree with you. The only thing that matters, in the end, is the quality of your own research and the courage of your convictions. It's the purest form of independent thought you can imagine.
So, as we wrap this up, here's the challenge. Following the herd feels safe. It's comfortable. It's conventional. So the question isn't just, are you brave enough to ignore it, but what incredible opportunities might you be missing out on simply because you aren't?
When most people think of Warren Buffett, they think of value investing. But here's the thing. His real secret sauce isn't just about snatching up cheap stocks. It's about finding wonderful companies at a fair price, and then just holding on for the ride. So how on earth does he spot these gems, especially when they're often hiding in plain sight? Well, that's exactly what we're going to break down today. First up, we're going to get into Buffett's #1 golden rule. Then we'll see how it plays out in the real world with 4 legendary investments: Geico, The Washington Post, Coca-Cola, and American Express. And to wrap it all up, we'll give you a checklist you can use to start spotting these wonderful companies yourself. So, what is this golden rule? What's the one thing he's always looking for? It all boils down to this one absolutely brilliant and simple idea that guides pretty much his entire philosophy: the economic moat. An economic moat is basically a company's durable competitive advantage. It's the thing that protects its profits from being chipped away by rivals. The way to think about it is this: the business is a castle. The moat is what defends it. The wider and deeper and more crocodile-infested that moat is, the safer the castle is from attack. This, right here, is the single most important quality Buffett hunts for. Okay, our first case study, Geico, is just the perfect example of this. It's about finding a truly wonderful company when it's disguised as an absolute train wreck. Seriously, everyone else saw a sinking ship, but Buffett saw an unsinkable fortress. So, back in the mid-70s, Geico was in a total freefall. I mean, the company was knocking on bankruptcy's door. It was posting huge losses because management had made a terrible mistake. They started insuring way too many high-risk drivers. To make things worse, its sales were a whopping 16 times its equity, which is just a classic sign of a company that is way, way over its skis. On paper, this thing looked like a 5-alarm fire. But Buffett, he looked right through all that short-term chaos, and he saw the moat. You see, unlike its competitors who all sold insurance through agents, Geico sold directly to customers. This meant they could cut out the middleman and offer much lower prices. And here's the genius part. The other guys couldn't just copy the model. If they tried, they'd take off their entire network of agents, basically destroying their own business. Geico had this amazing structural advantage that was incredibly hard to attack. So, because the whole world was panicking, Buffett was able to swoop in and start buying up shares for an average price of just $3.18. Think about that. He was buying a fantastic business model at a ridiculous fire sale price. He was betting that new management could fix the temporary problems because he knew that deep down the long-term moat was still perfectly intact. And wow, what a bet that turned out to be. Fast forward 20 years, Geico gets its act together, its brilliant business model just keeps chugging along, and Berkshire Hathaway ends up buying the rest of the company. The price they paid, $350 a share. The end result? His investment grew at an unbelievable 27.2% per year for 2 straight decades. That just crushes the market average. The takeaway here is crystal clear. A temporary crisis hitting a company that has a truly durable moat can create the investment opportunity of a lifetime. All right, next up, The Washington Post. Now, if Geico was all about a unique business model,
The Post shows us a totally different kind of moat, a classic, old-school, fortress-like dominant market position.
Buffett's thinking here was so simple, it was brilliant. See, back in the 1970s, if you were the main newspaper in a big city, you basically had a local monopoly. It's the paper everyone was used to, the one they trusted, and if you were an advertiser, you had to be in that paper. It was the information toll booth for the entire community. And you can just see the raw power of that moat right here in the numbers. Over a 26-year period, earnings per share grew at more than 15% a year. But look at the stock price. It compounded at a jaw-dropping 22% annually. That's the kind of predictable, long-term growth an unbeatable moat can deliver. For our third case, let's talk about Coca-Cola. This reveals yet another kind of moat. This one isn't about a clever business model or a local monopoly. No, this one's about something you can't even touch. It's a global brand that lives inside the minds of billions of people. Now, this investment really threw people for a loop at the time. If you looked at the traditional numbers, Coke actually looked expensive. Buffett paid over 15 times its earnings, which is not what you'd expect from a so-called value guy. The big question on Wall Street was, has Buffett finally lost his touch? Did he overpay? But Buffett wasn't just buying a year's worth of earnings. He was buying certainty. And this quote, well, it says it all, doesn't it? He believed the Coca-Cola brand was so powerful, so deeply woven into the fabric of global culture that you couldn't kill it, even if you had $100 billion. You couldn't replicate it. I mean, that is the very definition of an unbreachable moat. And the sheer scale was just mind-bending. At that time, Coke was responsible for nearly half of all soft drinks consumed on the entire planet. That kind of dominance, built up over a century of advertising and habit, meant that Coke could just keep growing and growing for years and years to come, which more than justified what looked like a high price tag.
Okay, for our final case study, let's dig into American Express. Now, this moat is different all over again. It's not just about being the cheapest or having a monopoly or even a brand. It's about a powerful, self-reinforcing network that literally gets stronger and more valuable with every single person who joins it. And just like we saw with Geico, the opportunity to buy came from a crisis. But this one was just bizarre. A subsidiary of Amex got caught up in what became known as the salad oil scandal. A client was using warehouse receipts for giant tanks of vegetable oil to get loans. The only problem? The tanks were mostly filled with seawater. You can't make this stuff up. Amex wasn't even at fault, but to protect its good name, it took a huge financial loss, and the stock got absolutely hammered. So what did Buffett do? He did what he does best. He completely ignored the screaming headlines and just did the homework. He asked one simple, crucial question. Okay, despite this crazy scandal, is the core business, the card, still strong? He and his partners went out and actually talked to customers, to restaurant owners, to competitors, to really understand how the whole system worked. And what their investigation found was the linchpin of the entire business, the corporate card. See, businesses depended on Amex for their employee expense accounts. This basically forced restaurants and hotels to accept the card if they wanted those high-spending business customers. And because all the merchants accepted it, it became essential for individual travelers too. It was this powerful, self-feeding loop. And on top of that, they found all these other little reinforcing parts of the moat. The brand had prestige, a certain cachet, the whole pay your balance in full model was seen as financially responsible, and corporate accounting departments just loved how easy the statements were to process. Each of these things might seem small on its own, but you add them all together, and they created this incredibly powerful network moat that competitors like Visa and MasterCard just couldn't break through. Okay, so what's the big lesson from all of this? What can we take away from these 4 masterclasses in investing? Let's boil it all down into a simple checklist you can use to spot these economic moats out in the wild. So, when you're on the hunt for a truly wonderful company, here are the 4 kinds of moats we've just seen in action. You can look for a unique business model that's hard to copy, just like Geico's, or maybe a dominant market position, like the Post's local monopoly. You should also think about the incredible power of an intangible global brand, like Coca-Cola. And finally, keep an eye out for a self-reinforcing network, like American Express, where being on top just makes you even stronger. Look, the ultimate lesson is this. The truly wonderful companies are protected by these deep, durable moats. And very often, the absolute best time to buy them is when the rest of the world is freaking out about some temporary problem. So the question I want to leave you with is this. What are the great economic castles of today?
And maybe more importantly, can you spot the crisis that might just give you a chance to buy one at a fair price? All right, let's talk about Warren Buffett, but we're not going to talk about PE ratios or market caps today. Nope. We're going to dive into something he thinks is way, way more important. The single biggest factor in any investment he makes: the people. Now, you might hear this and think, oh, that's nice. Work with people you like. But no, no, no. This is not some fluffy feel-good advice. For Buffett, this is a law. It's the absolute foundation of Berkshire Hathaway. It's the first hurdle that every single deal has to clear. So here's how we're going to break this all down. First, we'll cover Buffett's golden rule. Then we'll get into what he calls the owner's mindset. After that, we'll give you a field guide on the signs of great leaders, look at some amazing real-life examples, and then finally, what this all means for you. Okay, let's start at the beginning with this foundational rule. What exactly does Buffett mean when he separates people into good and bad for business? Because you'll see his definition is probably not what you think. Just let that sink in for a second. Never. He's saying it's 100% failure rate. It doesn't matter how amazing the business looks on paper, how incredible the product is, or how cheap the stock is. If the person at the top is wrong, the deal is destined to fail. For him, character isn't just a variable. It's the whole ball game. And here's that specific definition. See? A bad person in Buffett's world isn't about being a criminal. It's about alignment. It's someone who's playing for their own team. Their focus is on their paycheck, their next big job opportunity, their cushy retirement. They're just not obsessed with making the business itself, and by extension, the shareholders, wildly successful. So if a bad manager is focused on themselves, what's the flip side? Well, that brings us to what might be the most important concept in Buffett's entire playbook: the owner's mindset. The key word here? Fanatics. Buffett isn't looking for a well-qualified manager who clocks in and out. He's searching for someone who is completely and utterly obsessed, someone who treats the company's money like it's their own family savings, because in their head, it is. They can't turn it off. And here it is, laid out plain and simple. It's two totally different worlds, right? On the left, you have someone whose entire being is pointed towards making the business better, richer, and stronger for the long haul. And on the right, you've got someone who's just passing through, using the company as a vehicle for their own personal gain. One is a value creator, the other is a value extractor. But here's a crucial reality check. Buffett is no fool. He knows that even the most incredible manager can't save a fundamentally terrible business. It's like putting the world's best jockey on a three-legged horse. You're just not going to win. So his formula always needs two parts. One, an admirable person, and two, a business with at least decent economics. You have to have both. Okay, I know what you're thinking. This all sounds great, but I'm not Warren Buffett. How am I supposed to spot one of these owner-managers in the wild? Well, that's exactly what this next section is about. Let's build ourselves a little checklist. Here we go. 5 tangible things you can actually look for. These aren't just vague feelings. They are real behaviors that you can observe and that signal you're dealing with the right kind of person. This is your toolkit. First up, and this one's huge, they tell it like it is. No sugarcoating, no corporate jargon. They share the bad news just as openly as the good news. They talk to you, the shareholder, like you're a true partner in the business, not just some name on a stock certificate. And of course, Buffett practices what he preaches. This quote is basically the golden rule of investor relations. He's saying, I'm just going to tell you what I would want to know if I were in your shoes. It's that simple and it's that profound. It builds a foundation of absolute trust. Okay, sign number 2, they hate wasting money. And I mean, they hate it. This isn't just about being a little frugal. It's a deep-seated belief that every dollar belongs to the shareholders. So to them, a fancy corporate jet or a ridiculously plush headquarters isn't a perk of the job, it's theft. I love this quote because it's so incredibly true. It shows that the little things matter. I mean, if a manager thinks it's okay to pad their expense report for a fancy meal, what do you think they'll do when it's time to negotiate a multi-million-dollar acquisition? Character reveals itself in the small details. All right, now for the really fun part. Let's look at some of the actual people Buffett considers to be heroes. These are the managers who took the principles we've been talking about and lived them to the absolute extreme. So get that image of the slick, polished Fortune 500 CEO out of your head. That is not who we're talking about here. The people Buffett admires are, well, they're different. They're obsessive, they're often eccentric, and they are completely 100% devoted to their business. I mean, just look at these stories. They sound almost mythical, don't they? Take Thomas Murphy not painting the side of a building people couldn't see. Why waste the money? It creates zero value for the customer or the shareholder. Or Benjamin Rosner literally counting the sheets on a roll of toilet paper. It's not about the money from the toilet paper, it's about the principle. I will not be cheated, not on anything. These little acts reveal a massive, powerful mindset. So, what do we do with all this? After hearing about these legendary figures and powerful principles, how can you and I, as everyday investors, actually put this philosophy to work? Well, the good news is you've got plenty of tools. Start by reading the annual reports. Does the CEO's letter sound like a real human being talking honestly about their challenges, or does it sound like a press release? Watch interviews. Do they light up when they talk about the products and customers, or only when they talk about the stock price? These are the clues you're looking for. And of course, this is not a do as I say, not as I do situation. Buffett lives and breathes this stuff. He takes a tiny salary, his fortune is almost entirely in Berkshire stock, he truly eats his own cooking. He once famously told the public that his own company's new stock was overpriced. I mean, who does that? Only someone whose first loyalty is to the truth and to his partners, the shareholders. So if you're going to take just one thing away from our entire conversation today, let it be this. This is the magic formula. It's not enough to find a great business, and it's not enough to find a great manager. The real wonders, the truly life-changing investments, happen when you get both of them together. I'll leave you with this final thought to chew on. Are you just buying a ticker symbol and a balance sheet? Or are you entering into a long-term partnership with the person running the show? Because if you start thinking about it as a partnership, it changes everything about how you evaluate an opportunity. Thanks for joining me for this explainer. The lesson here is pretty clear, right? The numbers can tell you where a company has been, but it's the character of the leadership that tells you where it's going. So go find the Rose Blumpkins and the Thomas Murphys of today. They're out there.
Hey everyone, and welcome. Today, we're diving into a battle that rages inside every person who's ever bought a stock. It's the investor versus the gunslinger. Two completely different ways of thinking, and as we're about to see, two very different financial destinies. So, which one are you?
And get this isn't some new problem cooked up by the internet age. This quote, it's from 1919. Over 100 years ago, people were already struggling with this exact same thing. That itch for action versus the quiet patience of real investing, it's a timeless human struggle.
All right, so here's how we're going to break it all down. First, we'll really define who the investor and the gunslinger are. Then, we'll get into Warren Buffett's almost radical philosophy of just doing nothing. After that, we'll look at the cold, hard numbers, the real cost of trading too much. We'll even explore why it's so hard to stop. And finally, we'll wrap up with some real wisdom for building that investor mindset for the long haul.
Okay, let's kick things off by meeting our two main characters. You know, this isn't just about picking different stocks. It's about having two totally different realities when you look at the market. And these mindsets, they really do lead to completely different outcomes.
So let's break this down. The absolute key difference is right here at the top. The investor, they truly believe they're buying a small piece of a real business. The gunslinger, nah, they're just playing a ticker symbol that zips across a screen. And that one single difference changes everything. The investor's time horizon becomes forever. Because you don't buy a business to sell it next Tuesday. The gunslinger is impatient, thinking in days or months. The investor is focused on how the business is doing over years, while the gunslinger is just obsessed with the day-to-day price swings.
So speaking of that investor philosophy, there's no better person to talk about than Warren Buffett. And his whole approach is, honestly, so counterintuitive in our fast-paced world. He's built a massive fortune on the power of doing almost nothing.
This is maybe his most famous quote, right? But forever doesn't literally mean he never sells. What it means is that when he buys something, his intention is to hold it for good. He's not making a bet. He's becoming a partner in a great business, and he couldn't care less about the stock's daily mood swings.
And I love this one from his partner Charlie Munger. Lethargy bordering on sloth. I mean, who describes their multi-billion-dollar strategy like that? They see inactivity not as a weakness, but as their greatest strength. In a world screaming, do something, they've gotten rich by being intentionally, powerfully lazy.
So how do they actually pull this off? Well, it's not that complicated. It comes down to a really simple filter. First, they ask the 10-year question. Just asking that one thing forces you out of a speculator mindset. Second, they actively fight what they see as a Wall Street conspiracy, this constant pressure to trade so that other people make money. And third, and this is a big one, they just ignore the noise. All the predictions about interest rates or the economy, they spend basically zero time on it. They just focus on the business.
Okay, the philosophy sounds great, but does it actually hold up in the real world? Let's switch gears now from the ideas to the hard evidence. And honestly, the numbers for the gunslinger's hyperactive approach, they're pretty brutal. Now take a look at this. It comes from a huge study of 60,000 households. The investors who traded the least, the patient ones on the left, earned an incredible 18.5% a year. Now look at the most active traders on the right, just 11.4%. That is a 7 percentage point difference every single year. That might not sound like a lot, but compounded over decades, that gap is the difference between a nice nest egg and life-changing wealth. The data couldn't be clearer. The more you trade, the less you make.
And that's not even the whole picture. All that trading just bleeds money in other ways. You're paying way more in commissions, you're constantly triggering taxes instead of letting your money grow tax-free. But here's the real kicker. From that same study, the new stocks that people bought actually performed worse than the stocks they just sold, by about 5% on average. Just think about that. People were actively trading their way into worse investments. It's wild.
And this number just shows you how much this gunslinger thinking has taken over. By 1999, the average person held a stock for only 8 months. Just 10 years earlier, it was 2 years. And for the exciting tech stocks on the NASDAQ, a measly 5 months. As a whole, we've become incredibly impatient.
So that brings us to the most important question of all. If the evidence is so clear that trading less is better, why on earth can't we stop doing it? Let's really dig into the psychological traps and the systemic pressures that push us in the wrong direction.
I mean, this is the real puzzle, isn't it? It sounds so easy. Buy good businesses and then go to the beach. But in reality, just sitting on your hands is one of the hardest things in the world to do. So what's really going on here?
Well, a lot of it is just how our brains are wired. We are hopelessly overconfident, Something like 80% of drivers think they're above average. It's the same with investing. We think we can outsmart the market. That leads us to extrapolate. We see a stock that's gone up and we assume it'll just keep going. Our gambling instincts get triggered, looking for that thrill. And honestly, we just get bored. We crave novelty, like a kid who's suddenly tired of his perfectly good Pokemon cards because there's a new shiny set out.
But it's not just our own psychology. The entire financial system is basically designed to make us trade. Your broker gets paid when you buy or sell, not when you sit patiently. The financial news channels have 24 hours of airtime to fill, so every tiny market dip is treated like a 5-alarm fire. And for the pros managing billions, being busy gives them the illusion of control. It makes them feel and look like they're earning their huge fees.
Let me tell you a quick story that makes this real. There was a family, the Bleilers, who had a great trip to Disney World and wanted to buy some Disney stock. Makes sense, right? But just 6 months later, their broker called and urged them to sell to lock in their profits. Well, that advice made the broker a nice little commission, but for the Bleilers, it cost them an extra $37,000 they would have had if they just ignored him and held on.
So, what do we do? How do we actually fight back against all these forces, both inside and outside of us? Let's get into our last section here and talk about some practical ways and powerful stories to help build that patient investor mindset. This is one of my favorite investing stories ever. A writer asks a famous investor for a stock tip, and his advice is so simple. Find a company that makes something people use, throw away, and have to buy again. So she thought about her daughters, invested in Tampax, and then did nothing. She just held on. That one simple common sense idea made her a millionaire. It was all about the business, not the stock ticker.
You've probably heard this one before. You can't go broke taking a profit. It sounds so safe and smart, doesn't it? Well, Warren Buffett absolutely hates it. Why? Because it tricks you into doing the exact opposite of what you should. It tells you to sell your best companies, your beautiful flowers, while you hang on to all your losers, your weeds, praying they'll turn around. You get rich by letting your flowers grow into a jungle.
Okay, so here's a really cool practical tip for anyone who suspects they might be a little too trigger happy. Try this experiment. Every time you sell a stock, create a ghost portfolio. Keep track of that stock as if you still owned it. Over time, you can look back and see how your decisions actually played out. It can be a very powerful and sometimes very humbling way to see the true cost of your own activity.
And really, this quote from Buffett just says it all. This is the whole thing in a nutshell. The stock market is basically a giant machine that takes money from the active people and gives it to the patient people. That's it. Your temperament, your ability to sit still is way more important than how smart you are.
Now, to be fair, there are some very sophisticated traders out there who make the gunslinger style work. They focus on fast-growing companies and have incredibly high turnover. But it is a totally different sport. It means you are watching the market constantly and you have to be ready to sell at the absolute first whiff of trouble. It's a full-time, high-stress job, not a strategy for building long-term wealth.
So I want to leave you with this one final question to think about. We live in a world that just worships action, speed, and being busy. But what if, when it comes to your money, your biggest edge, your secret weapon, is simply learning how to do nothing at all? Thanks so much for joining me.
So, when you think of Warren Buffett, what comes to mind? Probably this friendly, grandfatherly figure, right? The Oracle of Omaha, dispensing folksy wisdom. Well, behind that public persona, there's a much more complex character, one who's governed by a really stern, almost cold, business-like philosophy. Today, we're going to pull back that curtain and look at the unsentimental genius who built an absolute empire, one calculated decision at a time.
All right, to really get inside Buffett's head, let's start with a tough question. And I mean, this is a question every single leader has to face. Imagine you're the boss. Who comes first? Your investors, the people who own the company, or your employees, the people whose livelihoods depend on it? It's a brutal choice, right? And it's a dilemma that Buffett has stared down more than once.
And you know what? There is no better example of this dilemma in its rawest form than the story of the company that actually gave his legendary firm its name, the Berkshire Hathaway textile mill. I mean, this is where Buffett's entire philosophy was forged, in the real world, with very real consequences for a lot of people.
So let's dive into this money manager's dilemma. Now, this wasn't just some academic case study for Buffett. No, the textile mill, that was personal. He was actually emotionally invested, which, as you'll see, made the cold, hard business reality that much harder to swallow.
Okay, check out this quote from 1978. It shows a side of Buffett you might not expect. At first, he really leaned into his humanity, you know? He wasn't just looking at the numbers. He was out there praising the mill's importance to the town, the awesome management, the loyal workers. He even went public and promised to keep the mills going, even if it meant making less money than he could somewhere else.
But, well, hope isn't a business strategy, is it? Fast forward to the mid-'80s, and the reality of the situation was just brutal. Those modest returns he was hoping for? Nope. It had turned into a giant money pit, just consuming cash. Foreign competition was completely slaughtering them, and Buffett even admitted it himself. All the other mill owners who were more objective about it, who didn't let feelings get in the way, had already packed it in and closed up shop. So, in the end, despite feeling bad about it, despite that emotional attachment, Buffett made the only choice his philosophy would let him make. He made the businesslike choice. He shut the whole thing down. The owners, the investors, came first. The employees came second. And that one single painful decision, that became the bedrock of everything he would do from then on.
Yeah, this wasn't just a one-time thing. This decision basically created a philosophy that would guide almost every move he made after that. You could call it the Buffett Doctrine.
And what is that doctrine? At its core, it's pretty simple. Be businesslike. Now, that doesn't mean be a monster. He'd say there's room for compassion, for being a decent human being. But your number one job, your primary task, is to make good money for your shareholders. When push comes to shove, they always come first.
And believe me, this was not just some theory he wrote down somewhere. Buffett has applied this credo, which can seem pretty brutal, again and again and again. Let's run through a few examples that really drive the point home.
Okay, first up, the Buffalo News. So their main competitor goes out of business, and the editorial staff, feeling pretty good, asks for a profit-sharing plan. Buffett's response was just incredibly blunt. He basically said, "There's nothing you guys on the third floor can do that actually affects profits." I mean, wow. You and I might think, hey, happy writers make a better paper, but for Buffett, the logic was pure finance. It was a crystal clear message: shareholder value comes before employee rewards. Period.
Then there was Dempster Mill, way back in his early days. He brings in this manager who just starts slashing costs, firing 100 people. And when people criticized him for it, Buffett's defense was cold, hard logic. If he hadn't made those cuts, the entire company would have gone under.
and then everyone would be out of a job, and the investors would have lost everything. It was a painful choice for sure, but in his mind, it was the only choice.
And who could forget the Salomon scandal in the 90s? Buffett steps in as chairman, and he is just disgusted by what he sees. The top execs are taking home these insane bonuses, almost 3/4 of the entire company's profits. So what does he do? While the company is making bank, he goes public and calls them out for being greedy. Then he cuts the bonus pool by $110 million and lays off 80 executives and 200 support staff. See, for him, it wasn't just about making a profit. It was about making sure that profit went to the owners, the shareholders, not just a handful of guys at the top.
This cold-blooded calculation was on full display during the collapse of long-term capital management. I mean, this was a crisis that people thought could take down the whole financial system. And Buffett? He didn't ride in on a white horse to save the day. Oh no. He saw a fire sale, a massive opportunity, and he made what one person called a shockingly lowball offer for their assets. It was pure, unsentimental, bottom-line business. That's vintage Buffett right there.
Okay, so all of that is pretty intense, right? But what's truly mind-blowing is that this philosophy, it doesn't stop at the office. Buffett applies this exact same business-like attitude to his own family.
I mean, listen to these stories. They're just wild. His sister, Doris, she racks up $1.4 million in debt from bad trades. He refuses to bail her out. His own daughter, Susie, asks for a $30,000 loan to redo her kitchen. He tells her to go to a bank, just like anybody else. And my favorite, his son Howie says he wants to be a farmer. So what does Buffett do? He buys him a farm and then rents it back to him at the standard market rate. For Buffett, a deal is a deal, even if it's with your own kid.
So, was he always this rigid? Was there ever a crack in the armor? Well, yes. There was one big exception. One time when Buffett and his partner Charlie Munger let their feelings get in the way of a business deal. And oh boy, does it serve as a cautionary tale.
Okay, so here's what happened. They were fighting a merger with a company called Wesco Financial because they thought the deal was totally unfair to shareholders. And they won. The merger fell apart. But then the stock price tanked. Now, the business-like move, the Buffett move, would be to swoop in and buy up the stock for pennies on the dollar, right? Instead, they decided to pay the old, higher price just to be fair to the folks they've been dealing with. And this one act of being nice guys landed them in a huge mess, a 2-year investigation by the SEC.
And Charlie Munger himself just summed it up perfectly. He called it a quixotic moment, like Don Quixote, idealistic and impractical. He basically admitted they were just acting on a feeling, on what felt like the right way to behave, instead of what made the most business sense.
So what was the result of them trying to be gentlemen for a day? Well, the SEC accused their company of manipulating the stock price to keep it artificially high, and they got slapped with a penalty of $115,000, which they had to pay to their own shareholders, the very people who got hurt because their managers chose to be fair instead of profitable.
It's kind of funny, right? This one exception actually proves the rule. It was the perfect real-world example of what happens when emotion and this idea of fairness get in the way of pure business logic. It can completely backfire and end up hurting the very people you're paid to protect, your shareholders. If anything, this whole mess just hammered home why his doctrine was so important in the first place.
Okay, so what's the big takeaway here? What does all this mean for you and your money? How can we take these lessons from Buffett's incredibly unsentimental philosophy and apply them to our own lives?
There's an old saying on Wall Street that just sums this whole thing up perfectly. A stock doesn't know that you own it. Think about that. We get so attached, right? We bring all this emotion to our investments, loyalty, hope, even pride. But the stock itself, it's just a piece of a business. It's completely indifferent. It doesn't care one bit about your feelings.
So, here are the key lessons from the Buffett doctrine. First, remember your goal is profitability. That's number one. Second, being loyal to a stock just because it did well for you in the past or because you like the company, that's not a reason to hold on to a bad investment. Third, if you want to do good in the world, be charitable. As Buffett does with his billions, just write a check. Don't try to express your humanity through your portfolio. That's a recipe for losing money. And finally, this doesn't mean you have to invest in stuff you think is unethical. You don't have to swing at every pitch. But whatever you do, don't let your emotions make you swing at a bad one.
Look, Warren Buffett drew his line in the sand, very clearly on the side of business-like profit. So the final question really is for you. When you're faced with these kinds of tough decisions, whether it's with money or in life, where do you draw the line?
Have you ever wondered why some of the most successful people in the world are also the most open about their screw-ups? Well, today we're going to dig into the surprising power of admitting you're wrong and how that brutal honesty might just be one of the biggest keys to success. Let's get into it. I love this quote from Warren Buffett because it just nails a huge problem. In the business world, mistakes often just appear out of nowhere. No one's to blame, knows no real investigation. They just kind of happen. But as you're about to see, pretending your mistakes don't exist is one of the most expensive things a person or a company can do. So, here's what we're going to cover. First, we'll unpack that whole virgin birth idea. Then, we're going to dive deep into Warren Buffett's incredible history of public self-criticism. We'll look at the massive cost of not learning from our errors, see how top surgeons think about mistakes, understand the psychology behind it all, and finally, figure out how you can start making mistakes like a master. Okay, so what exactly did Buffett mean by the virgin birth of a corporate blunder? Well, picture this. A company makes a terrible acquisition, losing millions. Instead of owning it, they just bury the loss in a giant line item called restructuring charges. It gets waved off as a one-time thing, and the real reasons for the failure, they never see the light of day. The mistake is born without a father. No one takes ownership. But then you've got a guy like Warren Buffett. And instead of burying his mistakes, he does the exact opposite. He puts a giant spotlight on them, year after year, for the entire world to see. He's built his legacy not just on his incredible wins, but on his absolutely fearless honesty about his losses. So how does he actually do it? Well, every single year in his letter to Berkshire Hathaway shareholders, Buffett includes what you could call his list of failures. He doesn't just mention them in passing. No, he puts them on the operating table, he dissects them, figures out the root cause, and spells out the consequences right there in black and white for everyone to read. And he does it with this amazing self-deprecating humor. When talking about a really bad year for the company, he didn't make excuses. He just said, "You don't need a detective to figure this one out. The guilty party is me, your chairman." I mean, how many CEOs do you know who talk like that? It's just unheard of. Buffett has a famous term for his big financial missteps. He calls them boners. So let's take a quick tour of some of the biggest mistakes he has not only admitted to but has analyzed in public. Now, what's so fascinating here is the depth of his thinking. He didn't just say, "Oops, I overpaid for Dexter shoes." He identified a second, much, much bigger error. He used his own company's incredibly valuable stock to make the purchase. That one decision amplified the financial damage enormously over the years. He owned both layers of the blunder. Here's another classic. This was a mistake of inaction, or maybe acting too soon. He sold shares in a company called Capital Cities, and what happened? The stock just kept climbing right after he sold. Now, most people would just quietly try to forget something like that. Not Buffett. He did the math for everyone to see. And here's what that math looked like. He spelled out the exact cost of his premature sale to his shareholders, over $222 million. He put a price tag on his own mistake. That's a level of transparency that is just almost unheard of. And in what he once called his top honors mistake, he pointed to a huge investment in U.S. Air. Notice what he doesn't do. He doesn't blame the economy or the airline industry or bad luck. He blames himself. He flat out calls it a case of sloppy analysis, even hinting that his own ego might have gotten in the way. Okay, so we've seen how the master does it. But what about the flip side? What happens when you do the opposite? What's the real, tangible cost of not admitting your mistakes and, as a result, never actually learning from them? So first, let's get really clear on what learning even means in this context. It's not just about feeling bad that you messed up. It's an active, three-step process. 1, you have to recognize it was an error, no excuses. 2, you have to analyze why it happened. And 3, you have to make a conscious pledge to yourself to avoid that same pitfall in the future. For the perfect anti-Buffett, we need to talk about a man named Charles Stedman. His investment funds were famous for basically one thing: losing money consistently for over a decade. His story is a powerful cautionary tale about the high price of not learning. See, Stedman was trapped in a destructive loop. He'd fall in love with story stocks, companies with a great narrative but terrible financials. He'd ignore the numbers, lose a ton of money, and then, this is the crucial part, he would do the exact same thing all over again. He never broke the cycle because he never stopped to analyze his own failure. And look, this isn't just about money or investing. This is about being human. To see just how deep this principle runs, let's step away from Wall Street and into a field where mistakes can have life or death consequences: surgery. A sociologist named Charles Bosque was studying young surgeons, and he came up with this brilliant two-question test to find the ones who were destined for greatness. The first question he'd ask was deceptively simple: have you ever made a mistake? But it was the follow-up question that revealed everything. If they said yes, he'd lean in and ask, "So, what was your worst mistake?" And their answers were incredibly telling. The worst candidates would immediately get defensive. They'd say something like, "I haven't really had one," or they'd blame the equipment or another team member, something outside their control. But the best candidates, they answered right away with specific, painful detail. They'd say, "Oh God, I make mistakes all the time. Let me tell you about this horrible thing that happened yesterday." They saw their errors not as a mark of shame, but as their most important teacher. So what is it? What allows someone, a surgeon, an investor, anyone, to be so radically open about their failures? Well, the answer isn't a lack of pride. It's the exact opposite. It's having a deep, unshakable foundation of self-confidence. Think about it. When you're truly confident, you're not threatened by being wrong. You have Peter Lynch, the legendary investor, openly buying back a stock for more than he sold it for, basically admitting his first call was wrong. You have the heavyweight boxing champ, gentleman Jim Corbett, who was famously polite because he had nothing to prove to anyone. Even Buffett will beat himself up over a stupid mistake in a friendly game of bridge. Their self-worth isn't tied to being perfect, so they're free to learn from their imperfections. All right, so let's tie this all together. How do we take this lesson and actually apply it? How can we start making mistakes like a master, turning our errors from things we hide into our greatest assets for growth? Look, if you remember just one thing from all of this, let it be this. Don't just feel bad about a mistake and move on. That's just passive regret, and it doesn't teach you a thing. Real learning is an active process. It demands that you stop, you confront the error head-on, you dissect why it happened without making excuses, and you make a real plan for how you'll handle it differently next time. And so I'll leave you with a final thought, a question that the best surgeons and the best investors ask themselves all the time. Think about the last time something didn't go your way. What was your mistake, and what did you actually truly learn from it? The answer to that question might just be your next big breakthrough. We've all been there, right? You panic sell a stock, and then you have to watch, in horror, as it skyrockets the very next week. Or maybe you've held on to a losing stock for way, way too long, just praying it'll turn around. Well, you're definitely not alone. These investing mistakes are so common, so predictable, there's an entire field of psychology dedicated to them. Today, we are going deep into our own minds to uncover the hidden biases that are secretly costing you money, and, more importantly, how you can finally get them under control. You know, when the investing legend Warren Buffett was asked what the secret to all his success was, his answer wasn't some complicated formula or a secret stock-picking method. Nope, it was just two words: I'm rational. And that simple phrase, it tells you everything. The biggest fight in investing isn't you against the market. It's you against yourself. So if being rational is the golden ticket, what's holding us back? What are these invisible strings that seem to pull us toward making these emotional, illogical, and, let's be honest, really expensive decisions with our money? Well, that is exactly what we are here to figure out. To get to the bottom of it, we've got a little roadmap. First up, we're going to define what this Buffett standard of rationality really means. Then we'll dive into 3 big categories of mental mistakes. How we get totally blinded by things that just happened, we've all done that. How our feelings completely sabotage our finances, hello, emotional investing. And then how our own brains can actually trick us with some seriously flawed logic. That part's a real mind bender. And then at the end, we'll put it all together so you can walk away as a more rational and hopefully a much more profitable investor. Okay, let's kick things off with the goal versus the reality. We all imagine ourselves as that calm, cool, logical investor, right? But the market, well, the market usually has other plans for our emotions. So for a long time, the academic world loved this idea called the efficient market hypothesis. It's this, neat and tidy theory that everyone investing is smart and logical, and because of that, stock prices are always perfectly fair. But if you've ever actually put $1 into the market, you know the reality is a lot more like what our source calls the nutty investor theory. The truth is, the market is full of people, us, acting illogically, driven by fear one day and greed the next, and that's what sends prices flying way too high or crashing way too low. Buffett's secret? He just accepts that reality instead of living in the textbook. All right, so let's tackle our first big mental hurdle, our brain's obsession with whatever just happened. We have this terrible, terrible habit of overreacting to the now. And this brings us to a really dangerous duo, recency and extrapolation. Recency is our brain's tendency to give way too much importance to things that just happened. And extrapolation, well, that's its reckless cousin. That's when we see a trend and we just foolishly assume it's going to keep going up and to the right in a straight line forever. These are both mental shortcuts that can lead us straight off a financial cliff. Here's a perfect way to think about it, completely outside of investing. The actual statistical risk of a flood in your town did not magically change the day after your neighbor's basement got soaked. It's the same. But because that event is so recent and so vivid in your mind, your perception of that risk goes through the roof, and suddenly everyone's rushing to buy more insurance. This exact same thing happens with stocks every single day. Now let's watch this play out with a real-world cautionary tale. It all starts with a hot tip from a friend. They tell you Pfizer is in huge trouble, facing lawsuits over a defective heart valve. It sounds urgent, it sounds scary, so you react. You sell your shares at $79, and then you watch the stock dip to $72, and you feel like a genius. You think, phew, dodged a bullet there, right? Wrong. 1 year later, that same stock is trading at $144. So what happened? You were so focused on the recent, loud, scary headline about the lawsuit that you completely missed the real story that was brewing under the surface. A game-changing new drug called Viagra. It's a classic case of getting spooked by the small picture and completely missing the big one. So, our perception of time is clearly flawed. But you know what? That's not the only thing getting in our way. Let's move on to an even more powerful force at play, our own emotions. At the very core of all our emotional investing mistakes is this incredibly powerful bias called loss aversion. Here's what it means in plain English. The pain of losing $100 feels roughly twice as intense as the pleasure you get from gaining $100. And why is that? Well, it's basically an evolutionary hangover. Back in the day, for our caveman ancestors, losing your food supply could literally mean death. Gaining extra food was just a nice bonus. Our brains are still running on that ancient survival software, even when we're just staring at our brokerage account. This cafeteria experiment shows loss aversion perfectly. Imagine you overhear some great news about a company you own. The result? Only about half of investors said they would buy more. Okay, now look at the flip side. You overhear some bad news. The result? 100%. Every single investor said they would sell. The fear of a potential loss is just so much more powerful than the hope of a future gain, and it causes us to sell at the absolute worst times. Oh, and the emotional traps do not stop there. We've got the love of gains. That's when we get nervous and we sell our winners way too early just to lock in a small profit. Then there's the pathetic fallacy. That's when you refuse to sell a losing stock because your favorite aunt gave it to you. A stock doesn't know you own it. There's also the avoidance of painful memories, when you swear off ever buying a certain stock again because it burned you 10 years ago. And of course, the big one, classic overconfidence. That's when we think we're smarter than everyone else, which leads to trading too much and taking on some really foolish risks. Okay, we've covered our warped sense of time, and we've covered our runaway emotions. But now we're wading into the sneakiest territory of all, the hidden glitches in our own logic. This is when our brains are actively working against us. And that brings us to this fascinating concept called anchoring. See, our minds are desperate for some kind of starting point when we have to make a decision. So what do? We latch onto the very first piece of information we hear, the anchor, and then we just kind of adjust from there. The crazy part is, our brain does this even when that anchor is completely random and has nothing to do with anything. This example sounds almost ridiculous, but it's based on real experiments. If you ask someone to think about the year Attila the Hun invaded Europe, let's say 451 AD, and then you immediately ask them to estimate the population of Seattle, their guess will be unconsciously dragged lower by that totally random number. It's completely irrational, but that's how we're wired. And in investing, we do this all the time. We anchor to a stock's 52-week high, or the price we first paid for it, even though those numbers might have absolutely zero bearing on what the company is actually worth today. Let's look at a few more of these logical traps. First, you've got the sunk cost fallacy. You know that feeling, right? It's that voice in your head that says, I've already put so much money into this loser, I can't possibly sell now. The cold hard reality? You shouldn't throw good money after bad. Then there's the herd instinct, the feeling that, hey, everyone is buying this, it must be a great idea. But in the stock market, the crowd is very, very often wrong. And finally, status quo bias. We feel like doing nothing is somehow safer than making a decision and being wrong. But doing nothing is a decision, and it has its own set of consequences. This one is one of my favorites because it's so easy to get wrong. It's the mistake of confusing the case rate with the base rate. So we hear a story, the case. Jane loves books. Our brain immediately jumps to a stereotype that fits. She must be a librarian. But wait a second. That ignores the base rate, the simple statistical fact that there are way, way more salespeople in the world than there are librarians. So statistically speaking, Jane is much more likely to be a salesperson who just happens to love books. Investors do this constantly. We fall in love with a company's exciting story without ever stopping to consider the base rate of how many companies with similar stories have actually failed. Okay, deep breath. We have just walked through a whole minefield of mental errors. So the big question is, how do we navigate it? How do we actually become that rational investor we all want to be? Well, it all begins with one thing, awareness. And there is one last major hurdle we have to get over. It's called cognitive dissonance. This is that really uncomfortable feeling you get when a new fact directly contradicts something you already believe. And to make that discomfort go away, our brains do something very clever. We start searching for any piece of information that confirms we were right all along, and we just ignore or reject or explain away anything that suggests we might have been wrong. This is why it is so incredibly hard to admit we made a mistake on a stock, even when all the evidence is staring us right in the face. And you know what? This brings us full circle. The most important point here is that you don't have to be perfect. You don't have to be some kind of emotionless robot to succeed. According to Buffett, success really just comes from being aware of these common mistakes and making a conscious effort to resist them, while you let other investors be the ones who fall into all the traps. So, to wrap all this up, I want to give you 3 mental watchdogs to take with you. Before you make any investment decision, just stop and ask yourself these 3 questions. First, am I doing this just because it was in the news yesterday? Am I falling for recency? Second, what emotion is driving me right now? Is this fear? Is it greed? Is it just nostalgia for some old stock? And third, is my logic solid here? Am I just mindlessly following the crowd or anchoring to some random number? I'll leave you with this final thought. Tonight, I want you to go and take a look at the stocks you own right now. Each and every one of them tells a story about a decision you made. And I want you to ask yourself honestly, is it a story of rational, logical decisions? Or is it a story that's been shaped by recency or loss aversion or one of the many other common mistakes that we've talked about today? The answer to that question might be the most valuable investment insight you ever get.
Welcome to The Explainer. Today, we're going to take a hard look at what might be the single most common piece of investing advice you've ever heard. In fact, we're going to see if maybe, just maybe, it's completely wrong.
You know the saying, don't put all your eggs in one basket. It's practically the first thing they teach you about money. But what if that's actually terrible advice? What if the real secret to building serious wealth is finding one incredibly strong basket and putting all your eggs in it? We're about to dive into the radical idea that concentration might just be the key to winning big.
All right, so here's our roadmap. First, we'll unpack Warren Buffett's super contrarian take on all this. Then, we'll look at the arguments for and against going all in. After that, we'll dig into the hard data to see what actually happens in the real world. And finally, we'll figure out what this all means for your personal playbook. Okay, let's get right into it. Buffett's core philosophy is, honestly, kind of shocking. He basically says that spreading your money thinly across tons of different stocks is a huge mistake. Instead, you should concentrate your capital in just a few truly outstanding businesses. It's a high-stakes strategy that flies in the face of everything we're taught about playing it safe. So what exactly do we mean by a concentrated portfolio? Well, think of it this way. Instead of owning a teeny-tiny, almost meaningless piece of 100 different companies, you own a big, significant slice of just a handful that you know inside and out and that you absolutely believe in. It's not about hedging your bets, it's about making a few high-conviction bets that you expect to really pay off. Now, I know what you're probably thinking. Isn't that incredibly risky? And yeah, it absolutely can be. But there's a really powerful logic behind it that we need to understand. Let's dig into why a focused approach, for the right kind of person, might actually be the smarter way to invest. So what's the big upside to being so focused? It really boils down to one word: knowledge. I mean, think about it. Can you really know 100 different companies? Can you keep up with their earnings calls, their competitors, their new products? No way. But you could probably know, say, 10 or 15 really, really well. That deep knowledge lets you make much smarter decisions. It allows you to pour your money into your absolute best ideas, not your 50th best idea.
Okay, but before you run off and sell everything to buy 3 stocks, let's hit the brakes, hard. There is a very good reason that diversification is the standard advice, and it's because concentration can go wrong in a big, big way. A single mistake can be an absolute disaster. Let's look at the dark side of the strategy.
And this slide really hammers home the danger. Look, if you own 100 stocks and one of them blows up, it's a bummer, but it's just a small dent in your portfolio. But if you only own 5 stocks and one of them gets cut in half, that's not a dent, that's a tidal wave that could sink your entire financial ship. One bad call, and you are in a world of hurt.
So it all comes down to this massive trade-off, doesn't it? On one side, you have the potential for incredible, life-changing returns that are driven by your own expertise. But on the other, you have the constant, terrifying risk of one catastrophic mistake wiping you out. It's the ultimate high-risk, high-reward gamble. All right, so we've talked about the theory, the pros and the cons, but what happens when the rubber meets the road? What happens when professional money managers try to do this with billions of dollars of real money? Does this concentrated strategy actually work? Let's stop guessing and look at the data.
And to do that, we're going to look at a fantastic study from the research firm Morningstar. They took a deep dive into a bunch of mutual funds that follow this exact strategy, holding 30 stocks or fewer, to see how they actually performed against their more diversified peers. This gives us a really clean, unbiased look at the results.
The results were, well, they were pretty wild. Check this out. The Marsico Focus Fund, back in late 1999, just went on an absolute tear. It shot up an incredible 34%. That is the kind of explosive growth that concentration promises, the kind of return that makes you feel like a certified genius.
But, and this is a huge but, here's the other side of that coin. Just a few months later, that same fund hit a wall and absolutely cratered. It dropped more than 18%. This is the brutal reality of concentration. The highs are amazing, but the lows are gut-wrenching. And this wasn't a one-time thing. The Morningstar study found this was a consistent pattern. You can see it right here on the chart. These concentrated funds, like Marsico and Sequoia, had these absolutely wild swings. They were way more volatile, either soaring 10 percentage points above their peers or crashing 10 percentage points below them. It was either feast or famine.
And that brings us to the single most important takeaway from all the data, summed up perfectly right here by Morningstar. Concentration gives you extreme performance, both good and bad. But over the long haul, it isn't actually better on average. You might hit a home run, but you're just as likely to strike out.
So wait a second, if it's this risky, and it's not even better on average, then why on earth would a legend like Warren Buffett swear by it? The answer is one of the most important insights in all of investing. There are 2 sets of rules. There's a law for the expert, the lion, and a completely different law for the rest of us, the lambs.
This quote from the old baseball player Phil Rizzuto is the perfect analogy. See, Rizzuto was a small guy, a singles hitter. So when a massive home run slugger told him to just swing for the fences every time, Rizzuto knew it was terrible advice for him. What works for a giant power hitter is a recipe for disaster for a small contact hitter.
And that is the absolute core of it, right here. You have to be brutally honest with yourself about which type of investor you are. Are you a lion, like Warren Buffett? Someone who actually enjoys reading financial reports for fun, who lives and breathes this stuff, and who has the stomach to make huge bets and not lose sleep? Or are you a lamb, who would much rather watch football on the weekend and is perfectly happy with steady, solid returns? There's no wrong answer, but you have to know who you are.
So what does this all mean for you personally? If you've looked in the mirror and realized, yep, I'm a lamb, are you just doomed to get mediocre results? Not at all. In fact, this is where it gets really interesting, because the ultimate lion, Warren Buffett himself, has some incredibly powerful and very surprising advice for the average investor.
You read that right. Let that sink in. The king of concentration, Warren Buffett, says that for most people, what he calls the know-nothing investor, the best thing to do is just buy a simple, low-cost index fund and call it a day. Why? Because by just admitting you don't have an edge and buying the whole market, you will almost certainly beat the vast majority of so-called experts who are trying and failing to be lions.
This is such a profound and game-changing idea. Being a smart investor has nothing to do with being a stock-picking genius. It's about having the self-awareness to know your own limitations. The very second you admit you're a lamb and choose the safe, diversified path of an index fund, you've made one of the smartest moves possible. Your dumb money instantly becomes genius money.
So we end right here with the most important question of all. Which one are you? Are you the lion, with the rare mix of skill, time, and nerve to make concentrated bets? Or are you the lamb, with the wisdom to know that the steady, diversified path is the smarter one for you? There is zero shame in being a lamb. In fact, for most of us, it is by far the wiser choice. The whole key is just being honest with yourself and picking the playbook that's actually built for you. Have you ever wondered if there's some secret formula to invest just like Warren Buffett? You know, a stock screener that could spit out a list of amazing companies just for you. It's a really tempting idea, right? So today, we're going to pull back the curtain and find out if these shortcuts can actually find the kinds of stocks that Buffett himself would even consider buying.
All right, so here's our game plan. First, we're going to bust the myth of the simple Buffett shortcut. Then we'll get into why his real superpower goes way beyond just the numbers. After that, we'll actually look at two different screening methods, one from Robert Hagstrom and another from David Braverman. And that's all going to lead us to the biggest lesson of all, where the real work of investing actually starts.
So let's dive right in with this big idea. The promise of a simple tool that just hands you a list of Buffett stocks. I mean, it sounds incredible, doesn't it? It feels like you could get the amazing results without putting in decades of work. But is that even realistic?
I mean, really think about it for a second. Can we take all that experience, all that deep business knowledge, and that legendary wisdom, and just, boil it all down into a few lines of code? The search for an easy answer is what gets a lot of investors into trouble, because the real secret is in understanding how Buffett thinks.
And this quote right here, it tells you everything you need to know about his mindset. See, he's not a gambler hoping for a lucky spin. He's more like a detective looking for a case that's already solved. His entire goal is to get rid of risk, not to take big chances. And that approach is the polar opposite of looking for an investment shortcut.
And this is absolutely crucial. Buffett's #1 most powerful filter isn't some fancy financial ratio. It's the total, complete absence of doubt. He and his mentor, the great Ben Graham, would dig and dig and dig into a company until every single question was answered. If even one little shred of uncertainty was left, they just walked away. No shortcuts, period.
Okay, so that relentless search for certainty, well, that leads us to the biggest hurdle in trying to copy him. A computer can crunch numbers all day long, sure, but that's only half the equation.
Think about it like this. Buffett's investing brain has two sides. On one side, you've got the quantitative stuff, the hard numbers like cash flow and profit margins. A screener loves that stuff. It can find it in seconds. But then you've got the other side, the qualitative side. This is all about judgment calls on management, deep research into the industry, and picking up on subtle clues that just don't show up on a spreadsheet. And that is where the real magic happens.
And let's just be real for a second. Buffett has a huge advantage that you and I just don't. If one of us calls a huge company, we get put on hold and maybe transferred to investor relations. When Warren Buffett calls, the CEO picks up the phone. That direct access to judge a company's leadership is a qualitative edge that no formula is ever going to replicate.
So, with all that said, are these screeners totally useless? Not at all, but we have to understand what they're actually for. So, let's check out our first example, a method from Buffett expert Robert Hagstrom, to see what I mean. And look, Hagstrom himself is the very first person to tell you what this thing is and what it isn't. It's not a magical buy list, it's not the finish line. In his own words, it is just a starting point for you to begin your own deep dive.
So Hagstrom breaks it down into 4 areas that Buffett looks at, and he looks at them in this order. Now, a screener can help you out with steps 3 and 4, the numbers and the price. That's the quantitative stuff we talked about. But steps 1 and 2, really understanding the business and its managers, well, that's the qualitative work, and that's all on you. Now, purely as a historical example, and I have to stress this is not investment advice, here are the top 5 results the screen came up with way back in February of 2001. The specific names aren't the point. The point is that this list isn't an answer key. It's the beginning of the test. Each company on this list represents a whole new set of questions that you now have to go out and find the answers to. Okay, let's switch gears and look at another approach. An analyst named David Braverman, who covers Berkshire Hathaway, came up with a much more technical 5-point screen. This one is really focused on the hard numbers.
And right away, you can see why this got people excited. Over a 6-year period, the stocks this screen picked absolutely crushed the broader market. A track record like that is exactly the kind of shortcut people dream about finding. So what was this screen actually looking for?
So first, we got to understand a really important term, owner earnings. This is one of Buffett's all-time favorite metrics. It's not just the net income you see on a statement. It's a much more realistic look at the actual cash a business is putting in the owner's pockets.
Braverman's screen was basically an obstacle course with 5 incredibly tough hurdles. It looked for high owner earnings, fat profit margins, and a consistently high return on equity. That ROE number is huge. It basically asks, for every dollar the owners have in the business, how much profit does it kick back? The screen also made sure the company was smart about reinvesting its earnings and, of course, that the stock wasn't wildly overpriced. It's a tough quantitative test. But even with all that, there is still a giant piece of the puzzle missing. And here's the twist. Braverman's purely mathematical screen pointed to tech giants like Microsoft and Oracle as great potential investments. But at that exact same time, Buffett was famously avoiding tech stocks completely, saying they were outside his circle of competence. And that right there is the perfect example of the gap between a formula and a philosophy. The numbers can all line up, but they can't capture a person's individual investment worldview.
So all of this brings us to the ultimate takeaway from both of these examples. After you run the numbers, after you get that list of potential companies, that's not the finish line. In fact, that is the exact moment the real work begins.
So if you're going to use tools like these, you have to remember a few critical rules. First, screeners are only for generating ideas, nothing more. Second, if you're not going to do that deep dive research afterward, then you have to diversify. Third, you've got to be ready to dig into annual reports and study what the managers are saying. And finally, as Hagstrom warns, even if you do everything right, don't expect to magically get Buffett's legendary returns.
I love this quote from mutual fund manager Edwin Waltsack. It just nails the point perfectly. Even if you get a bunch of experts who follow the exact same principles, their portfolios are all going to look different. And why is that? Because investing isn't just about a formula. It's about your own interpretation, your judgment, and what you personally believe in.
Look, running the screener, that's the easy part. The real work, the work that actually creates value, is the hours you spend reading and thinking. It's about understanding a business so well that you can own its stock with total, unshakable conviction, no matter what the market is screaming about tomorrow. And that's really the question I want to leave you with. A formula can find you a list of stocks, sure, but can it give you that deep, doubt-free conviction that has always been Warren Buffett's true secret weapon? Something to think about. Thanks so much for joining me.
You know, in the world of investing, there are good track records, and there are great ones. And then, every once in a while, you get the legends. I mean, we're talking about a level of success so incredible, people compare it to the New York Yankees in baseball or Beethoven in music. Today, we're going to pull back the curtain on one of those true legends.
Let's just start with a number. Look at this, $1,315,850. Now, that's not a lottery jackpot. That's what a single $10,000 investment in something called the Sequoia Fund, made way back in 1970, would have ballooned into by the year 2000. It's just an absolutely mind-boggling return that makes you wonder, how in the world did they do that?
And believe me, this was no flash in the pan. The proof is right here in this chart. Since it started, Sequoia has consistently beaten the S&P 500 index, the overall market, by an average of 2.7 percentage points a year. Now, I know what you're thinking. 2.7%, that doesn't sound like a lot. But when you let the magic of compounding do its thing for decades, well, that small number becomes a financial earthquake. It's the difference between having a nice retirement and creating real generational wealth.
But there's a catch, and it's a big one. You can't just go out and buy a piece of this fund. Nope. Sequoia slammed its doors shut to new investors all the way back in 1982. And that exclusivity, it just makes the story even more fascinating, right? It deepens the mystery. How did they pull this off? And more importantly for us, what can we learn from the mind that built this absolute powerhouse?
All right, so here's our game plan for this masterclass. We're going to start by asking if Sequoia is really the best fund ever. Then we'll meet the man, the myth, the legend himself, William J. Ruane. We'll uncover his 3 wise mentors, get to the heart of his philosophy on growth, see how he actually invested the Sequoia Ray, and then we'll wrap it all up with 4 powerful rules that you can take with you. So first things first, let's tackle that big claim head on. We've heard these incredible comparisons, but does Sequoia really deserve the title of the best fund ever? Let's check out the evidence.
Well, when you see a quote like this, it's pretty hard to argue. This just perfectly captures the fund's status. It wasn't just another fund that did well. No, it's widely considered to be in a totally different league, a benchmark for what excellence even means in this industry.
Okay, so who was the architect behind this masterpiece? Let's meet the man behind the legend, William J. Ruane, and try to understand the mind that created this incredible success story. Now, you're probably picturing some loud, aggressive, fast-talking Wall Street shark, right? Well, you'd be totally wrong. Descriptions of Ruane paint a picture of a calm, thoughtful, and charming guy, a straight arrow who spoke slowly and with real consideration. This quiet personality, it's almost the opposite of the explosive growth his fund achieved, which is actually our first big clue to his very unique approach. And this slide gives us such a cool glimpse into how he thought. In an industry that is totally obsessed with blinking lights and moment-to-moment data, Ruane's office was an oasis of quiet. Get this, no Quotron machine, no Bloomberg terminal spitting out stock quotes. Instead, a gorgeous view of Central Park and a library filled with the greats, Buffett, Adam Smith, Bernard Baruch. This wasn't a room for frantic trading. It was a sanctuary for deep, uninterrupted thinking.
But that deep thinking didn't just happen in a vacuum. Ruane's philosophy was a brilliant mix, built on the shoulders of giants. So let's meet the three wise mentors who really formed the bedrock of his incredibly successful approach to investing. This timeline really shows you the building blocks of his genius. He started with an engineering background in the Navy, so he had this practical, analytical mind. Harvard Business School sharpened it, but the real turning point, the moment that set everything in motion, came in 1950. He decided to just sit in on a seminar at Columbia University. And in that room, he met two men who would change his life and the entire world of investing forever.
His first mentor was the professor himself, the legendary Benjamin Graham, the father of value investing. Graham gave him the framework. His lesson was simple but profound. You have to start with the numbers. The financial reports are absolutely critical. You have to do the quantitative analysis to get an objective picture of a company's health. Then came mentor number two, Philip Fisher, who added this whole other crucial layer. Fisher's big idea was that the numbers alone were not enough. You had to look beyond the balance sheet, to the stuff you can't easily quantify, the quality of the business itself, its competitive edge, and its power to generate profits way, way into the future. And the third mentor, well, he wasn't a professor. He was another student sitting right there in Graham's class, a young Warren Buffett. Ruane saw firsthand how Buffett took Graham's hard-nosed quantitative foundation and brilliantly blended it with Fisher's ideas about quality, creating something new, something even more powerful.
So okay, we have Graham's hard numbers on one side and Fisher's business quality on the other. How did Ruane combine these powerful and sometimes competing ideas into his own unique philosophy? This right here is where we find the true Sequoia secret.
He started by tackling one of the oldest debates in investing. For decades, Wall Street has loved to put companies into one of two buckets. You're either a growth stock or a value stock. That's it. But Ruane, he saw things completely differently.
And this quote, this is the light bulb moment. He didn't see a conflict at all. For Ruane, growth wasn't the opposite of value, it was an essential part of value. Think about it. A company's ability to grow its earnings over time is a huge part of what makes it valuable in the first place. He saw them as two sides of the same coin.
So, with this brilliant, unified philosophy that growth is a key component of value, how did Ruane and his team actually put their money where their mouth was? Let's pull back the curtain and see the Sequoia way in action.
First off, they believed in concentration. As Ruane famously said, after you do all the hard work to find a truly great business, why not own a lot of it? And this chart shows he wasn't kidding. At one point, a full 1/3 of the entire fund was invested in a single company. His old classmate's company, Berkshire Hathaway. That's conviction.
And this patient, highly concentrated approach was the complete opposite of what he called the trading madness. While the rest of the market was caught up in an enormous frenzy, constantly buying and selling, chasing trends, Sequoia was just focused on the long-term health of the businesses they owned. They basically only sold if something fundamental about the company truly changed for the worse.
This philosophy also explains why they stayed closed all those years. It really came down to discipline and integrity. They knew a huge flood of new cash would force them to buy so-so companies because, as they honestly admitted, they just didn't have enough truly great ideas for the money they already managed. Protecting their existing shareholders' returns was way more important to them than just getting bigger.
So after all that, what can we take away from this? What's the lesson for us? Well, Ruane himself treasured 4 simple rules he got from another legendary investor, Albert Hettinger. So let's distill this whole masterclass down into that clear, actionable advice.
Here they are, 4 rules that guided one of the greatest investors of all time. Number 1, don't use margin. That's borrowed money. The logic is simple. If you're smart, you don't need the extra risk. Number 2, own a small, concentrated portfolio. Just 6 or 7 businesses you know inside and out. Number 3, stop watching the market's daily mood swings. Just focus on the health of your companies. And number 4, beware of momentum. The market goes from euphoric to depressed, and chasing whatever's hot is a surefire way to get burned.
Which really leaves us with this final, big, thought-provoking question. The whole story of William Ruane and the Sequoia Fund seems to suggest that maybe, just maybe, the secret to legendary success isn't about some complicated algorithm or frantic trading. Maybe after all the hard work of finding a truly great business run by great people, the single smartest move is to simply buy it and then just get out of your own way.
Today, we are diving into a really fascinating story from the world of investing. It's all about the attempt to build a mutual fund based on the principles of, well, one of the greatest investors of all time, Warren Buffett. This is the story of Robert Hagstrom's Focus Trust.
All right, let's just get right to it, because this is the billion-dollar question, isn't it? Could you actually take the legendary strategy of the Oracle of Omaha, a strategy that built an absolute empire, and make it accessible to pretty much anyone with $1,000 to their name? That was the grand experiment.
So where did this all start? Well, it kicked off with a simple but, incredibly ambitious idea: to create a fund that would basically mirror Buffett's investment strategy, but for the everyday person.
And the man behind this whole thing was Robert Hagstrom. And look, if anyone was qualified to try this, it was him. Hagstrom is a chartered financial analyst, and he's probably most famous for writing the fantastic book, The Warren Buffett Way. Now, while Buffett himself never commented, his legendary partner, Charlie Munger, actually recommended the book to Berkshire Hathaway shareholders. So yeah, it's safe to say Hagstrom really knew his stuff.
Okay, so the fund was built around this core concept called a focus portfolio. And get this, the name apparently came from Buffett himself, who described his own strategy to Hagstrom in that exact way. The idea is pretty simple, really. Instead of spreading your money thin across hundreds of stocks, you concentrate your bets on just 15 or 20 really good companies that you understand, and then you just hold on to them for the long haul. So in the beginning, back in 1996, the fund was a purist dream. It followed a really strict set of Buffett-like rules. It was concentrated, of course, but it also completely avoided the entire technology sector, just like Buffett was famous for doing back then. It also, interestingly, steered clear of the big Buffett stocks like Coca-Cola and Gillette. Hagstrom's thinking was that they'd already run up so far, and it even dodged companies with potential legal headaches. The whole goal was discipline and super low turnover.
But then, the story takes a really sharp turn. Just a few years in, the fund's whole philosophy started to shift in a way that honestly, nobody could have seen coming. It moved right into the one area it swore it would always avoid.
So what happened? Well, in 1998, the fund moved over to a new home at Legg Mason and got a new name, the Legg Mason Focus Trust. And this is where a new, very powerful influence comes into the picture, the celebrated money manager Bill Miller. Now, Miller was known for his own incredible success, but with a very different investment style, one that actually embraced technology. And under his guidance, the fund's direction began to change a lot.
And this slide just perfectly illustrates the pivot. I mean, just look at this contrast. Before the move, you had a strict zero exceptions rule against technology stocks. Afterwards, under Miller's influence, Hagstrom plunged 1/3 of the entire fund into so-called new economy tech stocks. This wasn't a small tweak. It was a radical departure from the original Buffett blueprint.
So this brings us to the crucial question. Did this massive bet pay off? Well, this is where the story becomes a true roller coaster, with some unbelievable highs and some absolutely devastating lows.
At first, the move looked like a stroke of pure genius. This was during the dot-com boom, and a lot of traditional value funds were really struggling. But the Focus Trust, it was thriving. It actually outperformed the S&P 500, which, is the benchmark for the 500 biggest U.S. companies for its first few years.
By the end of 1999, it looked like the grand experiment was a massive success.
And you can see it right here on this chart. Look at that incredible climb from 98 through 99 and right into the very beginning of 2000. It was just a fantastic run, all fueled by that big bet on technology. But, as you can also see, right there at that peak, the roller coaster is about to take a very, very steep drop.
And the fall was brutal. Here it is, in Hagstrom's own very honest words. In 2000, we got clobbered. And he tells you exactly why. The same tech stocks that had driven all that success became its undoing. At the same time, the fund had zero exposure to the sectors that were actually doing well, like oil and utilities. The very concentration that created the boom, well, it created the bust.
And here it is, the final number for the year 2000, a staggering 22% loss. To put that into perspective, the S&P 500 also went down that year, but the Focus Trust concentrated bet on tech meant its fall was just so much worse. The tech wreck had arrived, and the fund was right in the middle of it all.
So, what on earth can we learn from this incredible ride? Because this story isn't just about one fund's performance. It's about the very nature of this focused style of investing. And man, it offers some pretty profound lessons.
Now, before we judge Hagstrom's pivot to tech too harshly, it's probably worth asking a more nuanced question. Was this really a betrayal of the Buffett philosophy, or was it more of an evolution, maybe similar to an evolution that Buffett himself went through?
And Hagstrom himself makes this exact point. He argues that Buffett, thanks to a lot of influence from Charlie Munger, gradually moved away from the super strict, deep value principles of his mentor, Benjamin Graham. That old strategy of buying statistically cheap cigar butt stocks, companies with one last puff of value in them, it just wasn't working as well anymore. Buffett evolved. He started buying wonderful businesses at fair prices. Maybe Hagstrom saw his tech pivot in a similar light.
And this really brings the whole story back to us, right? The individual investor. After seeing the incredible volatility, the crazy ups and downs of the Focus Trust, can a regular person really pull off this kind of concentrated, high-conviction approach?
And this is Hagstrom's ultimate, really powerful conclusion. He says, yes, a focused strategy can produce dramatic, incredible performance. But here's the catch. Every single strategy, no matter how good, goes through periods where it just doesn't work. And during those tough times, an investor's endurance gets tested to its absolute limit. And in his words, most fail. The biggest challenge isn't picking the right stocks. It's having the psychological guts to stick with your strategy when everyone is telling you you're wrong.
So we'll leave you with this final thought. The story of the Focus Trust shows both the spectacular upside and the really painful downside of this kind of concentrated approach. It really forces us to ask whether this kind of investing is a test of your financial models and your stock picking skills, or if, at its very core, it's simply a test of your own human endurance.
Let's think about this for a second. If you're Warren Buffett and you've built this absolute empire, Berkshire Hathaway, who do you trust to take over when you're gone? I mean, who could possibly have the skill, the temperament, the judgment to handle all of that? It's one of the biggest questions in the world of finance. And the answer, believe it or not, is a name most people have never, ever heard. Now, when Buffett said this, you'd think he was talking about some Wall Street titan, right? Some household name. But he wasn't. Nope. He was talking about this quiet, kind of reclusive genius who flew completely under the radar. A guy he trusted completely to carry on his entire legacy. So, who was this mystery man? His name was Louis A. Simpson. And starting way back in 1979, he was the guy running the investments for Geico, which, as you know, is a huge part of Berkshire Hathaway. But here's the kicker, the thing that tells you everything you need to know. Buffett gave him total 100% autonomy. Nobody else got that. That is the ultimate vote of confidence. Simpson's path wasn't exactly typical. He started out teaching economics at Princeton back in the 60s. Then he had this really short, half-year gig at a super risky mutual fund and got out. It seems like that early taste of wild speculation just cemented this deep-seated belief in him to avoid reckless gambling, and that really set the stage for everything that came next. So, about a decade after that crazy Wall Street experience, Simpson finds himself interviewing for the top investment job at Geico. And get this, Warren Buffett himself sits in on the interview. It lasts 4 hours, just one conversation. And in those 4 hours, Buffett saw everything he needed to see. And this is just classic Buffett. His reaction after that meeting was incredible. He didn't need to see more candidates. He didn't need a committee meeting. He just turned to his team and said, "Stop the search, that's the fella." Just like that, he'd found his guy, the person he would one day name as the man to succeed him. Okay, so Buffett famously said that Simpson invested in almost the same way he did. And sure, they shared that core value investing DNA. But when you really dig in, you find these fascinating and frankly crucial differences in how they operated. And that's where the story gets really, really interesting. First up, concentration. Berkshire might hold, say, 28 stocks. Your average large cap fund, they're holding closer to 90. But Simpson, he usually held only 9 stocks. That takes an unbelievable amount of conviction. It means you have to know those businesses inside and out. It's focus on a whole other level. And here's another huge difference. We all know Buffett has famously steered clear of tech stocks for decades, saying he just doesn't understand them. Simpson, on the other hand, was a bit more daring. He wasn't afraid to get into the tech world, but, and this is key, only when he found what he called seemingly cheap tech stocks. And finally, there's turnover. Now, Simpson was definitely a long-term investor, but he was more active than Buffett. For example, back in 1997, he bought shares in Arrow Electronics and Mattel. By the very next year, 1998, he'd already sold them both. So he was much more willing to move in and out of things, which is just not the classic Buffett buy and hold forever picture we all have in our heads. So all these differences, they're interesting, right? But it all comes down to one simple question. Did any of it work? Did this more focused, tech-friendlier, slightly more active style actually, deliver the goods? Oh boy, did it ever. The numbers just speak for themselves. From 1979 to 1996, the S&P 500 did great, returning about 15.7% a year. But Simpson, over at Geico, returned an incredible 22.8%. He didn't just beat the market, he absolutely crushed it. And what's even crazier, he almost kept pace with Buffett himself, who was averaging 26.5% during that same time. And it all came to a head in 1999, right at the peak of the dot-com bubble. As tech stocks were going to the moon, Berkshire Hathaway's portfolio basically just broke even for the year. But Simpson's GICO portfolio, with his willingness to dip a toe into tech, it earned a solid 17%. He didn't just keep pace, he actually beat the master. Think about that, an investor who could crush the market, hang with Buffett, and even beat him during one of the craziest periods in stock market history. You have to ask, how? What was his secret sauce? What was his playbook? Well, turns out, the answer lies in a few simple core principles. And lucky for us, Simpson wasn't totally silent about his methods. He actually laid out his entire investment strategy in a GICO report. And it wasn't some ridiculously complex algorithm or anything. It was just a set of 4 simple but incredibly powerful core ideas. So here they are. It's actually pretty straightforward. Number 1, think independently. Basically, ignore the noise from Wall Street. Number 2, invest in high-return businesses. Find companies that are already winners and look like they're going to keep winning. 3, pay only a reasonable price, even for an excellent business. And number 4, our favorite, do not diversify excessively. It all comes back to that intense focus. And you can see this playbook in action when you look at his actual investments. Take a look at Shaw Communications, a cable company. At the time he owned it, its price-to-earnings ratio was 61. Now, for a lot of people, that would scream expensive. But for Simpson, that was a reasonable price to pay for what he saw as an excellent high-return business. It just goes to show you, his idea of value wasn't just about finding stuff that looks cheap on paper. But a playbook is one thing. Anyone can read the rules. Simpson's true secret weapon, his real edge, it wasn't just his strategy. It was his mindset. It was his whole psychological makeup. I mean, the guy was a fanatic, but in the best possible way. He'd read through financial statements and annual reports like they were crime novels, looking for clues no one else saw. And, this is so important, he lived in California, far, far away from what he called the madding Wall Street crowd. He intentionally built a moat around himself to stay away from the groupthink. And really, this is the final verdict from Buffett himself, the highest praise you can get. He said Simpson had the ideal temperament for investing. And listen to this last part. He derived no particular pleasure from operating with or against the crowd. He wasn't trying to be a rebel, and he wasn't trying to follow the trend. He just didn't care. He only cared about being right. And that really is what it all comes down to. Simpson's first and most important rule was to think independently. So the real question this whole story leaves us with is a personal one. In the world we live in today, with 24/7 financial news, with social media, with nonstop noise, could you actually do it? Could you truly ignore the crowd and just think for yourself? Okay, when you think about the absolute legends of investing, a few names probably pop right into your head. Warren Buffett, Benjamin Graham, right? We all know them. But what if I told you that behind these giants, there were these unsung titans, intellectual partners, who didn't just place the trades, but actually helped shape their entire philosophy? Well, today, we're going to pull back the curtain on one of the most important and yet least known firms in the entire history of value investing. To really get just how important these guys are, let me start with a question for you. We all know Warren Buffett. The man is famously brilliant, famously careful with his money. So who on earth did the Oracle of Omaha himself trust to be his stockbroker? Who did he trust to buy the very shares of Berkshire Hathaway that would make him a household name? The answer is a firm called Tweedy, Browne. And get this, their story doesn't even start with Buffett. It goes way deeper, all the way back to his mentor. Founded way, way back in 1920, their biggest client for years was none other than Benjamin Graham. Yeah, the guy who wrote The Intelligent Investor, the literal father of value investing. They were there right at the beginning, executing the trades for the man who literally wrote the book on it. So naturally, when Buffett, Graham's star pupil, came onto the scene, he went straight to Tweedy, Browne. They handled most of his purchases of Berkshire Hathaway stock. But here's the thing. It was so much more than just a client relationship. These guys were peers. I mean, one of the firm's partners actually gave Buffett some desk space in their office where he'd just drop in and sip a Pepsi. And here's a really crucial detail. Buffett asked his brokers not to buy the same stocks he was buying so they wouldn't drive up the price for him. And Howard Browne was one of the very, very few who actually respected that. Now that's integrity. So what is it that makes this firm so special? It's not just their incredible history. It's a philosophy, a kind of code of conviction that's been hardwired into their DNA for decades. So let's break down exactly what sets them apart from pretty much everyone else. I mean, just look at this. This tells you so much about their incredible discipline. In an industry that is constantly chasing the next hot trend, Tweedy, Browne has just two funds. That's it. No trendy tech funds, no fund of the month club. They just stick to their knitting, as they say, which is finding undervalued companies. And you can see it in the numbers. Their price-to-earnings and price-to-book ratios are just way below the market average. And tech stocks, you'll find almost none. They're simply not playing the same game as everybody else. And if you want one quote that perfectly captures their mindset, this is it. It's from Christopher Brown, and it's hilarious, but also so revealing. When some cybersquatters stole their domain name, their reaction wasn't to lawyer up or write a check. Nope. They were just too cheap to ransom it back. You see? Being cheap, or let's say extremely value conscious, isn't just a stock-picking strategy for them. It is in their DNA. It's who they are. Now, don't get the wrong idea. They aren't just looking for cheap stocks based on a hunch. The real secret weapon is that these guys are true intellectuals. They're basically academics with a brokerage account. They rigorously study decades of data and even publish these amazing little pamphlets, like one called What Has Worked in Investing. Their whole approach is built not on what might work tomorrow, but on a deep understanding of what has been proven to work over the long run. And this data-driven approach puts them right in the middle of one of the biggest debates on Wall Street. And Christopher Brown, man, he had a very clear and very colorful way of framing this classic conflict between value and growth investing. Just look at how he breaks it down. He says growth investors think they're buying all the neat companies, the fiber optics, the cool tech, and they look at value investors and say they're stuck with the hospice patients of corporate America, the boring Rust Belt stuff. But here's Brown's key insight. True value and growth are joined at the hip. The real danger is that what most people call growth investing is really just momentum chasing, just buying what went up yesterday without a clue about the fundamentals. And he even brings it right down to personality. He jokes that value investors, well, they're the eccentric ones. They're opinionated. Probably not the guys you want to grab a beer with. But the growth investors, they follow the trends. They don't have super strong convictions. They're the popular crowd. They're good people to go out drinking with. It's a funny line, but it really highlights that stubborn, principled, and maybe a little weird mindset you need to be a true value investor. And this isn't just talk. His philosophy is backed by hard evidence. He points to this fascinating study that found that over a 20-year period, boring old pharmaceutical companies and those exciting, high-flying tech companies had basically the same long-term returns. But here's the huge difference. The leaders in the pharma industry pretty much stayed the same. The leaders in tech, it was a revolving door of companies that would crash and burn. So you could get to the same destination, but the path through tech was way, way more dangerous. Okay, so we get the philosophy. But how does all of this translate into a practical, real-world playbook? We've talked about the big ideas, but how do they actually find these undervalued gems? Well, it turns out it's surprisingly straightforward. Here it is. It's basically a 3-step scan. First, they run a screen for the absolute basics, stocks that are cheap compared to their book value and their earnings. Simple enough. Second, and this is a big one, they track insider buying. I mean, who knows a company better than its own chairman or CFO? If those people are putting their own hard-earned money on the line, that's a powerful, powerful signal. And third, they follow the leads of other smart people, investors they already know and respect. Let's look at that third step in action with Wells Fargo. Years ago, the bank looked like an absolute disaster. It had zero earnings, and the top Wall Street analysts were completely split on its future. Tweety Brown had no idea who to believe. And then the news broke. Warren Buffett had just bought $600 million worth of the stock. As Brown put it, that was better than a phone call. That was all the signal they needed to dig in. And here's a classic example of step 2, tracking the insiders. Back in '93, the market was in a total panic about potential healthcare reform, and stocks like Johnson & Johnson were getting hammered. But amid all that fear, they noticed something interesting. A director at J&J, a highly respected executive named Tom Murphy, had personally bought almost 40,000 shares. So while everyone else was selling in a panic, they followed the insider's lead and made a huge and hugely profitable investment. But look, having a great playbook is really only half the battle. The other half, and it might be the harder half, is having the psychological discipline to actually stick with it. This is the endgame. This is about cultivating the right mindset for the long haul. Braun argues that one of the biggest mistakes we all make as investors is that we tend to value action more than inaction. We feel like we have to constantly be doing something. He even provocatively suggests this might be why some studies show that women are often more successful investors. They tend to be more cautious and trade less. The key takeaway here is that so often more activity just leads to worse results. And if you need proof that these guys walk the walk on inaction, just look at this number, 4%. In 1995, their American Value Fund had a portfolio turnover of just 4%. Let that sink in. 100% turnover means you've replaced your entire portfolio in a year. 4% means they hold their average stock for 25 years. They are not trading. They are owning. And this right here might be the secret ingredient to all of their success. Alignment. The partners at the firm have over $400 million of their own money invested right alongside their clients. They eat their own cooking. They feel the exact same pain and the exact same success. Brown jokes that for them, April 15th, tax day, is a national day of mourning. And why is that? Because they hate paying taxes on capital gains just as much as you do, which gives them a huge bias to just hold on to their stocks for the long, long term. So does all this patience, this value consciousness, this inaction, does it actually work? Well, the proof is right here. This chart shows the steady, compounding growth of their fund. Look, it's not a get-rich-quick scheme. It's a get-rich-slowly, get-rich-surely machine. And it's built on decades of proven principles. The proof is right there in the results. So let's end with this question, because it really gets to the very heart of the Tweety Brown philosophy. In a world that's just filled with noise and a constant pressure to trade, they force us all to ask a simple question. Are you just clicking buttons to feel busy, to do something? Or are you patiently executing a disciplined strategy that's designed to actually accomplish something meaningful over the long run? It's a simple question, but it has profound implications for every single investor out there.
When you hear the words value investing, chances are one name pops into your head: Warren Buffett. But what if I told you there was another genius out there, a guy who stood shoulder to shoulder with the greats, who had a completely different playbook, and who actually claimed to know more about finance than the Oracle of Omaha himself? Well, today we're pulling back the curtain on the brilliant, outspoken, and way too often overlooked Martin J. Whitman.
All right, here's how we're going to break it down.
First, we're going to get to know the man himself. Then, we'll put him in the ring with Buffett for a little showdown of ideas. After that, we'll see how his totally contrarian view made him a fortune, dig into his scathing critique of how most people invest, and wrap it all up with his actual rules of the road for you. So, first things first, let's meet Marty Whitman. And let me tell you, he was not your typical Wall Street suit. The guy was a character, a true academic, and a man who was just never, ever afraid to say exactly what was on his mind.
You know, to really get a handle on who Whitman was, it all starts with his confidence. I mean, just imagine having the guts to even think something like this, let alone say it out loud. It really begs the question on this slide, who on earth would make a claim like that?
That would be Martin J. Whitman, ladies and gentlemen. And look, this wasn't just some empty boast or pure arrogance. From his point of view, it was just a fact. It was all about his deep, deep belief in his own special area of expertise, pure financial analysis, which, as we're about to see, was a whole different world from Buffett's people-first approach.
This slide really paints the picture, doesn't it? Here's a guy who just marched to the beat of his own drum. He was comfortable enough to kick his feet up on his desk wearing old, beat-up sneakers. Yet he was so sharp he was teaching at Yale and Columbia. And his start in litigation, that gave him this almost forensic way of taking apart a company's finances, piece by piece.
And this quote, it just perfectly sums up the guy's personality, right? He had this amazing, kind of dry, totally down-to-earth sense of humor that just sliced right through all the self-importance you usually find in high finance. He just saw the world for what it was.
Okay, so let's get down to it. How did this sneaker-wearing professor's playbook really differ from the most famous investor on the planet? This is where it gets fun. Whitman versus Buffett.
So the first big difference is just their fundamental approach. Whitman himself called Buffett a control investor. That means Buffett likes to be in the driver's seat. He wants to own a company outright or at the very least have a seat on the board so he can influence management. Whitman, totally different. He was a passive investor. He bought big chunks of companies, sure, but he wasn't trying to run the show. His power came from his sharp analysis, not from a chair in the boardroom.
And what's fascinating is how brutally honest Whitman was about this. He would straight up say that Buffett had this uncanny ability to judge people, to pick the right management. But himself, he'd just admit, I screw up. Boy, he knew his superpower wasn't reading people, it was reading a balance sheet. And you can really see how this difference in their strengths led them down completely opposite paths, especially when it came to tech. Buffett, famously, has stayed away from tech for most of his career, saying he just doesn't get it. But Whitman, he ran right towards it. He knew a lot of tech companies would fail, so he just bought a whole basket of them, like a dozen semiconductor stocks. He wasn't betting on the tech, he was betting on their strong finances, and, as he put it, he made a fortune.
So, you might be wondering, how did that big bet on tech actually work out for him? Well, let's look at the exact moment when Whitman's contrarian streak paid off big time.
Okay, take a look at this chart. It's pretty wild. As the dot-com bubble is bursting in 2000 and the S&P 500 is taking a nosedive, Whitman's fund is hitting all-time highs. And why? It all goes back to those semiconductor stocks he'd been scooping up in 97 and 98 when everybody else thought they were junk. But here's the best part. When he was asked about this spectacular, career-defining performance, he gave a one-word answer, spelled out for emphasis. In classic Whitman style, he just chalked a huge part of it up to pure, simple luck. You gotta love that humility. And that is the absolute key takeaway here. He wasn't some market wizard who predicted the crash. No way. His success came from something much simpler, and honestly, way more powerful. Just buy good stuff when it's cheap. He totally ignored what Wall Street calls market risk, that fear that everything will go down together. Because he believed that if a company is solid and you bought it for a bargain, its true value will win out in the end, no matter what the rest of the market does.
And this core belief, this almost religious focus on buying things cheap, it led him to have some, let's say, strong opinions about the most popular way people were investing their money.
Yeah, he had absolutely zero patience for what's known as growth investing. To him, it wasn't really investing at all. It was just pure speculation. It's when people fall in love with a story about how great a company is going to be in the future and they completely ignore the price they're paying today. In his mind, you're just betting that a crazy stock market will bail you out.
And yeah, he really didn't hold back. This quote says it all. That's exactly how he saw a market that was being driven by hype and speculation. Just a complete madhouse with the least rational people in charge.
And that's precisely why he thought things like economic forecasts were totally irrelevant.
For him, a real value investor doesn't need a booming economy to make money. The real payoff comes when one of your undervalued companies gets bought out or acquired or taken private. The value gets unlocked by real business deals, not by market hype.
Okay, so what does this all mean for us? How can we actually use these ideas? Let's break down his straightforward, no-nonsense advice for investors at every level. So if you're a regular, everyday investor, his advice was crystal clear. First, avoid whatever is popular. Chasing hot IPOs or junk bonds, he called that a death sentence. He was adamant that individuals trying to play the market just get taken to the cleaners. So what's the solution? Don't try to be a hero. Instead, invest with the pros through proven, no-load value funds.
And what about for those ambitious students in his classes at Yale who wanted to be the next Marty Whitman? His advice wasn't to go read a bunch of theory books. Nope. He told them to get their hands dirty. Go work in an investment bank, in accounting, or as a lender. In his words, you have to learn the guts of the business. You got to see how the sausage is really made.
And finally, this slide gets to the very heart of his process. This is what he was actually looking for. He famously dismissed the P/E ratio, which almost every analyst on Wall Street obsesses over. He thought it was basically useless, because earnings can be messed with. Instead, he looked at the hard, cold facts on the balance sheet. What are the company's assets really worth? Do they have a ton of debt? And most importantly, can you buy it all for way less than it's actually worth? And that brings us to our final question, one that really captures the essence of Martin Whitman's entire philosophy. In a world where we're just bombarded 24/7 by market news, hype, and speculation, his career poses a really challenging idea. Maybe the smartest and most profitable thing an investor can do is to simply tune it all out and focus on the one thing that truly matters: value.
So what if I told you there was an investor who learned directly from Benjamin Graham, the father of value investing, who shared an office with a young Warren Buffett and who went on to crush the market for nearly half a century? And what if I told you that you've probably never even heard his name? Well, today, we're pulling back the curtain on the simple genius of Walter Schloss.
And look, the numbers here are just staggering. From 1955 all the way to the early 2000s, his investments returned an average of 15.7% a year. The broader market, just 11.2%. Now, that kind of outperformance over that long of a period, that isn't just a lucky streak. That is a rock-solid strategy that was built to last through all kinds of markets.
So that leads to the big question, right? With a track record like that, why isn't Walter Schloss a household name? Why isn't he mentioned in the same breath as Buffett every single day? Well, the answer gets to the very core of his philosophy, not just about investing, but about life. And we're going to unpack that right now.
All right, here's our game plan. First, we'll get to know the man himself, this unsung legend. Then, we'll dig into the foundation of fear that shaped his entire worldview. After that, we'll open up his investment playbook, piece by piece. We'll also look at what he chose to ignore, which is just as important. And finally, we'll wrap up with some of his timeless wisdom.
So, let's start with who this guy actually was. Walter Schloss wasn't some outsider who got lucky. No, he was a direct student of the master himself, Benjamin Graham. But, and this is key, he took those lessons and carved out his own unique and deliberately simple path to success. And you can see his credentials right here. This guy was in the room where it happened. He hits Wall Street right after the Depression, spends nearly a decade working for Ben Graham, and then, get this, even shares office space with Warren Buffett. He was literally at the epicenter of the value investing universe.
And here it is. This is the answer to why he isn't more famous. It was completely by design. He had zero interest in building a massive empire or having a huge staff. He wasn't chasing fame or complexity. He just wanted to keep his life and his investing simple.
So where did this super disciplined, almost cautious approach really come from? Well, it was forged in the fire of the Great Depression. The lessons he witnessed firsthand during that collapse became the absolute bedrock of his entire philosophy for the rest of his life.
You know, to really get inside his head, you have to picture the market back in 1929. People were buying stocks with just 10% down. Think about that. That means a tiny little dip in the market could completely, totally wipe you out. Schloss talked about seeing stocks that were trading at $90 a share just plummet to $2. I mean, seeing that kind of financial devastation, that leaves a mark.
And this quote just says it all. Schloss saw this fear of losing money as something his whole generation of investors inherited, and he even included Warren Buffett in that group. For them, protecting your capital, making sure you don't get wiped out, that wasn't just some textbook rule.
It was a gut-level instinct. Okay, so we've got the mindset, this foundation of fear. But how did that translate into an actual strategy? How did he do it? Let's break down the surprisingly simple, actionable rules that Schloss used to consistently find winners for almost 50 years.
His whole method was just beautifully straightforward. First, he'd hunt for cheap stocks using a company's book value. Second, he knew exactly what the biggest red flag was, the one thing to avoid at all costs. Third, he had superhuman patience. And fourth, he deliberately looked in the places nobody else was paying attention to. Let's dig into each of these.
See, back in Ben Graham's day, you could literally find companies trading for less than the cash they had in the bank. By the time Schloss was on his own, those deals were gone. So he adapted. He focused on book value. Basically, what are the company's physical assets actually worth? That became his North Star for finding a bargain.
So when Schloss was digging through a company's financials, what was the one thing that would make him slam on the brakes? What was the ultimate danger sign he was always looking out for?
And there it is, debt. For Walter Schloss, too much debt was the absolute kiss of death. He knew that when things get tough, and they always do, the people who lent you money get nervous and they can pull the plug. A company with no debt has breathing room. A company drowning in debt is on a timer.
And this brings us to the final and maybe the toughest part of his playbook, patience. This was not a get-rich-quick thing at all. Schloss figured it took, on average, about 4 years for the market to finally realize the value in one of his cheap stocks. His entire legacy was built on that incredible discipline, day after day, year after year.
Okay, now this is where it gets really interesting, because what made Schloss so special wasn't just what he did, but what he deliberately chose not to do. It's the power of subtraction, of keeping things simple. That was his secret weapon.
Now this is a huge one. Unlike basically every other famous investor, Schloss didn't waste a second trying to meet with CEOs or judge management teams. His logic was brutally simple. If the management is great, the stock price will be high. If they're bad, the price will be low. He figured the story was already right there in the numbers.
Here's another piece of so-called wisdom he just threw right out the window, trying to time the market. He had no interest in guessing if the market was going up or down. If he couldn't find any stocks that met his super strict criteria, you know what he did? He just sat on his cash and waited. Simple as that.
He also went after one of the most popular investing mantras out there. You've heard it a million times. Buy good companies and hold on forever. To Schloss, that idea was just way too simplistic and frankly kind of dangerous. He knew that things change and you have to be ready to sell.
And this is just a perfect example of his philosophy in action. He sold Bethlehem Steel, which was a blue chip, a Dow Jones stock, for $37 a share because he thought it was fully valued. Then he took that cash and plowed it into a cheap, forgotten stock, Western Pacific Railroad. The result? Bethlehem Steel cratered down to $3 a share, while his cheap railroad stock got bought out for $163. That, right there, is the magic of selling a good company to buy a truly great bargain.
So let's pull it all together. What are the big lessons we can take from Walter Schloss? Let's try to distill his entire approach down into some wisdom that is just as powerful today as it was 50 years ago.
You know, one of the best ways to understand Schloss is to put him side by side with Buffett. Schloss loved industrial cyclical companies and valued them based on their hard assets. Buffett, on the other hand, became a genius at predicting the future earnings of stable businesses like banks and insurance companies. Both are value investors for sure, but they took completely different roads to get there.
And when somebody asked him what the single biggest mistake average investors make is, his answer was so simple, so direct. He said people just trade too much. They get swept up in the news, in their emotions, and they're always chasing that quick buck, forgetting that building real wealth takes time.
And really, that leaves us with this final question to think about. Walter Schloss's whole career was a masterclass in simplicity, patience, and discipline. In our world today, which is obsessed with speed and complexity and the next big thing, maybe his greatest lesson is that the ultimate edge, the real secret, is just finding a simple strategy that works and then having the guts to stick with it.
So what if the real secret to crushing it in the market wasn't about finding the next hot stock, but about ignoring all the noise? Today, we're going to dive into the mind of Robert Torre, a legendary fund manager who built an incredible track record by doing exactly that. He learned from the best for sure, but he was always fiercely independent, and his ideas offer a powerful antidote to the short-term chaos of Wall Street.
Right off the bat, Torre gives a huge nod to his biggest influence.
You can see he viewed Warren Buffett as more than just an investor. He was like a living masterclass in long-term thinking. But notice what's happening here. This isn't just fan mail. It's a strategic move. He's absorbing the core principles of a winner before he even thinks about setting out on his own path.
And boom, right there, that's the absolute core of Robert Torre. Even with all that respect for Buffett, at the end of the day, his loyalty was to his own independent thought. Trusting his own judgment over the roar of the crowd wasn't just a quirk, it was the secret ingredient to his entire career.
All right, so here's our roadmap. We're going to trace his journey, from his really unconventional start, through the painful, costly mistakes that actually made him who he is, and then get to his core philosophy. From there, we'll see how that put him head-to-head with Wall Street. And finally, we'll boil it all down into a playbook any of us can learn from.
So who was this guy they called the Buffett of Bethesda? Well, let me tell you, his story doesn't start where you'd probably think.
Just look at that starting point. Torre wasn't some Wharton finance bro. He graduated from Duke with a degree in history. He kind of stumbled into the industry, which, it turns out, was his secret weapon. It gave him a totally different lens. He didn't see the market as a bunch of spreadsheets. He saw it as a long story of human behavior and big, sweeping historical trends.
And that unique perspective, it led him to a set of principles that, look a whole lot like Buffett's. He was all about buying great, growing businesses, especially when they were going through some temporary trouble. He wasn't scared to put big money into his best ideas, and once he bought in, he was planning to hold on for dear life, just tuning out the daily static from the market.
But look, this brilliant philosophy, it wasn't something he just read in a book, oh no. It was forged in the fire of some really painful and sometimes just plain ridiculous investment mistakes.
You know, seems like every great investor has that one story of an early mistake that just stung so bad. For Torre, it was a lesson he'd never, ever forget. And it all revolved around a story stock that sounded way, way too good to be true.
Okay, get this. The company was called Agricultural Research and Development. The story they were selling was revolutionary. They were breeding pigs that were totally immune to diseases. I mean, who wouldn't want in on that? Torre bought in, the stock soared, but the truth was a little less scientific. See, to create their disease-free herd, they were just, killing any pig that showed the slightest sign of being sick. The story completely fell apart, and the stock went straight to zero. Total wipeout.
And in his own, super understated way, you can just feel how heavy that lesson was. The big takeaway? A great story is completely worthless if the business underneath is a house of cards. This disaster taught him that, mistakes are going to happen, but actually learning from them is what separates the grown-ups from the kids in this game.
And that pig farm? That was just the beginning of his education. He learned the hard way to be super skeptical of management that just brushes off huge problems like asbestos lawsuits. He got burned by executives who are fudging the numbers to line their own pockets with bonuses. He learned to raise an eyebrow at bizarre acquisitions, like a company randomly buying a hearing aid manufacturer with no new tech. And he learned that management isn't always going to tell you the truth about the competition. Every single failure was just another brick in the foundation of his success.
All right, so all of these lessons, all this scar tissue, it all led him to one simple, incredibly powerful conclusion that became the absolute bedrock of his entire investing style. He figured out this critical distinction. He realized that a lot of so-called value stocks are just cheap for a reason. They're just plain bad businesses that are almost guaranteed to disappoint you. So he just flipped the whole idea on its head. Instead of getting a low price for a crummy business, he was more than happy to pay a fair price for a great one.
And this coach nails his entire worldview. The stock price? That's just a flickering number on a screen. It's temporary. True, lasting value comes from what the business is actually doing. Its profits, its growth, its moat. If the business does well over the years, the stock will take care of itself.
And hey, the proof is in the pudding, right? Just look at this performance chart. This shows his fund's growth right through the dot-com bubble and crash. While everyone else was chasing tech stocks with zero earnings, Torre's focus on real, profitable companies just created this steady upward climb. This wasn't just a theory, it was a strategy that was making and protecting real money while a lot of people were getting absolutely wiped out. This right here gets to the heart of his radical patience. I mean, think about it. When everyone on Wall Street is obsessed with the next quarter, Torre was thinking in decades. He actually said that from his point of view, any time frame under 5 years was basically meaningless noise. He was playing a totally different sport than almost everybody else. And because he was playing a different sport,
He had some very, let's say, pointed things to say about how the financial industry usually operates. He had zero patience for what he called the relative performance game. You know, that endless cycle of fund managers frantically buying and selling, chasing whatever's hot, just trying to beat the S&P 500 by a fraction of a percent each quarter. He saw the whole thing as a giant value-destroying circus that only made the middlemen rich, not the actual investors.
He even did the math on the damage. He figured that taxes from all that trading, plus the fund fees and the advisor fees, all that can eat up a staggering 5% of your return every single year. I mean, just think about that. If the average business grows at maybe 6%, Wall Street and the government are taking almost the whole pie.
And this put him in a direct collision course with conventional wisdom. Wall Street screams, diversify. He said that just guarantees you'll get mediocre results. The whole industry is built on asset allocation. He called it total nonsense. For Teray, it was simple. The only thing worth owning for the long haul was a piece of a great, growing American company. Full stop.
Okay, so after all the stories and all the critiques, what can we actually take away from Robert Torrey's incredible career? Let's try to boil this all down into a clear, actionable playbook.
Here they are, the 7 timeless rules. 1. Buy superior businesses, not cheap value traps. 2. Focus on the business itself, not the squiggly line of the stock price. 3. Be patient and wait for a price that makes sense. 4. Just ignore the noise from market gurus and academics. 5. Put your money in a few companies you really believe in. 6. Think in decades, not quarters. And finally, number 7, the most important rule of all. Be your own guy. Trust your own work.
This quote, it's the perfect bow on top of his whole philosophy. If you want to achieve something better than average, you simply cannot think and act like the average person. It takes guts, it takes patience, and it takes a deep, unwavering commitment to thinking for yourself. Robert Torrey lived that every single day.
And all this really leaves us with one big question to ask ourselves. When you look at your own investments, what are you really doing? Are you a true long-term owner of excellent businesses? Or are you just playing the market's frantic short-term game? The answer to that question, well, it could change everything.
So let's talk about a guy named Edwin D. Walczak. He's a fund manager who did something most people in his line of work can only dream about. He consistently beat the market. But you know what? This isn't really a story about success. It's about what came after. A crisis of confidence so deep it forced him to question everything, and I mean everything, he thought he knew about investing. And this is the question that just ate away at him. Can you imagine that? You're a professional investor, you're doing your job better than almost everyone else, and you're still looking in the mirror thinking, this isn't good enough? This one quote, it just gets right to the heart of his entire struggle.
You know, this idea of self-doubt, that's really the engine of this whole story. His journey is this fascinating look into the psychology of investing, a world where you can be objectively successful, but it can still feel like you're failing. It's what pushed him to find a better, more solid way of doing things.
Let's just put some numbers on this so you could see what we're talking about. Over a full decade, his fund outperformed the S&P 500 by 1.8% after fees. Now that might not sound like a huge number, but in the world of fund management, that is the holy grail. He was winning the game. But for him, it wasn't enough.
Okay, so to really get what he was going through, you got to picture the scene. It's the late 1990s, the absolute peak of the dot-com bubble. Walczak was what's called a value investor. Basically, he looked for solid, maybe even boring companies that just seemed undervalued. But back then, the market was going crazy for flashy tech companies with zero profits, and it was absolutely punishing the kinds of stocks Walczak owned. He literally called it a nightmarish time.
And the pressure he was under was just immense. The amount of money in his fund absolutely plummeted. It went from a high of $600 million all the way down to just $125 million. People were pulling their money out left and right. Other big-name value managers were getting fired. Walczak thought he was going to lose his job too. This wasn't some academic exercise for him. It was a fight for survival.
And if you look at the fund's performance, it was just a total roller coaster. After climbing steadily through the mid-90s, it just took this sharp, painful dive heading into the year 2000. That was the value enter. He was down 14% in 1999 alone. But then, and this is the crazy part, as the tech bubble burst, his discipline paid off big time. The fund shot up 35% in 2000, even as the rest of the market was crashing. That kind of volatility would test anyone's courage.
So with all this chaos happening on the outside, what does Walzak do? He starts looking inward. He began to question everything, not just whether he picked the right stocks, but the very foundation of his entire investment strategy. He was asking himself, is my whole approach just wrong?
And these are the questions that were just tearing him apart. Should he be bolder? Focus his bets on just a handful of stocks? Was he selling his big winners way too early? Was this just a tough market, or was his entire philosophy just broken? And then the biggest question of all for him. As a self-described Buffett Mooney, a huge admirer of Warren Buffett, why couldn't he get the same results as the master himself?
And you know what's wild? He came to this incredible conclusion. The answer wasn't to be smarter. It wasn't to do more research or build better spreadsheets. He realized there's a limit, a fundamental limit, to what any one person can really know about a company or about the future. Simply having more brain power wasn't going to solve this puzzle.
So he's looking for answers, and this search, it takes him on a journey, both in his mind and, well, literally. He decided to go straight to the source to try and get some wisdom from the one person he admired more than anyone in the investing world.
At the absolute lowest point of his professional life in 1999, he made what he calls a pilgrimage. He was feeling totally despondent, and he flew to Omaha for the Berkshire Hathaway annual meeting. And the way he describes it is so powerful. He said it was like a priest who's lost his faith going to the Vatican to see the Pope. He was looking for something to believe in again.
And you can feel his frustration here, right? He's grappling with this huge conflict at the heart of being a money manager. On the one hand, what you really want are these patient, long-term clients who get what you're doing. But the reality? He saw that most clients are just driven by momentum, by emotion. As he put it, they're in at the highs and out at the lows, the exact opposite of what a value investor is supposed to do.
And it's out of all this chaos, the market pressure, the crippling self-doubt, even that trip to Omaha, that something new starts to take shape. A clearer philosophy began to emerge for him. He started to see investing not as a science, but as, well, something else entirely.
This was his big aha moment. He realized that all the numbers, the formulas, the spreadsheets, that's only about 10 or 15% of the job. The real work, the other 90%, it's qualitative. It's all about understanding the business itself. What does it actually do? How does it make money? Is this a business that you can truly, genuinely understand?
And, his hero, Warren Buffett, had the perfect line for this. He said if investing was really that simple, if it was just about crunching numbers, then librarians would be billionaires. It's just a fantastic quote that perfectly captures this idea that the real answers aren't found in a textbook.
So, okay, if the math isn't the most important part, then what is? For Walzak, it all came down to one single qualitative question. Does this company have a sustainable competitive advantage? That became the absolute centerpiece of his new philosophy. All those complex financial models, they were secondary, because without a real understanding of the business, those models are just, as he put it, garbage in, garbage out. And this all leads us to the big takeaway from Walzak's whole ordeal. It's not about finding some magic formula that always works. It's about embracing something that's really rare in the world of finance: intellectual humility. This story just says it all. Early in his career, a young Walzak went to the legendary investor Mario Gabelli, pitched him some bad stock ideas, and asked for a job. Gabelli's response was brutal. He said, "If you want to work here, you'll have to pay me." And looking back, Walzak totally agrees, saying, "I didn't know shit." It's this raw, humbling memory that really grounds his entire philosophy.
And this kind of became his personal mantra. Now, it sounds really self-deprecating, but it's actually a super powerful strategic statement. If you believe that your knowledge is limited and that you should act very, very rarely, what does that lead to? A concentrated portfolio with very little trading. It's a whole philosophy born from humility. And this is the fundamental truth he finally landed on. In a business that is all about trying to predict the future, he accepted that true certainty is almost impossible to find. And realizing that isn't a sign of weakness, it's a sign of wisdom.
So Walzak's story is really about one person's struggle to find conviction during a nightmarish time. He found his answer not in more data or more complex formulas, but in humility and in a deep qualitative understanding of a few great businesses. And that really just leaves all of us with a question, doesn't it? In a world that is just filled with endless information and market noise, how do you find your conviction?
All right, let's get into it. Today we're unpacking the story of James Gibson and the Clipper Fund. And this is a really fascinating one, a true masterclass in what it means to go against the grain. It's a story about being wrong and then being wrong again and again, right before you're proven to be spectacularly, undeniably right. So here's our game plan. First, we're going to dig into what made Gibson a real contrarian, not just someone who claimed the title. Then we'll break down the fund's core philosophies, step by step. After that, we'll relive the tough years, that real test of conviction, before seeing the incredible reward. And finally, we'll pull it all together to see what lessons we can learn. Okay, so first things first, we hear that word contrarian thrown around all the time in investing, right? But what did it actually mean for James Gibson? What set him and his team so far apart from everyone else? You know, it's pretty easy to call yourself a contrarian when your strategy is working. But what happens when it's failing? I mean, for years on end. How do you stick to your guns when the entire market, probably your clients, and even your own performance numbers are telling you you're dead wrong? That's the real test. And this quote from Gibson just hits the nail on the head. Talk is cheap. Being a real contrarian isn't some marketing slogan you slap on a brochure. It's a discipline, a painful, deeply ingrained discipline of acting against the herd, especially when it's costing you in the short term. So, what did this disciplined approach actually look like in practice? The Clipper Fund wasn't just a random collection of stocks. It was built on a very clear, very powerful, and pretty much non-negotiable set of principles. The whole strategy really boiled down to these 4 pillars. Their success wasn't some happy accident. It was a direct result of sticking to this playbook no matter what. So let's break each one of these down. First up, concentration. Now, you always hear diversify, diversify, diversify. Gibson's view was the exact opposite. He believed in making big, concentrated bets on his absolute best ideas. The fund only held about 30 stocks because, as he said, if you're being honest, your 10th best idea is probably going to do a lot better than your 50th best idea. Second, they completely ignored the idea of a catalyst. They weren't trying to predict some news event or earnings surprise that would make a stock jump. Gibson thought that was just being too clever by half. Instead, their entire focus was on one thing and one thing only, the true underlying value of the business itself. And this right here, this was the engine of the whole operation. They hunted for great companies, businesses with strong brands and dominant market positions, what they called franchises. But here's the kicker. They would only pull the trigger and buy if the market hated that stock so much that it was trading at a huge discount, at least 30% below what they calculated its real value to be. Okay, so having a philosophy is one thing, but sticking with it when it feels like it's completely broken, that's a whole different story. And the tech bubble of the late 90s put the Clipper Fund through the ultimate stress test. Just look at this. For 4 consecutive years, as the dot-com craze was taking over the world, Gibson's old-school value strategy looked obsolete. While tech stocks with no profits were going to the moon, the Clipper Fund was lagging behind the market, year after painful year. And 1999? That was the absolute bottom. The S&P 500, just roaring ahead on tech mania, was up 20%. And the Clipper Fund, stubbornly sticking to its guns, it was actually down 2%. Can you even imagine the pressure they were under? The calls from investors begging them to just give up and buy some tech stocks. But then, after 4 long years in the investing wilderness, the tide turned. And when that tech bubble finally popped, all that patience, all that pain, it was rewarded in a way that was just spectacular. And here it is, the great reversal. In 2000, as the S&P 500 was crashing, losing 10% of its value, the Clipper Fund soared, a massive 35% gain. That's a 45-point swing against the market in a single year. It was the ultimate I told you so. Seeing it like this on a chart just drives the point home, doesn't it? I mean, that's not just beating the market. That's playing a completely different game. The very discipline that made them look foolish just a year earlier became their superpower. But, you know, this chart might be the most important one of all. When you zoom out and look at the big picture, that absolutely agonizing stretch in the late 90s, it's just a little blip, a small dip in what is otherwise a powerful, steady climb upward. It really puts that short-term pain in perspective. So what was it that drove this incredible rebound? Not the sexy tech stocks of the day, that's for sure. It was boring, out-of-favor companies. You had Philip Morris, which one of the managers called a cash machine, even with all its legal headaches. And you had the mortgage giants, Freddie Mac and Fannie Mae. So let's pop the hood for a second and look at a couple of stats that really show just how different the Clipper Fund's DNA was. This wasn't just a slightly different flavor of mutual fund, it was a fundamentally different kind of investment vehicle. This number, beta, tells you a lot. A beta of 1 means you move right along with the market. Clipper's was just 0.37. So, what does that mean? It means the fund was way less volatile than the overall market, giving its investors a much smoother, less stressful ride. And this number is maybe even more telling. The fund only had a 25% correlation with the S&P 500. Think about that. That means 3/4 of the time, the fund was basically marching to the beat of its own drum, totally independent of what the broader market was doing day to day. A true diversifier. It's also interesting to see they offered a sort of supercharged version of their strategy. The UAM Clipper Focus Fund took the same ideas, but turned them up to 11. No cash buffer, stocks only, and it was even more concentrated, with over a third of its money in just 5 companies. It was their philosophy in its purest form. So, we've walked through the tough times and the incredible payoff. What's the big takeaway? What can we really learn from the story of James Gibson and the Clipper Fund? You know, I think Morningstar just nailed it. They're the ones who named Gibson's team managers of the year after that amazing turnaround in 2000. And their assessment was simple. It's a great strategy if you have the stomach to hang on. The reward is there, but you have to earn it by surviving those long, painful years when it's not working. And really, that's the final question this whole story leaves us with. And it applies to so much more than just investing. Do you have the conviction, the psychological strength to stick with the sound process, even when the entire world is screaming that you're wrong, all for the chance to ultimately be proven right? Welcome to The Explainer. Today, we're going to get into the career and, really, the philosophy of one of Wall Street's most influential, successful, and controversial figures, Michael Price. I mean, this was a guy who made billions for his investors, but depending on who you asked, he was either a hero for the common shareholder or a straight-up villain of corporate America. Okay, let's dive into this. So, which one was he? A ruthless corporate raider who cost thousands of people their jobs? Or was he a champion for the average person who trusted him with their life savings? You know, this very question was at the heart of a PBS documentary that really thrust Price into the national spotlight. And you really got to understand the context of this quote. This was the documentary's closing line, delivered with this really heavy tone. And right after these words, the program cuts to footage of Michael Price on a polo horse, literally riding off. It's an incredibly powerful piece of television that paints a very clear and, yeah, a very damning picture. But was he actually the villain of the story? Well, like with most things, the reality is way more complicated than a TV soundbite. To really understand Michael Price, we need to look past that caricature and examine the two sort of conflicting narratives about the man. So on one hand, you have the documentary's version of him, right? This larger-than-life symbol of Wall Street excess. They're focused on the polo, the custom suits, and of course, his big role in pressuring Chase Bank into that merger with Chemical Bank that led to 12,000 layoffs. But then, on the other side of the ledger, you have a guy who started with, and these are his words, zilch, who used his fund to save 7 banks from going under, gave millions back to his university, and was just absolutely adored by the very shareholders he worked for. Now, Price, as you can imagine, felt the documentary was a complete hatchet job. He thought it was totally unbalanced and offered a very different take on all the accusations that were being leveled against him. And he was not shy about defending his actions or his lifestyle. He just systematically broke down the image they created. The polo thing, he said it's a team sport he can still play because football injuries totally wrecked his knees. And he argued that it costs him less, relative to his income, than what the average person might spend on fishing. The custom suits? Just a practical thing, really, because he lifted weights and off-the-rack suits just didn't fit him. And where did all this wealth come from? It wasn't handed to him. It was earned by providing terrific risk-adjusted returns for everyday people for over 2 decades. So what about the big one, the Chase Bank merger that cost so many people their jobs? Price didn't run from this at all. He argued that his pressure, far from being destructive, was actually essential for the bank's long-term survival. From where Price was sitting, he saw a company that was performing terribly. I mean, the worst in its class. He made the case that if Chase hadn't merged, it would have become a very sick company, which would have led to even more job losses down the road. For him, the logic was super simple. His number one duty was to his shareholders, and in a capitalist system, it's the shareholders who call the shots. To really get why he did what he did, we have to go deeper than just one merger. We've got to look at the investment philosophy he picked up from his legendary mentor, a guy named Max Heine. This philosophy was the bedrock of everything the Mutual Series Fund did. Now, this wasn't about chasing hot stocks or trying to guess the market's next move. Not at all. It was a disciplined, research-heavy, and deeply contrarian way of finding bargains where pretty much nobody else was looking. And it all went back to the godfather of value investing himself, Benjamin Graham. You know, this quote just says it all. Max Heine's partner remembered him saying this, and it perfectly captures their mindset. It meant you needed huge amounts of patience and, maybe even more importantly, courage. The real test of a true value investor wasn't cashing in during that one fantastic year, but having the guts to stick with your principles during that one horrible year. So the strategy really broke down into 3 core areas. First, you had your basic Graham and Dodd value investing. Figure out a company's real worth and buy it for way less. Second was risk arbitrage, which is all about analyzing mergers and takeovers to find an edge. And the third part, this was the really gutsy stuff. Diving headfirst into bankruptcies and distressed companies to find value where everyone else just saw chaos. As one of the managers said, we don't mind pain as long as it's not ours. And the foundation for all of this? It was completely non-negotiable. David Winters, the fund's chief investment officer, put it really bluntly. When he interviewed people for a job, he'd ask, "Have you read Ben Graham?" The answer decided everything. You were either on the train or off. It was really that simple. So this philosophy wasn't just some abstract theory they talked about in the office. Michael Price was famous for his hands-on, super intensive research process. He called it kicking the tires, and it meant doing the hard, grinding work to find out what a company's assets were really worth. Okay, a perfect, almost legendary example of this in action was when Max Heine made this huge bet on the Penn Central Railroad right after it went bankrupt in 1976. And let me tell you, this was a move that absolutely terrified most of Wall Street at the time. So the situation is this massive, chaotic bankruptcy. But Heine's insight, which came from just hardcore research, was beautiful in its simplicity. He calculated that the scrap value of the railroad's tracks alone was enough to cover the bonds he was buying for just 10 cents on the dollar. This one bet showed everything they were about: courage, patience, and doing the work. It absolutely put Mutual Series on the map. Let's look at another one. This time, it's a manager named David Marcus making a big investment in a French water company called Suez. And this move wasn't just contrarian to Wall Street. It actually startled investors in Europe. They thought he'd lost his mind. Marcus himself said that a local French stockbroker literally told him to his face that he was stupid for buying into Suez. The feeling on the ground was just overwhelmingly negative. But Marcus, because he had done his own research and kicked the tires, trusted his own analysis over all that market noise. So he went ahead and bought 3% of the entire company. And the result? The stock tripled. The stupid investment paid off spectacularly. It just proved, once again, the incredible power of their independent, research-driven, and deeply contrarian approach. They saw value where everybody else just saw risk. And look, this strategy of courage and research wasn't just about a few legendary home runs. It delivered consistent, long-term results. Just take a look at this chart of the Mutual Beacon Fund during Price's tenure. It really demonstrates that steady, powerful wealth creation that made his shareholders so incredibly loyal. So what can the average person actually learn from all of this? Well, fortunately, Price was pretty open about his core principles. He laid out a clear playbook that cuts right through what he called the gibberish on Wall Street. This single sentence, this is pretty much his entire philosophy. It sounds so simple, right? But it contains 2 incredibly difficult things. First, you have to do the hard work to figure out what a business is truly worth. And second, you have to have the discipline and the patience to wait until the market offers it to you at a massive discount. His advice for the rest of us was just as direct and focused on the fundamentals. Read the prospectus, he said. People are lazy and they just don't do it, but that's where all the hidden fees live. Check the 5- and 10-year track record, not just what happened last quarter. Look at what the fund actually owns and ask yourself, would I buy these companies myself? The common thread through all of it is pretty clear. Do your own homework. Okay, so let's bring it all back together. How should we remember Michael Price?
Was he the polo-playing corporate raider from that documentary? Or was he something else entirely?
Well, in his own words, his job description was pretty simple. He wasn't there to worry about long-term corporate strategy or social policy. He saw himself as an agent for his shareholders, and his function was to buy undervalued assets and then do what was necessary to see their value realized. And this gives you the other side of the story. While the media might have painted him as a villain, his own shareholders, they saw him as a hero. At shareholder meetings, you had ordinary, often elderly people who would just shower him with affection, bringing him small gifts and thanking him for the financial security he'd given them. The source material actually describes it as a love fest. Ultimately, the story of Michael Price forces us all to confront a really fundamental and difficult question about modern capitalism. When that drive to unlock value for shareholders leads to painful outcomes like layoffs, is that a necessary service in an efficient market? Or is it a sin? His career doesn't give us an easy answer, but it perfectly frames a debate that is more relevant today than ever before. So what if you could just tap into the combined wisdom of some of the greatest value investors of all time? Well, that's exactly what we're going to do today. We're going beyond just one single legend to pull together the core strategies of masters like Charles Royce, Jean-Marie Evelard, and Mario Gabelli. Our goal? To create a powerful, unified framework that you can actually use. But let's kick things off with a quote that might sound a little weird. Charles Royce, a true master of value investing, straight up admits that investing in growth stocks, the high flyers, the exciting stories, is just more fun. So why on earth would he and all the other legends we're about to study choose the harder, less glamorous path? What's the secret they know that pretty much everyone else misses? To get to the bottom of that, we've broken their philosophy down into 5 crucial stages. We're going to start with the absolute essential, the contrarian mindset. Then we'll put on our detective hats as we hunt for hidden value. After that, we'll have to brace ourselves for the agony of waiting, master the art of knowing when to sell, and then finally we'll distill it all down into some timeless lessons that can really shape your own investment journey. Okay, first up, the foundation for everything else, the contrarian mindset. See, before you can even think about looking at a stock, you've got to have the right psychology. It's a fundamentally different way of seeing the world, and it separates these investors from the crowd right from the get-go. Charles Royce gives us this really raw but honest take. You don't just decide one day to be a value investor. You're forged into one. It happens after you've lost money, after you've really felt the sting of a high-flying stock completely collapsing. That pain, it creates this deep-seated realism and an intense focus on risk. It's a lesson you can pretty much only learn the hard way. And that mindset leads directly to a powerful strategy, which Robert Oldstein defines perfectly here. A value investor is someone who buys stocks for less than they're really worth, their true underlying intrinsic value. And how do they do that? By exploiting crowd psychology. They see temporary problems in market panic not as things to run away from, but as the very source of their biggest opportunities. You gotta hear this next quote. It's supposedly left an entire panel of financial experts totally speechless. When he was challenged about why he still held stocks even though he had a pessimistic outlook, Jean-Marie Evelard just said, "I may be wrong." I mean, wow. That's a stunning admission of humility in a world that just craves certainty. The true value investor is always acknowledging they could be wrong and builds their whole strategy around that fact. And that humility leads right into this classic saying quoted here by Colin Varenbach. To survive in the market for the long haul, you just can't be bold and reckless. You have to be conservative. The goal isn't about hitting home runs every time. It's about staying in the game for decades. And that requires a patient, tortoise-like approach, not flying too close to the sun. So, once you've got that contrarian mindset locked in, how do you actually put it into practice? What are you really looking for in a company? This is where the real detective work kicks in. And this right here is the central question of the hunt. It's not some single secret formula. As we're about to see, each of these masters has their own unique criteria, their own special lens for spotting hidden value where everybody else just sees trouble. I absolutely love this medical analogy from Charles Royce. He's not out there buying terminally ill companies. No way. He's looking for fundamentally healthy businesses that have just caught a cold. Maybe their growth slowed down from 20% to 12%, and the market completely freaked out and crushed the stock. He sees a temporary sickness that can be cured, not a fatal disease. Now, Mario Gabbielli, on the other hand, he's looking for something a little different. He searches for a franchise, a company that has such a dominant position in its market that it's practically indestructible. It can weather any economic storm and probably come out even stronger. For Gabelli, the durability of the business itself is everything. But here's the thing. Despite their different philosophies, they all speak the same language: conservative finance. This chart really highlights their common ground. They're all looking for a low price compared to the company's earnings or assets. They demand low debt to make sure the company can survive a bad downturn. And they prioritize strong free cash flow, the actual cash a business generates. So whether it's Olstein's mantra of price, price, and price, or Gabelli's focus on cash, they're all grounded in these hard, defensive numbers. So how do they dig up all this information? Well, this slide basically synthesizes their methods into a clear 4-step process. First, you hit the books, especially the footnotes. That's where companies hide all the juicy details. Then, you talk to management to get the official party line. But then, and this is so key, you go talk to their competitors to get the real story. And finally, you dig into the proxy statements to see if management's interests are really aligned with shareholders or if they're just enriching themselves. Okay, so you've done the detective work. You've found a great company at a great price. Now comes the hardest part of all, the part that tests even the most disciplined investors out there, the agony of waiting. And let's be crystal clear, this isn't just about being patient for a few months. We're talking about a kind of patience that can feel infinite. And as our source material makes brutally clear, it doesn't always pay off. This right here is the ultimate test of a value investor's conviction. And this quote just brilliantly illustrates the pain involved. I mean, imagine you've done all the work. You've found a bargain, you've waited patiently for years. Then, just as the value is about to be recognized, the company's own management, who also knows it's cheap, buys the company out from under you for a lowball price. Royce calls it a big problem, and you can just feel the frustration in those words. Robert Olstein explains exactly why this patience is so necessary. The very market inefficiency that creates your opportunity, those deeply ingrained misperceptions of the crowd, is also the thing that makes the process so incredibly slow. You can't just expect the market to suddenly wake up tomorrow and agree with you. It takes time for the story to change and for that true value to be recognized. Okay, so your patience has finally paid off. The stock has soared, but now you face a question that is just as critical as when you bought it. When do you sell? And, as we're about to see, this is where even the masters don't always agree. This slide shows two fundamentally different approaches. On one side, you have Charles Royce, who says selling a great company just because it's no longer small would be absurd. Why would you clip the flowers just as they're starting to bloom? But then on the other side, you have Jean-Marie Evelard, who is a strict disciplinarian. He bought Johnson & Johnson when it was cheap, and he sold it the moment it was no longer a value stock, fully admitting he was probably selling too soon. So what do? Stick with your winners or stick to your principles? Robert Olstein offers a third perspective, and it's one that explains his fund's pretty high turnover rate. For him, it's all about a constant calculation of risk versus reward. The second a stock's price makes it more risky than it is rewarding, he sells. He's not really concerned with holding for the long term, he's concerned with managing risk at all times. Phew, okay, so after exploring the mindset, the hunt, the waiting, and the selling, what are the ultimate takeaways? This final section distills everything we've talked about into powerful, enduring lessons for every single one of us. All right, this is the master list. These are the core principles. First, be patient. We've definitely seen how critical that is. Read Graham and Dodd. It's the Bible of value investing. Diversify, which one investor cheekily notes keeps you from falling asleep. Take a long-term view and just ignore the market's daily noise. Do not extrapolate recent trends into the future, because today's hot stock is so often tomorrow's disaster. And finally, recognize that the battle between value and growth is cyclical. Each one will have its time in the sun. It's just the natural order of the market. And we're going to end with this profound thought from the legendary Max Heine. Many roads lead to Jerusalem. While the core principles we've discussed are your compass, this is a beautiful reminder that there is no single secret formula. Royce, Gabelli, Evelard, they all took different paths to get to the same destination. Their wisdom gives us the map, but you ultimately have to choose your own road. The only question is, which path will you take? When you hear the name Warren Buffett, you probably think of one thing, right? Investing success. But how exactly does he do it? I mean, it can feel like this incredibly complex, maybe even magical process, but what if we could actually break it down? What if we could turn it into a clear, understandable blueprint? Well, that's exactly what we're going to do today. We are going to deconstruct the Buffett blueprint. All right, so here's our game plan. We're going to start with the practical stuff. 3 direct ways you can literally start investing like Buffett today. Then we'll dive into the really crucial part, the mindset that separates the best from the rest. From there, we'll cover his core principles, his actual checklist for finding great companies. And finally, we'll look at the man himself, because his personal character is really what makes the whole thing work. So let's jump right in with Section 1, 3 ways to invest. Think of these as your on-ramps into Buffett's world. We'll go from the absolute simplest path to a more hands-on approach. It's a pretty straightforward question, right? How do I do this? And you know what? The answers are actually pretty straightforward too. You don't have to be some kind of Wall Street wizard to get started. There are clear, tangible options out there for just about anyone. Okay, here they are. Path number 1 is the most direct route. You just buy shares of his company, Berkshire Hathaway. Simple. You are literally buying a piece of his entire portfolio. Path 2 requires a little more legwork. You can follow Berkshire's public filings and buy some of the same individual stocks they own, like Apple or Coca-Cola. And Path 3? You can find mutual funds that are specifically run with a similar Buffett-style philosophy. You can even mix and match these. The bottom line is, you've got choices. But just knowing what to buy is only the beginning. And that brings us to Section 2, the superior investor's mindset. Because honestly, picking the right stocks is only half the battle. The real secret sauce, it's all in your head. It's not just what you buy, it's all about how you think. Okay, now this is fascinating. This slide is based on a poll of 24 really respected investors. On the left, you've got the value investors. They're all about doing better research than anyone else and being willing to go against the crowd. On the right, you've got growth investors. They prioritize logic, keeping emotions out of it, and knowing when to sell. But look closely. What's the number 1 priority for both groups? Sticking with your strategy. That discipline, that's universal. So where does Buffett fit into all this? Well, here's the key takeaway. He's not just one or the other. He is a hybrid of both. He started out as a pure value guy, sure, but he evolved. I mean, think about his massive investment in Apple. The value investor in him saw a company with an untouchable brand, a huge competitive moat, and it was trading at a reasonable price. But then the growth investor in him kicked in and saw this incredible, sticky ecosystem and a services business that was just going to explode. He brilliantly blends the best of both worlds. This mind map really is the perfect snapshot of that hybrid approach. You can see all those traits in one place. He's logical, and he's not afraid to be contrarian. He's flexible, which is what allowed him to evolve his strategy over the decades. And when we say deep research, we're not just talking about reading annual reports. We're talking old school, boots on the ground stuff, like actually visiting companies in person. You put that together with a disciplined sell strategy, and you really see how he embodies the best of everything. So that brings us right to Section 3, Buffett's core investment principles. If the mindset we just talked about is the how, then these principles are the solid as a rock why. This is the absolute bedrock of his entire strategy. These are the rules that guide every single decision he makes. And get this, these 6 pillars were actually reviewed and approved by Buffett himself. So this is the real deal. First, you have to be a fanatic, genuinely fascinated by the whole process. You need extreme patience, the kind where you'd be willing to hold a stock even if the market shut down for 10 years. You have to think for yourself and have the self-confidence that comes with that so you don't panic sell. You also need the humility to admit you don't know everything. And finally, the golden rule. Find a great business, but never, ever overpay for it. And that third pillar, being an independent thinker, is so critical. This quote from Buffett's mentor, Benjamin Graham, just nails it. It's not about whether you're popular. It's about whether your facts and your reasoning are sound. What everyone else is yelling about, that's just noise. Your homework is what actually matters. Okay, so we've got the mindset down, we've got the core principles. Now it's time to get practical. Welcome to Section 4, Defining a Wonderful Business. This is the toolkit. This is the actual checklist that Buffett uses to sort the truly great companies from the ones that are just... Okay. So what in the world is a wonderful business? Well, in a nutshell, it's this. A company that makes a good return on its money, has a powerful brand or competitive edge, churns out predictable profits, and, this is a big one, you can actually understand how it makes money. No complicated black boxes allowed. So let's break that down a bit more. Part 1 of the checklist is all about the financial health and the business itself. He's looking for great returns on capital without a ton of debt or any funny accounting gimmicks. He wants real cash profits, not just numbers on a page. He's looking for a powerful franchise, that economic moat, that gives the company the freedom to raise prices. And again, it's got to be simple to understand and ideally not constantly in the crosshairs of government regulators. And part 2 of the checklist is all about operations and leadership. He wants earnings to be consistent and predictable, not all over the map. The business needs to be efficient, like having low inventory that turns over really quickly. It can't be a capital black hole that just constantly needs more and more money poured into it. And I love this one. Buffett famously says he wants a business so good that an idiot could run it. And finally, and maybe most importantly, management has to think like owners and always put shareholders first. All right, now for our final section, the man behind the method. Because after you go through all the checklists and all the principles, you realize something profound. This entire blueprint, it's all built on the foundation of one person's character. His personal traits are what make the whole strategy possible. First and foremost, you have to understand this. Warren Buffett is not a gambler, period. He's not rolling the dice on some long shot. He is absolutely determined to only invest in what he considers to be almost sure things. He plays a game that he knows he can win. He is also brutally, intellectually honest. He doesn't hide from his errors or sweep them under the rug. He ruthlessly studies his mistakes, figures out exactly what went wrong, and makes sure he learns the lesson so he never, ever repeats it. And this is so important. It's not just about the numbers on a spreadsheet. Character is everything to him. He flat out insists on working only with people that he trusts and admires. For Buffett, who you are in business with is every bit as important as what the business is. And in the end, it really all comes down to this. In his own words, success isn't about predicting which way a stock chart is going to go. It's about good business judgment combined with the mental strength to keep yourself separate from all the super contagious fear and greed that are constantly swirling around the market. It's about logic over emotion. Always. So there you have it. The mindset, the principles, the checklist, and the character. You have the complete blueprint to Warren Buffett's legendary success. The only question left is, what's the first brick that you're going to lay?